Each presentation you'll see is designed to deliver not just information, but perspective, the catalysts, the valuations, and the underlying theses that can drive performance. What sets us, Singular Research, apart? For over 20 years, Singular Research has been committed to one mission: performance-based research. Unlike many firms, we're independent, our ideas are conflicted and uncompromised by investment banking or paid-for-play corporate sponsorships. That independence has allowed us to build a reputation of trust and credibility with institutional investors across the country. We've got the numbers to back that up. Our coverage list, our bread and butter, has consistently outperformed the S&P 500 over the long run. We've earned broad distribution and wide acceptance in the institutional marketplace with over 110 clients with over 60 billion in assets under management. Our team is dedicated to surfacing and sourcing undercovered, overlooked opportunities, the kind of research that can really move the needle. The Singular brand difference, we'd like to say, we're not just another research shop. We're idea generators with a track record of results. We combine rigorous analysis with an independent spirit, and that blend has given us a staying power for over 2 decades in a very competitive field. So today is not just about presentations or non-presentations. Mostly we'll have presentations. It's about discovery. It's about engaging with new ideas, asking tough questions, and leaving fresh perspectives that can enhance your decision making. And with that, we're going to get started, and we look forward to an educational, entertaining, and rewarding day together. In just a minute.
Ready to go.
Hey, Mark. Okay.
Hey, good morning, everybody.
Hi, good to see you back. So, of course, our platform WebEx has decided to do a makeover, very fancy new makeover. So we're launching into it. We're going to have some fun. So we've got Mark Benz to present his venture, his new company from Canada. Very exciting co-location type, I believe, of AI that you're working with.
Company.
Data centers. And data centers are, if you ask me, the place to be for growth in the next 5 to 10 years. Take it away, Mark.
All right, I just need to be able to share my screen, which you guys should be able to let me do so I can show the presentation and we can get rocking.
All righty.
You need to make me a presenter.
Our in-house technician just got hired away by Goldman Sachs.
Oh.
Those bandits. Huh?
Get it?
So while they're doing that, I do have a question for you.
Yes.
How does one access your research after today? Do you publish a monthly newsletter or weekly stock look, emails? How does that?
So the question is, how do you get a research flow? And the answer is online. Singularresearch.com.
Okay, you guys should be able to see my screen now.
And you can sign up for a free trial.
Okay, can you guys see my screen now?
Yes.
Yes.
Okay, we're ready to go?
Bruce, you can tell them we're ready to go. Yeah.
Okay, I'm going to start then. Let's make sure that the slides are changing. They changed for you there?
Yes.
Yes.
Okay, perfect. All right, well, good morning, everybody. I'm really excited to be here today. My company is called Carrier Connect Data Solutions, and we are a co-location data center company. I think this is going to be the most exciting presentation you're going to see today. We are in the right space at the right time, experiencing absolutely massive growth in the data center industry. We went public in February. We're about an $11 million Canadian market cap. And when you see the opportunity and what we have already done in this business, you're going to see this is a very attractive investment opportunity. We trade on the venture in Canada under CCDS, on the OTCQB in the United States under CCDSF, which is the ticker that probably most of the audience today can buy. We're trading at about 86 cents Canadian or 62 cents. We'll get your bids filled on the QB. The market makers cross stock back and forth between the Canadian market. You can bid even if there's not asks, you'll get filled if you're in that 62, 63 cent range right now. But we're moving up steadily as the business progresses. What is a data center? So first and foremost, it's really important to understand the business we're in. We're selling, it's essentially a real estate play. You sell space, power, and cooling. Space being, this is a rack inside of a data center. Inside of this rack is servers. Might be traditional computing servers, might be new AI servers to enable all the new AI protocols and systems out there. But we sell space in a rack, so you can put your servers in the rack. We sell power, so everything obviously gets powered up. Cooling, which is huge to keep all the servers in the data center cool because they throw off a lot of heat. We connect your servers to the internet with fiber optic connectivity, and we run a whole bunch of power backup systems so the power never goes off. So even if the hydro to the building goes down, our battery systems kick in and keep your servers running. And then behind our battery systems, we have diesel generators. They can run for days and weeks. Even if there was, say a natural disaster and there was no power to the building, your servers would stay online and stay running. Now, what we don't sell, this is really important to understand, is we do not sell servers inside of the racks, and we do not sell services to update servers or run software on servers. This is an IT company or any sort of software company comes and puts their equipment inside of our racks, and we provide them with the infrastructure to run them. So we're a data center, it's called co-location. I don't care if an AI server becomes outdated in a week, a month, or 2 years. That's not our business. The company itself will come and pull their server out, put a new one in, and update them. We're providing the infrastructure that runs the internet and runs AI systems. So it's like a real estate play. Think of it as a building or a floor of a building in any major center where all the local companies come and put their hardware to run it on the internet. Gotta go the other way. All right. So what's going on in data center growth? It's exploding. The need for space in data centers worldwide, North America wide, Canada, US, is going through the roof because of AI primarily. If you ask ChatGPT to plan you a vacation to Ireland, it'll take 10 times as much processing power versus if you ask Google. 10 times as much processing power means literally 10 times as many servers on aggregate. 10 times as many servers means 10 times as much space in data centers. Every server that's running the internet and running software companies and running everything you do on your computer in the cloud lives in a data center, lives in somebody's data center hooked up to the internet, chewing away processing transactions. So you can imagine as compute power goes up, the need for space in data centers goes up very exponentially. This is specifically why I got into this industry, because of this growth and opportunity and the fact that it's going to be here for years and decades to come. You can Google data center growth yourself. You'll find 50 charts that look exactly like this. This is the same thing in written format. What is our company doing? We are doing essentially a roll-up play of buying small to medium-sized data centers that are currently private companies, or they may be owned by corporations, but they're not part of a data center company, primarily private industry companies. And we're buying them for private company multiples and adding them to a portfolio, a public company portfolio. The arbitrage opportunity is very, very significant. These private companies, might be doing $5 million a year in revenue, $10 million a year in revenue. They're great companies. They're profitable. Data centers, by the way, throw off typically 40% EBITDA So 40% profit when they're 80% or more full. And by the way, data centers are almost always full, as we mentioned, because there's massive demand. People are buying space in data centers or renting space a year before they're even built. Let that sink in. Demand in the industry is so high that people are renting space a year before it's available to get in line to have a place to put their infrastructure to run their companies and run their AI companies. That's why they're profitable. They're throwing 40% profit. By the way, data center customers never leave. They're incredibly sticky. They don't want the risk of their servers going offline or downtime or issues for their customers. So they put them in the data centers and they keep them there for years. But there's these private corporations, great businesses, but they're owned by 5 entrepreneurs, and maybe it's 8 guys, and they have a great business. They have a paycheck, but they don't have any liquidity. They don't have any way to cash out and make a few $million and retire. That's where we come along. The big data center companies will never buy their small data centers. They're busy building $100 million facilities. They're $10 billion companies. We can come along and buy these data centers for 2 to 3 times revenue. And then immediately, as we add them to our public portfolio, a public data center company, and there's lots of them, they're usually much bigger, get a multiple of 10 times revenue. So if we buy a company for $1 million, if we buy a company for $3 million, let's say a $1 million revenue company, we buy for $3 million, which is 3x revenue. We put in our portfolio, it's worth $10 million. It's worth 10x revenue. So that's what we're looking for, primarily North America, but internationally. Private companies, good businesses, profitable, standalone. We buy them as they are. There's no need to change them or do anything to them. They have sales teams, management teams, etc. Put them in a portfolio and get a very significant re-rate on the valuation. One other kind is we can buy non-core assets from corporations. And what is a non-core asset? So think of a tech company, like a software company that owns a data center, but they're not a data center company, and they don't either need to or want to own the data center. We can buy from these corporations, again, for good prices and get it re-rated. So that's the thesis, and I'll tell you how it's going, which is extremely well. We bought our first data center in Vancouver in February. It's at 200 Burrard Street. It was called Carrier Connect Systems, and that's how our public company came to exist, Carrier Connect Data Solutions. That was our first asset. It's right in downtown Vancouver. It's a small urban center, but it was perfect for the first transaction because I didn't even need to raise any money to buy it. I owned personally the capital pool company that I created to look for business opportunities with my capital pool company. We bought this data center, took it public, and ended up with Carrier Connect Data Solutions. It has about 50 racks, and it's about 1/4 of a megawatt. Great facility, profitable. Last year it did, it's a small data center, like I said, 360,000 in revenue. This year the target was 500. It's going to do way over that, probably 750 and growing. And the reason we're growing so quickly is we're actually putting AI companies that didn't used to exist into the racks, and they'll pay 2 and 3 times for space what traditional compute companies will. So we got the first data center and we were off and running. Then we bought a second data center in Australia. This is a phenomenal facility. It's 2 megawatts of power, 220 racks of space. Everything's built out. It looks like a brand new data inside. It's got 3 diesel generators for backup systems, 3 industrial chillers, full battery backup. It's doing today about 65,000 a month in revenue, but it's only 20% full. It can do 330,000 a month without a single extra dollar of investment, which is about $4 million a year. $4 million a year could be worth up to $40 million in market cap. It's got $6 million worth of hardware in it. So the racking systems, the generators, and everything else. If I just shut it down today and sold it, I could get $6 million for these assets and for this hardware, and it would cost $20 million to build. Data centers cost about $10 million a megawatt to build. This is a 2 megawatt facility. So if we went and built it today, it would cost at least $20 million. But it was owned by a software company that ended up with this data center through an M&A transaction. They bought another software company. That other company had a data center, and suddenly they owned a data center. And again, this is like our model. They're not a data center company. In fact, they had no interest in being in the data center business. So they wanted to offload it. We heard about it first. We heard about it through the network. Our CTO is the guy who owned the Vancouver data center. He had a relationship. We flew to Australia. We signed the LOI. And we said, hey, we had just gone public. We had just bought our data center in Vancouver, and we said, we'll take this off your hands, because they frankly really didn't want to get rid of it. They didn't know how to run it. They didn't know what to do with it. And we said, you need to give us a good deal or some good financing in particular. And we bought it for 2.5 million Australian, only 300,000 up front. This is the crazy thing, 300 grand up front, and the rest was on a 25-year vendor take back. So they financed the rest. And again, it would cost 20 million to build, and there's $6 million worth of hardware in it. It's profitable today, and it can grow 5x from where it is in revenue as we fill up the rest of the space. And I have all sorts of customers already coming to us saying, oh, you actually have space. We'll move our servers there. This is going to be an absolute cherry facility for us. And again, we've already acquired this and added it to the portfolio. We then signed an LOI to buy a data center company in Ottawa called Pure Colo. They have two 2-megawatt facilities, so 4 megawatts in total. This would cost $40 million to build what they have. It's 4 full data halls, which are rooms that host racks and servers, 60 international customers. The government of Canada is a customer. They've built this from scratch, bootstrapped it. It's 8 years old. They've only ever lost 2 customers in 8 years, one of which they fired because they weren't paying their bills. Another one left to go somewhere else for another reason. The stickiness of the revenue is phenomenal. Today, they're doing 2.6 million a year revenue. They have the space because they just added 2 of the new data halls to the company, meaning they had 2 more parts of the data center with racking. They can do up to $6 million a year. This could be a $60 million market cap business all on its own. It would cost $40 million to build because it's 4 megawatts. We're buying it for $8.5 million, and we're going to close it in Q4 of this year. So that'd be the 3rd data center. And here's the timeline that we're going on. We went public in February, listed as CCDS on the TSX Venture. Again, in the US, it's CCDSF. Through the end of this year, we're acquiring data centers 2 and 3. 2 was Perth, Australia. The 3rd one will be Ottawa. And then through next year, continue to expand the portfolio. We have very active conversations going on with data center companies in Edmonton, St. John, New Brunswick, Calgary, Mississauga, Buffalo. Our model is, so far the investment thesis is working extremely well. We're finding great assets, self-contained businesses, profitable, that we can buy, again, for very attractive prices, as you've seen, add them to a portfolio and get them re-rated essentially as part of a public company portfolio. We thought about starting to build our own. We're at, as I said, like about $11 million market cap, which is incredible what we have for the market cap we have so far. But once we're $100 million market cap, we were like, okay, maybe we'll raise $25 million and start building data centers. But I'm actually becoming a much stronger believer of there's no reason to stop buying, adding to the portfolio, operating businesses, and building the pubco and the holding company that way until we run out of companies to buy. And if that's the case, then sure, we can build. But every time we add a portfolio company, our valuation becomes very significantly higher, and the company continues to be successful. At this stage, when you're fairly early on, although we've grown really quickly and very successfully so far, you're counting on a team. My background has been a public company CEO most of my career. I'm a tech guy right from the start. I have a computer science degree, then a business MBA, and then started getting involved in public tech companies. My last company started with 2 people, started with a 3-cent stock, started with a $3 million market cap, and I built it to a $1 billion market cap company over the course of 6 years. While doing that, raised more than $50 million as a public CEO just with that company. I've been the CEO of 3 different public companies. The first one, we hit a $1 billion market cap. The second one was actually a capital pool company I created and bought a cybersecurity company that's now $125 million market cap within 2 years. And my third one is this company. Started out as my CPC, bought the data center business, and we're going to grow this very significantly. I retired for about 2 years and realized I need something to sink my teeth into for the next 3 to 5 years. And this is it. This is a long-term play. It's my money. It's my family's money. It was our CPC that we created. That's why I could buy the data center company with no raise. And you're going to see the capital pool company. Sorry, you're going to see our cap table which is very tight and very impressive because we didn't need to go raise external money right out of the gate from, what I like to call the IR scammer type people that are always around trying to invest in your company when it's cheap. Our CTO is John Arnett. He owned the data center at 200 Burrard in Vancouver that we bought. Serial tech entrepreneur, once an Entrepreneur of the Year award. He's forgotten more about data centers than I'll probably ever know. He was a perfect guy when I said to him, okay, let's merge these companies, but we want to go buy a whole bunch and build, a company in the many hundreds of millions to $1 billion market cap. Do you want to do it with me? And he said, absolutely. So John, we're partners in this business. He's my CTO, incredible guy at the helm. So we have the tech side covered. We have the business side covered. And then we have two guys on our board that have a ton of public company experience. Mitch Demeter, he runs a company currently that's public called SPETS, SPTZ. He worked for me at Big Digital Assets. He was eventually on our board and sits on multiple public company boards. And then there's Peter Smirniadis, who runs Victory Square Technologies, an incubator in Vancouver for early stage tech companies. These guys have great networks and are a very valuable asset to us. And then I have probably the best capital markets advisor in the market, a guy named Dan Barnholm. He worked for multiple different investment banks. He's literally raised over $1 billion for his clients over the course of his career as a banker, banking everything from mining companies to tech companies. About a year ago, he finally decided he was going to go become a CEO himself of a public company. It's called Luca Mining. He's taken it from 25 cents to $1.50, $1.60 Canadian in less than a year. And he's there step in step with us helping build this business. So we got a tremendous advisor on the board. And as I said, this is the best cap table you're going to see today. It might be the best cap table you see this month. We only have 13.3 million shares outstanding. 32% are owned by insiders. Myself and John own over 2 million shares each. We're in this for the long term to build a very significant business. 4.3 million shares are escrowed, both from the CPC and from 200 Burrard, the first data center. Most of them are owned by John and I anyway, so we wouldn't sell them even if we could, plus they're locked up by the exchange. So there's less than 7 million shares free trading. Tightly held vehicle. It's growing very steadily. You look back at the chart, and in fact, I have a new chart. Here it is, new slide just for today's presentation. We went public again at about 15 cents. Very purposely, I said, let's go out with a conservative market cap. We're not going to overvalue everything. We're going to build a really nice top line, cash flowing, profitable business by acquiring data centers at good prices and frankly, having them re-rated at public company prices, gone from 15 cents to about 85, 86 cents Canadian, which is again about 62 cents US. But the beauty of it all is with 13.3 million shares, it's still only $11 million market cap Canadian. Absolutely phenomenal time to invest. This is our very first conference, first presentation in the US. We got our QB listing just a few weeks ago. So you are here at a perfect time to invest in this business right as we start marketing our data center company, data center roll up into the US market. I have great connections in the US from my other companies throughout my career. We're going to do a lot of conferences. We're going to do a lot of broker meetings, non-deal road shows, family offices, you name it, get the message out. And that's going to provide a significant catalyst to the movement of the stock up to a valuation that's going to be much more reasonable versus where we just got going. Obviously, we're going to be adding data centers number 3 and 4 now that we have 2 under our belt with Perth. Top line revenue in the next 6 to 12 months will 10x with the acquisitions of the data centers in our pipeline. We're going to continue to fill up our data centers, the new one in Perth that has lots of space, and adding AI type companies in 200 Burrard, which really increases the revenue per square foot and per footprint that we have. And then investor outreach, as I talked about, getting out and telling the carrier stories. I just mentioned we're going to do a lot in the US. We're just getting Canadian marketing going as well. And that's the business. I'm obviously excited and fired up about where we're going. The capital structure is good. The business is requiring good. We have the right people and the right management team, the right board, the right advisors. We're in a hot space. Whether I'm in it or not, data center growth is going to continue very significantly over the next 10 years. And there is a phenomenal opportunity to help these entrepreneurs or companies that own data centers that want liquidity for us to take them, put in a portfolio, run it for cash flow and keep growing it, or we sell it to Cologix or eStructures or Equinix, one of these large public companies. They will buy a portfolio of data centers happily from us because that's one transaction. What they don't want to do is go around and buy up a whole bunch of smaller and medium data centers and do all that work. We're doing the work. That's why we'll get paid for it, because we can sell them a whole portfolio for, again, a very, very significant premium over our acquisition cost. And that's it for the presentation. Market Carrier Connect DS is in datasolutions.com. Honestly, email me. I'll send you the presentation. I'll answer questions. We're welcoming new stakeholders, new shareholders, new investors right now as we go. And again, the ticker in the US, CCDSF. Thank you very much. I imagine we have some questions.
I have a question. They can't see us, I don't think.
Oh.
No, I can't see you, but I can hear you a little bit. Go ahead.
Oh, okay. Who do you consider your main competitors?
Yeah, that's a great question. So in the roll-up play, we don't have one that I'm aware of. I mean, the other data center companies, most of them are, many billion-dollar companies that have a portfolio of data centers, like a Cologix or an eStructures, and they're building very large facilities. So they're not trying to buy the companies that I'm trying to buy, so they're not competing at that level. We're the only public roll-up play or private roll-up play that I'm aware of. I think there'll be more as we prove this model and show how valuable it is. So we're early movers, just like, when I got into crypto in 2017, we were very, very, very early movers. And, as I say, if you're going to be on the bleeding edge, you have challenges, but you usually get, rewarded for it financially. In terms of the data centers themselves, it's really companies like Cologix, eStructures, Equinix. So if I buy one data center in Ottawa, the other company in town, for example, that's selling data center services is probably a Cologix. Now, it's not concerning to me from a competitive point of view because I'm buying an already existing operating business that's cash flow positive and has its own customer base. And remember, the stickiness of customers in data centers is very significant. No one pulls all their gear out of one data center to move across the street to another one, even if the price was a bit better, which it's not. The bigger companies charge more because they don't want the risk of downtime and being offline. So there is obviously competitors in the space, but there is none yet in the roll-up play that we're running.
Thank you.
I have a question.
Yeah.
You mentioned that a lot of the companies that are taking space in your data centers are AI companies. A lot of the titans right now, like Facebook, are lowering their investments in AI and whatnot. And some people are saying there might be a bubble. And you didn't really mention what other types of companies there are. Is the population diverse enough to survive if that were to be a bubble and it bursted?
Yeah, great question. Absolutely. So in our data centers, AI type of companies are probably only currently 2 or 3% of revenue. Most are traditional compute companies. We're in British Columbia. We have, like mid-sized construction companies, small software companies. We have lots of managed service companies in our data centers, which are, 5-person companies that are small IT teams that manage IT for a wide range of tech customers and small businesses. And they'll come in and, buy 5 racks worth of space. And as their customer base and as their business grows, they actually have to then put more servers in our data centers to service their customers. So some of our customers are, essentially middlemen that also act as sales agents because when their business grows, so does ours. But AI is quite new, as you know. It is driving growth. We are taking in some AI customers, but today, primarily the mix is, traditional compute, traditional Dell Blade servers and things, and not new AI servers. So, we're in a great spot. We're not investing or building a $100 million facility to serve Facebook or Facebook, serve their customers in the AI space and then find out the bubble bursts. That won't affect us at all.
Thank you.
No problem.
I consider myself sort of a socially conscious investor. I notice your team is all white men. Would you say that your company that we're just not seeing has more diversity in terms of gender and race?
Yeah, actually, our CFO is a female, and she is a foreign person as well. So we do have a diversity. Now, we are only really a 4-person company at this point, but our head of finance and CFO is Zula, and she is female. So I'm a believer in diversity as well. So we're really the 3 main people that run the company. We're 1/3 female, and 2 of us are Canadian, and 1 of us is not.
Thank you.
No problem.
Do you see any impact of cloud storage?
Can you say that again a little louder? Sorry.
Is there any impact you see with cloud storage versus data center?
Yeah. So it's an awesome question, actually. The cloud is a collection of servers that live in the data center. So Amazon sells you cloud services and cloud storage, or maybe Apple sells you cloud storage for your iPhone backup. I mean, a lot of people do stuff like that. Software companies all over the world use Amazon to run in the cloud. And what that means is they're renting space on Amazon servers instead of buying their own servers and putting their own servers in a data center. You know where Amazon servers sit? They all sit in a data center. So when the cloud grows, so does the data center industry. We don't have Amazon in our current data centers, but there's a data center right across the street from us in Vancouver that's full of Amazon servers. And as we buy bigger and bigger data centers as we grow, Amazon will be in our data centers. They're in data centers all over the world. That's where their hardware sits. They have to rent it from other people and rent the space, and then they sell the cloud server space to customers out all around the world in the internet. So anytime someone is using the cloud, they're using a server that somewhere sits in the data center, whether it's Amazon's cloud or Microsoft's cloud or Apple's cloud or Facebook's cloud. So that, you know, in another part that's really driving some revenue as well is the idea of sovereign cloud, they call it, meaning you want to know where your data is. So Americans like to know that their data is in the US, Canadians like to know their data is in Canada, Australians like to know that their data is in Australia. And that is causing people to take business away from Amazon and out of the cloud and buying their own servers and putting it in data centers, because then they know exactly physically where their data is, which is also helping drive particularly our data center growth, because again, we aren't servicing Amazon with our current businesses. So it's impacting the industry in a positive way for us.
Thank you.
Great question, though.
Quick question, just talking on data centers, what's your, do you guys have a company approach from like the environment perspective when it comes to data centers? Like if you guys are approaching it in a unique way, like for green energy, different things?
Yeah, I mean, so we just bought this data center in Australia, in Perth, and we're actually investigating how to set up a solar farm, because Perth, I mean, it's essentially beside a desert, and there's tons and tons of solar heat and energy. And we would love to power our data centers using solar power and getting off the grid, off the traditional hydro grid as much as possible. So that's something as we grow, we want to do. And as we raise capital, we want to invest in, which gives us, you know, it's good for business and it's good for business. And what I mean by that is it's lets us be green, right? And that is positive from an investment point of view, but it also lets us lower our cost of electricity, which does a couple different things. One, it either lets us increase profit, which is, you know, we're a public company, a for-profit business. So if we don't change the price we charge our customers for space and power, we have more profit if we can produce electricity cheaper, or we can pass it on to our customers, or some portion of it onto our customers for savings, which makes our data centers more attractive. The vast majority of data centers are on the public grid, you know, government provided or government utility grids. So you can't really compete on power prices for the most part. But if we do build, you know, particularly solar farms, we will be able to get off that grid. And it works best if you're in data centers at the edges of a city where there's a lot of space. And that's what we have in Perth, and that's what we'd like to do with more data centers in the future. So something we'd really like to get into.
Awesome, thank you.
I got one more.
Sure.
You said, quote, this is something you'd like to sink your teeth into for the next 3 to 5 years. What happens after that?
Well, that is one of two things happens after that. I mean, by then, this company, by no stretch, should easily be in the multiple hundreds of millions of dollars of market cap, right? If we execute on a plan with 10x multiple over revenue, that's going to happen quickly. So when we hit that point, either we'll be able to sell the business, the whole portfolio, the whole company to Cologix and eStructures and Equinix. I mean, these are big companies. Cologix is a $7 billion private equity owned company out of Denver. The head of sales for Canada lives like 3 blocks from me in Canada. So we have a good relationship. I've even toured their data centers. They would buy us because they're growing, they're expanding as fast as possible, but they won't go buy one-offs. They will buy a portfolio. So we could sell to those guys, one of the larger players in the space. Or we can say, hey, listen, we have a great public company, great growth, great stock price. Let's keep on this model or start building our own data centers. But at some point, it'll be a time for me to say, hey, I accomplished what I wanted to accomplish, and it's time to move on. Excuse me. So we'll see, right? I'll decide it's time for me to pass this on to a CEO who is good at the next stage of growth, which might be, $1 to $10 billion worth of revenue. I'm really good at the 0 to $100 million plus market cap, but there is people that might be the right guys to take us, or women to take us from, again, $1 billion to $10 billion of market cap at a whole different global level. That's could be the time for that. And I know when it's time to put the different leadership in place. So we'll see when we get there, but I think that'll take, give or take 3 to 5 years, and that's the plan for me.
Thank you.
Time for one more question. Uh-oh, I may have to come up with it. This may have been asked. I just kind of rejoined here, Mark, but in terms of your closest comps, like when we try to put a valuation on your company, who are we putting into your comp group?
Yeah, so it's an empty comp group because there's nobody else doing roll up right now that I'm aware of in North America of this kind of play. I think it's unique. I think it's an amazing business thesis and investment model. The main competitors in the space that are public are dramatically bigger. I mean, the large NASDAQ data center company is Equinix, and they are somewhere around 8 billion in revenue and 80 billion market cap. So what you see is every time you look up a data center company that's public, it's 10x of their revenue as their market cap. And with just what we showed you today, that's in our very imminent pipeline, there's more than $5 million a year worth of revenue, which is a $50 million market cap valuation, which is 5x where we sit right now in terms of market cap. So as we get bigger, we'll be able to find more comps, but that'll take a little bit of time. And I'm actually really like the greenfield space we're in right now, and there's nobody else. I'm not competing to buy these assets, which lets me get them for good prices. And yeah, it allows us to be in that, hyper growth mode from a market cap and revenue point of view.
That's terrific. Any final comments, Mark?
I want to thank Singular Research for having me here today. I did lots of Singular Research conferences with my old company. We usually saw tremendous buying and investment on the backside of these conferences, is why I'm back with Carrier. This is the first US conference we've done. So I expect to see a really positive outcome, and I hope the people in the room and the people watching online to pick up some Carrier Connect, CCDSF, put in their portfolio, and be part of the exciting ride we're on.
We'll have to have you talk to one of our analysts very soon as well.
Yes, and I've done research with Singular as well, and I look forward to that.
Terrific. Well, thank you, Mark. Hand for Mark Benz. Thank you very much.
Thanks, guys. Appreciate
Okay.
it. Have a great day.
Thank you. We're gonna take a 2 minute break while we get reconfigured here, where we go from virtual to reality right here. So come on up with the hard drive, thumb drive. Okay. Don't let me touch it. That's a big mistake.
So the camera's working it in, so we'll just get the camera off and then use this. Hey,
Well, we've got 9 more to
Don't
go.
worry, just do this.
Next company,
What about that?
we're very excited about. We've been covering them for a little while. Sally.
Yeah, Wash.
You just joined.
April, 6 months, 5 months.
Who's the other? That's the
You
other.
minimize it if you like.
PES.
Minimize.
Yes.
Just remember where it is. He has all his stuff over here, so we're gonna go.
Okay, our next company, while we're getting ready here. That should be. Need my glasses.
This
Getting all this drag.
That is?
Orion.
Yes, yes.
Copy.
Okay.
Heavily.
Is it a PDF? Yes,
Um,
PDF is fine. PDF is fine.
Orion Energy, ticker symbol OESX. We currently trading around, is it 65, 67?
So go back. Go to,
Uh,
I don't know if it's this one, or is it this one? Okay. Make it
$8.
Oh, you reverse split,
Make
okay.
it,
Yes.
What was the ratio?
Share.
Camera not on.
Okay,
We're gonna get.
so, we have an $18 target and the stock price is roughly 8. Is that right? That's a little bit of room for growth.
No.
So a little bit about Orion. They're a leading manufacturer, seller, and servicer of LED lighting systems in the U.S., which is green energy,
Okay, copy.
lower cost energy, and more environmentally suitable energy. Also, they've recently made a very exciting acquisition in the complementary EV charging station solutions and electrical maintenance solution space. Those EVs charge, as EVs take out more of the marketplace. And those are in the same establishment you have your lighting with, or are they different?
Our primary facility is in
Try
Manitowoc,
to lie.
Wisconsin. And then we have also an engineering and construction management group in Jacksonville, Florida.
Okay,
The EV group is just outside of Boston.
Which one?
that's out of Boston.
It'll
Okay.
be on the desktop.
So there you have it. We're getting close
I just
to
wanted to
going
show you
live
that.
here.
That it?
Hopefully really close.
I don't know, the camera's not.
So this honestly, these guys are brilliant. I'm not any good at all with this technology. I'm gonna blame this on the provider. Like I said earlier, they just get this upgrade.
Wait, turn it off. Turn it off.
We're all
We lost the
misaligned,
camera.
so that's great.
So go back to her file and start sharing.
So,
The EV group is Voltrek. The EV group is Orion Voltrek.
What do you wanna do?
Company they purchased.
Your share
Yeah.
is already the presentation.
This one?
oh, okay.
So we're good.
You should be good.
How many in here have an EV? Wait, let me start with here. You don't even need a car.
Oh, let me advance.
Where's your,
I forgot where it was.
you're sharing your screen? Yeah, that's the same thing.
Like Johnny, you know.
It's in there.
Stuff.
Get for breakfast.
That's- yeah, you know.
Nobody sharing
You're up,
your
I
screen.
had to get ready for this. Right,
I'm trying to do this.
so, how'd you like that last?
Just not responding.
It's not responding.
Fine, Christine, everybody else?
No, I'm not doing that.
Yeah. Mark's a serial entrepreneur.
Where's the, where is this one?
He takes some big
Just click on
swings.
that. Now click on that.
Sometimes you
And
can.
now try to arrow
Now you could. Yeah,
it. Yeah, but they're showing this.
so we don't need to live
Yeah,
then?
So,
I don't know if they're seeing this.
You can't.
No, okay,
You're not.
all right, go back.
Maybe. Let's minimize. One more. Better.
It's like,
all right.
They are seeing it.
no, look.
Hurdling towards our presentation.
Vaya toda vez, citar live.
Let's see.
They're seeing it.
Is the webcast the issue or? Let's see.
No, the webcast is not the issue.
Oh, before these guys run away, is it arrows?
Forward and backwards. Forward.
I see the
Okay.
presentation.
Okay, thanks.
Are you getting ready?
Yeah, I'm not that tall. Yeah.
Okay.
I
So
think,
we
is everything
have
working?
the CFO, Per. All right, Per. And we have the CEO, Sally. And we're going live right now, so it's all yourself.
Okay. Hi, everyone. I am Sally Washlow, the CEO of Orion Energy Systems. As noted, Per Brodin is with me today as well, so thank you for joining. I will start with our safe harbor, but then our organizational mission is we help our customers achieve their sustainability, energy savings, carbon footprint reduction goals through innovative technology and exceptional service. So I will walk you through some of our business segments and how we deliver this to our customers. At a glance, Orion delivers optimally efficient LED lighting systems. We also do commercial and industrial EV charging infrastructure solutions and lighting and electrical maintenance managed services. Some highlights, we are an attractive investment opportunity. Recent share price was $7.40. I think we're slightly above that today with a market cap of just over 25 million. I'll highlight a couple of our investment merits. We do have a diversified revenue stream in our various segments, EV, lighting, and maintenance, which I'll share a little bit more about. Within that, there are reoccurring revenue capabilities, and we also recently optimized our cost structure, which will unlock our operating leverage. I'll also share this morning a bit about our strong and long-term customer base, and also how we have a proprietary supply chain with manufacturing flexibility. Our ownership also is about a little over 10% insider with directors and officers. Our three big business segments, lighting, maintenance, and technical services, and EV charging systems. Within the lighting segment, here's where we design, we manufacture, and install energy efficient LED lighting systems. So we can work with a customer at the beginning of their journey to determine their lighting needs. Our engineering team will then help spec out what those needs are based on energy efficiency and ROI that they want to maintain. And then we have the ability to build it in our facility. We're based in Manitowoc, Wisconsin. We have a manufacturing facility there. And then we have a design and maintenance team in Florida, and then our EV segment in Boston. So through this, we work with interior and exterior applications. We can also combine IoT controls for our customers in the lighting segment and multiple go-to-market opportunities. We can provide full turnkey service to our customers, or we might partner with a local or regional partner as well, but all within that realm, spec'd in our lighting products. Then when I move on to our maintenance and technical services, here is where we are delivering reoccurring services across both the lighting and EV segment. These service contracts are often 3 years or more, which provides an opportunity for reoccurring revenue. And we do preventative and reactive maintenance within the lighting and EV segments. And our EV charging system segment, that is where we're providing end-to-end EV commercial charging solutions. So big question we're often asked is, do we do home? We don't. We are focused on the site design installation and commissioning of commercial opportunities. And again, in this segment, much like the lighting segment, we're providing full turnkey installation. We partner with leading equipment suppliers such as ABB and ChargePoint to bring their solutions to market. And we also have national execution capabilities on this front as well. And then rounding out the service with networking and maintenance, delivering reoccurring revenue in this segment as well. So we believe we have nimble technology and an unrivaled ROI for our customers, and how we're bringing some of these value adds and our competitive advantage is shown here. I'll highlight a few. We do deliver industry-leading technology and design in lighting, and this is through working with our engineering and the team that delivers the product to build the highest energy efficiency and smart design to provide our customers with the best ROI. Our unique turnkey capability, many of our competitors in this segment, they'll do one or the other. We have the capability to provide a complete solution and execute from project conception to completion, either through our own team or as well working with partners. I touched a little bit on our design and manufacturing flexibility, and that is because we have built a flexible and cost-efficient supply chain. So we can build it here in the US with our US-based manufacturing, which is really important for lead time, time to market, and also if the job is required to have BAA or BABA compliant, we can build it here. But if need be, we can also build it through our global supply chain with partners in Asia and Mexico. Accelerated product development, because we are doing the design, it can take us 4 to 6 months versus 12 months, and that enables us early market leadership in this realm. We have a broad sales reach. We go to market through a network of national accounts that have been longtime customers. We have an agent network, and then we also work with ESCOs and resellers in the market as well. We really want to meet the customer where they are and that intersection of where they need us. And we have a blue chip customer base with repeat business, which provides us access to retrofit their facilities, as well as IoT opportunities with connected devices within their facilities. So a little bit more about our lighting, our custom manufacturing. Here is a picture of our manufacturing facility in Manitowoc, Wisconsin. That's about an hour north of Milwaukee. And within here, we have a proprietary manufacturing approach located here, and then with our global partner network. We also maintain significant component raw materials. Oftentimes, a project will need to be turned around quickly, and we have the ability to do that. And our custom manufacturing is done here as well within our Manitowoc facility, which enables us to be compliant with BAA and BABA. In maintenance and managed services, much of this is managed out of our operations in Jacksonville, Florida, where we have the opportunity for reoccurring maintenance revenue. Again, we're doing preventative and reactive maintenance, so we are often in our customers' facilities on a monthly, quarterly basis, supporting them on their maintenance needs. And we're going to market here with a nationwide network of skilled and certified lighting and electrical professionals. We also have a dedicated 24-hour response team. So again, the reactive maintenance, we can fulfill our customers' needs immediately. Their downtime prevents them from sometimes opening their doors. So we're there to support them. In EV charging, this was a division. We go to market in EV charging under the Voltrek brand. It was a division we acquired about 3 years ago from an industry pioneer. So with their expertise, we now have over 15 years of EV expertise and experience. We are one of the premier resellers of EV charging stations. You can see on here our partners, ABB, InCharge, and ChargePoint, and we are a full turnkey service provider partnering with these companies. They're often providing us leads and then often recommending us because of our 15 years of exceptional service and experience in the market to install these systems. We have over 7,300 charge points under maintenance and management. With that, we get reoccurring revenue from many of those charging points. And we are a partner for the utilities with their Make Ready programs partner, and we have national coverage. Here is one of our installation sites in Watertown, New York. I've mentioned a bit during today's discussion about our turnkey capabilities. This is really to show that we are at the beginning, starting with a customer. It could be a factory audit, then we're working on the design, bringing it to our manufacturing facility or one of our partners, installing. We're working then on the back end to ensure that our customers are getting the rebates that they're deemed warranted for the projects that we've partnered on. We have warranty on all of our products as well, and then with maintenance. So we do deliver a full solution for our customers, and that enables us to be a preferred U.S. provider to many Fortune 100 and global leaders with our capabilities. Here are some of the client examples, many blue chip customers on here, ranging from automotive, food and beverage, retail is another big channel for us, logistics providers, as well as government programs we have worked upon as well. And within the EV charging, a big partner for us there is the Massachusetts Department of Transportation. We've helped them build out many of their EV charging capabilities throughout the state. A couple of case studies to share with you. This is some work that we've done within the automotive realm. A company, Clarios, they're based in one of their facilities in Florence, Kentucky. They had over 100,000 square feet that not only did we save them energy, but made it a brighter place to work as well. We went in and retrofitted all of their fluorescent troffers with linear high bay LED fixtures as well, saving them energy and also reducing their carbon footprint as well. And within EV charging, again, a lot of our business is focused on fleets. Here is an example of where we supported a high school with their EV transit vans and helping them support their fleet of vans transporting students with special needs. Another recent example is the work that we do with the Boston Public School System. We've had several reoccurring contracts with them as they electrify their full bus fleet throughout Boston Public Schools. So an example of the work that we do is here. In summary, how we achieve our mission is that we are one source for LED and EV charging projects. We enable our customers substantial reduction in energy costs for LED projects. Often a payback is between 1 and 4 years. We have advanced product design. We have the highest lumen per watt performance in the industry through the design work that our engineering team provides. Our flexible supply chain and manufacturing footprint enables US-based, and also through our global partner network, we're able to be flexible. We are continuing to expand our product portfolio with interior and exterior products, and also a price point that we've recently hit with our Triton Pro contractor line has opened up some new market opportunities for us as well. Our multiple go-to-market models, including our turnkey management to match our customers' needs. And we are also expanding our lighting maintenance service. What we have also found in lighting maintenance is while we're there, they might have other electrical needs based on the skills and talents of our network, often we are finding that deeper engagements with those customers as we're helping them with some of their other electrical infrastructure needs. Our senior management team, myself, I was a member of the board since 2022 and was recently appointed in April of this past year as the CEO. Per Brodin, who's with me today in the back of the room, he's been with the company since 2020 as the CFO. And then Scott Green is our COO. He joined in 2013 with the acquisition of Harris Lighting. That's the main group that we have down in Florida working on our managed services. Here are a few charts, and I'll highlight last year we did our fiscal year ends in March. Last year we did about 80 million in revenue, and we've been really working on gross margin improvements, as you can see to the right, with Q1 of 26 hitting 30% gross margin. So with that, I'll conclude, and if you have any questions, I'm happy to take them.
First, thank you. That was a great presentation.
Thank you.
My question is twofold, and it has to do with government policy. One is there any impact to the tariffs when you're sourcing in goods? And then the second one is impact on any environmental policies or EVs or anything like that.
Yeah. So I'll take the first tariff issue. We refer to it as the bouncing ball within our management team. And so there are impacts, but we are navigating them through whether we're moving our production because of our global network. They do have the capability to build our product in several different countries in Asia and then Mexico as well. And then our capability to build here in the US. So we literally have a spreadsheet that calculates based upon what news is coming of the day. And so we continue to navigate that issue. On some of the environmental regulations, there was obviously a lot of noise, especially surrounding EV at the beginning of this year. And projections are changing in terms of EV sales specifically within North America. Globally, it's a different story, but I'll focus on North America. We still see a tremendous upside with EV charging installation where we focus on, just because of the current market that's out there of vehicles on the road. And the market is still increasing, maybe just not at the rates that were formerly projected. So there's still a lot of network that has to be built. And it makes good economic sense, especially for fleets, to enable and electrify their fleets. And that's an area that we focus on as well. So we're pretty conservative in our guidance, though, even through all of that as it shakes out. But between LED lighting and the work we do in EV charging, it makes for good ROI as well. So there's the environmental play, but it's good ROI.
Thank you.
Maybe one point back to the tariff question is, not only do we proactively work to mitigate, I'll say, the gross effect, we also believe that we've mitigated the net effect such that we think that, on the bottom line will have very little effect as things sit today.
Thank you.
Hi. So you said that you're the premier reseller of EV chargers. Is it common to get them secondhand? And if so, why are people selling them in the first place if they already have them?
So there are distributors that sell them as well. But we were one of the original partners with companies like the likes of ChargePoint as a value-added reseller. So we're not a pure play distributor of products. We actually install and maintain them as well.
And to clarify, they're not used. It's just a term of art that we're a reseller.
Yeah.
Because ChargePoint doesn't sell direct.
Okay.
I got it. Pardon? So Orion is 30 years old as a company. We recently acquired the EV charging division 3 years ago, but prior to that, they had 15 years of experience. Our market is mainly North America and specifically the US and Canada. We've had a couple global projects, but they were with US partners, specifically the Department of Defense with a project in Germany. So we continue to grow and diversify our revenue streams. And some of that is through our maintenance work and EV charging, buying that division. But you know, we're certainly looking to even grow in adjacent lighting areas. International growth outside of North America is not really on our radar right now.
What are the company's targets and your growth plan?
So we have guided pretty conservatively this year. Last year we finished at 80, and we're looking to do about 84 million this year, our targets for this year. And our fiscal year ends in March.
And how are you going to get there?
Through the segments that we're currently servicing, maintenance has been a strong business for us. And so there's some growth in there. And the lighting business, we're taking a pretty conservative approach on EV for this year.
Most of the project is understand infrastructure, right? So how much are you dependent on the government, and what's the share of the private clients?
Yeah, a lot of our work is with industry and not with government. And so in terms of, we do have some government contracts, but they have not been affected by some of the pullback in government funding. So I would say 60-70%. Per might have a better estimate on our non-government contracts as well. But many of it's to electrify fleets in the EV segment. They already own the vehicles. They need a way to charge them as well. And then in lighting, it's mainly with private companies within that infrastructure, and there's a clear ROI for them.
And problem is that, are you publicly traded?
Yes, we are. We're on the NASDAQ as OESX.
$7 to $8 range.
Yeah.
I have a question here, Sally. The LED lighting business.
Mm-hmm.
You know, it kind of feels in one way it's been here and everybody has it, but then again, is that true? In other words, what is the penetration level of LED and competing lighting systems that are more energy efficient?
There's still a lot of room for growth. There's many facilities that still have fluorescent lighting. We also have on our website a map of the states that are banning fluorescent and you need to move to LED. And to your point, LED lighting has been around for a while, but even some of our earlier projects that we did in LED, customers are coming back to us and saying we need to LED our facilities as well. So we see growth in both areas.
Oh, and what do you feel would be a key, I guess, Kickstarter catalyst for your underlying business to kind of break out to the next level?
Yeah, our business can be lumpy. I'll say that based upon the project work. So as we rebuild some of our other sales channels and LED lighting, we're doing that. And I think that will help smooth out some of the, call it lumpy project work. And then continuing to diversify our revenue streams.
Right. Are there any more home runs out there like Home Depot?
We're always looking for home runs.
Yeah.
and partners.
Any more questions for Sally or Per?
Have y'all been through a reverse split in your company's stock?
Yeah, recently, through the last month. So we're back in compliance with NASDAQ and on solid footing to move forward.
What necessitated that?
We were trading under $1, and to maintain compliance, we did a reverse split.
They got this funny thing with penny stocks. I don't quite get it. I mean, but, it's like crypto, they have this funny thing with it. But anyhow,
Yeah.
Institutions can buy stocks now that buy your stock now, for example, whereas when it's a penny stock, yeah, they've got these rules, so they can't do it. So this simply increases your market.
Yeah.
I agree. Well, any closing comments?
Thank you all for joining today, and thank you for having us.
Thank you.
Management will be here for about 15 minutes if anybody wants further discussion. And then they're leaving.
Okay. We have another presentation.
Do we have a biology break before the next
Yes. Go.
person comes up?
We're gonna do some tech finagling around, so take a run. 5, maybe 10, it depends how well it goes. It could be longer. Yeah. Help. Okay.
Directions on how to do it, so he's set up now to do it to first go, but you might want to connect with him.
He's set up now?
He's set up now.
Okay.
He should be in the system now. And
Okay.
you can walk him through it. I can give you anything you need. I give you my phone. You can dial him direct.
Yeah.
He's on WhatsApp.
Yeah.
On his computer. Just on his computer. He set up on his computer.
Okay. I'm gonna give my assistant to our assistant.
Are you setting up the next one? Okay, so I have this phone number where you have in case you want to call him.
Hello, how are you?
I'm just helping set up the next.
No worries. Are you next?
Dan O'Brien is talking.
Awesome, yeah.
He's coming in by phone.
Virtual. Is he in Panama or?
No, he's in British Columbia out in the ocean on his boat.
Wow.
Yeah, yeah.
Oh,
So, but he has satellite contact, so he's good. Yeah.
That's the
Is it 10:30?
7, yes. Do it again. I had the same problem.
I have is it the PowerPoint you're looking for? What are you looking for?
Oh, no, he's trying something else.
Oh, okay.
No
Perfect. Thanks.
Your start time is 10:30?
Yes.
Okay.
For some reason, we lost the camera on this.
Oh.
It's not recognizing the camera. It never did recognize this guy to begin with, but now it lost the integrated camera as well. It won't come up. So Bruce is trying to figure a workaround without leaving the session.
Mhm.
Although we did it once before, I don't want to close the session
Right.
because it's recording. I'd rather let it run.
Right.
Yes, sir.
Yeah.
So yeah,
We're gonna post-production, we're gonna put some lipstick on it.
Yeah.
Edit it quite a bit. Sure. And then we're gonna post it on our website where
Whatever you want. Come on again.
you can get a whole nother life. More visibility.
No, not
How are you guys, is Dan doing the one-on-ones?
Yeah. No, I'm going to do the one.
Okay, because I gave him the dime. Did you see him?
I did.
Did you get the one-on-one list?
Yes, I did. I have the one-on-one list.
And
I have the phone number and the dial.
you're doing this.
I'm doing
Dan's just doing this.
That's right. I can do the one-on-ones from anywhere.
His phone, I wasn't sure who exactly was going to do what.
Yeah.
I knew you were here,
Now, sending, now this is the one-on-ones now is a bit of a problem. Did everybody who's doing a one-on-one with me, have they got a PowerPoint?
Not necessarily, no.
So, because they've given me a dial-in number to do the PowerPoint.
What's that?
Because this is the whole thing, how it's set up. This isn't what I understood what we're coming to. I was understanding it was one-on-one.
So I see 605, I don't see
That's what
603.
makes it,
It's both. You've got 7 one-on-ones throughout the day. Some here, some virtual.
oh, some are virtual,
Yeah.
but some one-on-ones here for sure, like, who are investment companies or what?
Institutions.
Institutions, yeah.
I'd have to look at your calendar, see your schedule, but it looks like it's pretty good interest. We have more of a retail audience here.
But we saw it change.
I was given what Michael was saying, all of my calls were virtual.
Yeah.
I believe. I was dialing, I send them the PowerPoint, by email or with
They're all gonna get the research report.
they're all gonna get the research.
Oh, yeah.
Are they gonna get, but are they gonna get the
We
PowerPoint?
just launched coverage.
Yeah, I heard you just lost contact. Yeah.
4 days ago.
Sure.
So that goes out pretty broadly. Probably to 2,000 investors.
Right.
Thanks, I may call you.
And these one-on-ones, you may have seen that report already.
Yeah.
May know your name.
Sure.
Already.
I wish he had sent me what he was sending out in advance or sent it in advance to make sure we look at it for any mistakes. Yeah, we did go over it, but the research generally.
Yeah, that's a little bit of a touchy area.
I know, just to read it in case of mistakes, for mistakes.
We did a couple drafts.
Yeah.
I think we did.
Hold on, trying to get my.
Okay, not yet. We still have time. So it's that's not.
Yeah.
No way to change this or anything.
Hello? Oh, damn. Hold on. Okay, sorry about that. Yeah, shut it. Oh, my goodness. Okay, thank you.
There was an initial draft, but it was a secondary.
I needed the mic. Listen, we got the integrated, let's just work with it. Okay. So we got, so we got.
Boom, boom. So we have to share. So now, if we can get.
No, I'm not sure. Who are we waiting for?
Dan? Do we see a Dan
Dan
on
Marsh?
the list? Hold on. No, David Marsh is our analyst.
Oh, sorry.
He's a familiar name. We're looking for Dan O'Brien, correct?
He tried to get on the computer. Should get on the computer. Okay. Dan at Flexible Solutions.
If he's
Not
logged on to the meeting, we should see him. That's all. We're just
He's
looking.
logged on. He just got logged on
Did,
again.
did
but
you,
it
when,
should-
when he came in at 6:05, right? This guy right here, did you allow him on your email or no? Did you approve him on your email?
Yeah.
You did do that?
Yeah.
Okay.
You have to do the same thing.
That's the overflow room. Do I have to do it again?
I don't know.
Is there a 6:03 that came in? Because we're trying to get this so it could be organizer, so it could be a little bit.
Let's see if he has it, because I don't see him here on the list.
Dan O'Brien.
Yeah, I don't
Yeah.
see a Dan O'Brien. Is everybody's here?
He's on the, maybe. he did get
Can we
put
call
on
him?
there. Yeah.
Oh, absolutely, yeah, we'll give him a call. See if he has our
Is
credentials.
he 03, 04?
He may be able to hear us too.
Yes.
Yes,
Yeah.
if he's locked on.
Okay. Okay, someone's coming in here.
Oh, someone's coming in now? It might be Dan.
No, James, somebody.
Dan's not answering his phone right now. If you can email him right now, he can respond.
Do we have an email
Yeah,
for?
Dan at flexiblesolutions.com.
Oh, we don't have any.
You don't have email?
Not to do it from here.
Oh, okay.
You can do it from her phone?
He can do it from his phone possibly. My phone, I do it purposely, not put email on my phone.
Do you let me in?
Um,
You let me in.
okay, hold on. I'm not seeing you here though, but so just go ahead.
No. Let me get the beer.
You want to do it?
Yeah, let's do it. Just let me get the.
He's not using it anyway.
PowerPoint up on this.
So we have your PowerPoint, is that right? We have Dan's PowerPoint?
Oh, I've got a thumb drive if you want that.
Yeah,
Same-
yeah.
They have it. You guys do have it.
I'm still not hearing you, Dan, through the our system here. Do you have your microphone enabled?
No, your system muted it. Now it's still muted. So you've done that at your end.
All right. So I'm going to ask you to unmute there, and you should get a message, and you could just unmute it.
Does it show?
Nothing happens when I hit the unmute.
Nothing happens when you hit the unmute. It's great.
Sometimes it's
All right.
So, yeah. Sometimes it's yeah.
603.
Okay, so this is the thumb drive we have. Is this us? Right? FSI?
Yeah.
Okay. Let's go to our desktop.
Okay, as I'm unmuted now.
There you go.
Yeah, just took a minute.
Yes, Dan, thank you so much. Can you hear us?
Yes.
Perfect. So I'm going to pull up your presentation in just a second.
So you gotta go through. Yeah, yeah, I got it. FSI. Which is it? This one?
Yeah. Okay, good.
Yeah, go back to.
Let me go to the room over there.
Okay, we're getting ready to queue this up. While waiting, I'm going to introduce the company and say a little bit about it. This is a new company to our research. We just recently picked up coverage. The name of the company is Flexible Solutions International, ticker symbol FSI.
Yeah.
Stock price roughly nine-ish. We have a 12-month price target of 12.
Yeah.
So that points to 20% plus upside. The company, very interesting company, a lot going on. They make biodegradable polymers that are environmentally friendly chemicals. And they're used to control water evaporation, even in swimming pools, to make the water stay warmer longer and cleaner longer. A lot of swimming pools out there. Also, it has other very strategic, broader-based uses in other industries. Importantly, the company is also going through a metamorphosis in their strategic process, where they're dealing with the tariffs in a very creative way. They're developing their new products, the aforementioned, in Illinois. And they've always had operations in South America, Central America, and they're going to maintain those operations. So they're able to not incur a tariff and get their new products developed. So it's very, very creative. So we're expecting some very good growth from their new products, and we're expecting higher profitability based on the way they have restructured or strategically aligned their business now. So we're getting pretty ready for the presentation. We have the CEO, Dan O'Brien, joining us from the home office or his boat. Maybe it's one and the same. Not kidding, but coming up very soon. And it's Flexible Solutions International, FSI.
Okay.
Good morning. Am I live?
Yes. Hello, Dan. Can you hear me?
I can hear you.
All right. Well, nice to chat with you again. And thank you for joining and participating with our conference. We have a room full of very eager, open-minded investors this morning and an online crowd as well. It's significant, waiting to learn about flexible solutions and your unique new products and the way you manage the business very efficiently. So are you enabled to turn the slides at this point, Dan? You can take it from here.
Yes, you'll need to provide me with control over the slides. I've got them on my screen, but I do not have control yet.
Dan, right?
Dan, yeah. Or I can do it. Better not keep me away from it.
We're not going to be able to see him for this presentation?
You mean like live in person?
Like we did with Mark, yeah, the first one.
Yeah, I don't know. I don't know. That's a good question.
Okay, here you go. Is he's a presenter now, so I don't know if he's going to have access to the files on our. Okay, that's what okay. If I could get this up. Okay.
Do we turn them here manually, or is he going to turn them?
Yeah, no, we have to do it here.
Okay. Dan, we're going to turn the slides at your command, so take it away. Tell me what to do.
Right, that arrow. Yeah, that arrow, yeah. So
That goes forward?
You see, so you hit the right.
Okay. Hello, Dan.
Hi.
Hey, Dan,
Okay,
go ahead.
Still don't have my presentation.
We have it up. We can see it. We'll turn it here manually. You just say turn slides and we'll do it. So
Okay.
go
I'll do
for
that.
it. All righty.
Good morning, everybody. Sorry for the AV issues, but at least we don't have a burn on a film. That's over and done with. Welcome, and I'm the CEO, Dan O'Brien of Flexible Solutions International. Slide 2, please. Because I can't see the slides moving, I'm going to assume that it moved to slide 2 and the safe harbor provision. The Private Securities Litigation Reform Act of 1995 provides a safe harbor for forward-looking statements. Certain of the statements contained herein, which are not historical facts, are forward-looking statements with respect to events, the occurrence of which involve risks and uncertainties. These forward-looking statements may be impacted either positively or negatively by various factors. Information concerning potential factors that could affect the company is detailed from time to time in the company's reports filed with the Securities and Exchange Commission. Next slide, please. We started in 1998. You can see on the slide that we started with a swimming pool product. We still sell that product. We continued with an invention that saves water from reservoirs and canals. I would like to point out that it's been unsuccessful from the point of view of the huge markets that are available. And we attribute that to a fairly simple problem. The customers are bureaucracies, and saying no is always easier than saying yes and losing your job and your pension. The second problem, of course, is that after the product is applied, it's invisible. And selling invisible products is a very difficult problem. Slide 4, please. Next slide. 2004, we had the opportunity to buy the assets of a company that was going bankrupt, but which had great technology and a lovely factory and some very good people. We did it. It was called Donlar, and it's now called our Nanochem division. And it's specialty chemicals for oil field, fertilizer, detergents, wine. Very good business. As you can see from the slide, we started with not very much, and we're now doing quite a bit through this division. In fact, it's the biggest division of our company today. It was an interesting experience, taking over a company from management that was not focused and was charging too much for their services, and turning it into a profitable and growing division taught us all a lot, and we enjoyed it very much. And it's now ready for the next transition, which we'll talk about a little later. Next slide, please. In 2012, the Nanochem division was able to expand into additional products. The usefulness of our original polymer, polyaspartates, in the agriculture market really showed us that there were other opportunities in the conservation of fertilizer world. And the next two products that we brought in, EX10 and Sun 27, Sun 27 and N-Saver 30, they had an interesting aspect. The first polymer saved phosphates, and the second polymers, the nitrogen stabilizers, saved nitrogen. So it put us in a position of being able to conserve all parts of the agricultural trinity of fertilizers. We're pretty happy with that. These sales are growing. Much of it goes through our Florida LLC customer. And, we feel that this is an area where we'll be successful in our new Panama division, which I will speak about in just a little bit. Could we go to the next slide, please? This one's just a simple picture of our operations in Illinois. As you can see, it's a pretty substantial place. This entire facility is being repurposed for food grade. So it's becoming a very valuable US-based manufacturing operation for products made in America to be sold to Americans. Could I have the next slide, please? And here's our segue into food group. We didn't invent this. The people who did invent it are in Italy, and they have the patents, but they came to us as the premier manufacturer of polyaspartates and said, would you like to share the cost of getting food grade approval for your product in return for an evergreen contract to supply us? And we said, yes, and proceeded. So the particular food grade aspartate, potassium polyaspartate, is now food grade approved in both Europe and America, and it has been very successful. You can see from my writing that there's a fair amount of volume available. It will be self-limiting though, because the amount of wine made on Earth has a limit, and the use of this product, just as an anecdote, is 10 grams per hectoliter, which is 10 grams per 100 liters. So we needed to find something as big as the wine industry in order to get a significant volume. Next slide, please. 2022, this is when we started the projects that are coming to fruition now. We obtained debt, we increased our equipment, we improved our employees, we learned all the ins and outs of filing protocols with the FDA, being inspected, having the FDA has a wonderful habit. They inspect at least once a year without warning. And we think this is great because we always operate it at the best levels. And there's competition in these markets. And we feel that all we have to do is maintain perfect quality. And over time, we will attract business that is being lost by people who weren't maintaining perfect quality and suffered an unexpected inspection. So we think this is a great opportunity for us to use our skill set to become a respected part of the food chain, and also to be positioned so that when other people make mistakes, it results in opportunities for us. Could I have the next slide, please? Now we're up to this year. The work we started in 2022 is bearing fruit, and it's pretty significant for a company that last year had revenue of 38 million, and this year is moving towards a $30 million contract, followed by a contract of 6.5 to 13 with an opportunity to go as high as 25. So I've actually said in my SEC filed speeches that we have a strong belief, not a guarantee, but a strong belief that we can double our revenue across the 2025, 26, and into early 2027. We'll certainly be aiming for those run rates, and it's highly likely that we will be at a double by year end 2027. So those are our goals. They're not forward guidance. They're the goals of Flexible Solutions, but we believe that those goals, combined with the contracts which we've filed in redacted form, really support our goals. And this is where we're headed. I should point out the last line on this slide. We don't expect additional equipment or capital improvements for the second contracts. We have the equipment on site. There will be little things, maybe 100,000 here, 100,000 there, but nothing that is in the $1 million range. And certainly, we do not expect to have to do any capital raises to reach full production. Next slide, please. Okay, we see new opportunities. My goodness. Yeah, sales to the new and existing customers and the existing product lines, those are going on. Developing new lines of business and manufacturing, yes. In the food grade Illinois plant, we are already doing basic research on additional products that we could make. Some are more advanced than others. None of them are likely to be major contracts before we've finished rolling out the 2 contracts we have all the way to their maximum. We know better than to try and do too many things at once. And doubling your revenue in a couple of years with a couple of major contracts is plenty for us to do at the Illinois plant. Down in the Panama operations, we have the opportunity to increase sales of the existing products also, but we're fielding inquiries from people who are internationally oriented and have already seen that what we're doing in Panama would allow them to be more efficient. So we're looking at opportunities there as well. And then finally, acquisitions. Now we do acquire and have acquired over the years, but we're pretty picky. It's usually got to bring its own management because we're spread thin. It's got to be in our line of business, so we don't have to learn everything from the beginning again. And it's got to be profitable already, and of course, available at a fair price. So while we're always looking for acquisitions, they take a long time to find the right ones. And we want to caution you that until we find correct acquisitions, that's an area where we look but don't buy. Next slide, please. Okay, several times in 2024, we made news releases about the potential of moving into the drug compounding industry. We bought a vial filling machine. We have it in storage. It can be set up and placed in operation relatively quickly. And there are businesses that can be pushed through that line. When we did this, the GLP-1 business was huge, and compounders were falling all over themselves trying to find ways into the business. As you all know, Eli Lilly and Novo Nordisk have managed to increase their production capacity, and GLP-1 is no longer on the shortage list. That means that if it's not on the shortage list, we are not allowed to compound it. So the opportunity passed us by. On the other hand, there are other opportunities. And I mentioned one there, lidocaine. But perhaps the more interesting situation is that GLP-1 is a peptide drug, and it's the first one to reach the market. But there are 100 others in development. The probability that one or more of those drugs will be commercialized by a company that does not have enough production capacity, and we are potentially there as a contract producer, at least for the bottling end or the vial filling end of it, is fairly strong. So we're keeping our ear to the ground there. But as you'll notice, we would require a large contract to be in place before we move forward on this, because we'd have to make a new drug level clean room and hire additional people. So that is a longer term project. Next slide, please. There's just a picture of the line. And gentlemen, I think I missed a slide, so I'm going to go up. No. My apologies. I did not miss a slide, but I'm going to talk about our Panama operation right now. All right. Flexible Solutions, through its NanoChem division, has suffered since 2017 under the original tariff regime, which made it possible for us to remain in business in America, but not particularly profitable and definitely difficult because our international customers were not interested in paying a premium just because the production came out of America and had higher tariffs on the way for the raw ingredients. So we had to keep our prices down and apply for the government rebate program for exports. It's now coming on 8 years, and we have not received any of our rebates back. There's a lot of money in an American bank account. That money is not shown on our balance sheet because the auditors, and rightly so, after 8 years, are concerned that it's not collectible. That sort of government friction caused us about 2 years ago to decide that we needed to do our international production for international customers outside of the United States. So we developed a program, and we have rented space in the country of Panama. We are in the later stages of installing all the equipment and expect to be in production as soon as possible. Now there's still one more permit, the occupancy permit, but we're expecting that we can be in production relatively quickly. The point here is that we will not be paying the American tariffs when we import raw materials from around the world into Panama. And our customers will still pay tariffs when they import the finished goods into whichever country they are in. But the friction of the American tariff program will be gone for all our international production. And this is of our polymers and our agriculture products. As a result, we're expecting to be able to grow. We're expecting to be able to have higher profits. And we are expecting to be able to find new product lines and new customers, because it's a much more efficient way of doing business than we were finding in the United States. A final point on that is that we do expect that we'll be able to sell some material into the United States from there and support some of our American customers as well. So it's a very, very good thing that we've done there. And it had a secondary advantage. We have now freed up 100% of that factory I showed you back in about slide 5 or 6. 100% of that factory is now available for food grade production in the United States for US customers. That's going to allow us to expand quite significantly without any further capex in the form of new buildings or new spaces. So we're feeling very good about that. Panama was a good choice. And then a final comment about it is, until we moved to Panama, which is happening very soon, every raw material coming in from internationally was landing in either Prince Rupert, Canada, or Long Beach, California, and having to go by rail and truck from there to our Illinois plant for remanufacture. And then from the Illinois plant, it was having to go to either Montreal, New York City, Charlotte, or back to Long Beach for export. So in Panama, our factory is 20 minutes from the port, the inbound port, and 20 minutes from the outbound port. This is going to help us a lot, and it's going to help our customers a lot. We feel that we're going to be able to deliver a week quicker than we could before. We also have the opportunity, which is quite interesting. We can export from either port or either side of Panama, either the Caribbean side, through the canal or the Pacific side, direct from our factory. There's also a rail line that goes from our factory area across Panama to the Caribbean port. So we've got multiple export opportunities, and we feel that we've done a really good job of finding our next business. Okay, I'm back at slide 13 now after that sidetrack. It's two key people in our company. I'm speaking. Sad my dad's gone, but he sure helped me and us build a very strong company. And 8 years ago, one of our executives said to me, you know, you should hire George Murray. And I said, George Murray works for a customer. You can't go headhunting your customers' people. And they said, oh, well, George is really good. So my next move was to go to the company that owned the company that George worked for and say, hey, how'd you like to sell some? And we bought 65% of our E&P division, and the bonus that we bought with the division was George Murray. He's now manager of all FSI operations, and he's doing a great job. He has stick-handled the movement into 100% food grade in Illinois, while I've been freed up to work with another director, Rob Helena, to put the Panama operation in place. George and I are a great team, and I look forward to many more years of working with him. Next slide, please. Well, that's a balance sheet, and we feel that it's pretty strong. We feel that we can continue being profitable. I should mention that this year is a transition year, and you'll see in our news releases and in my speeches that developing a second factory while transitioning your first factory definitely has some extra costs that are not capitalized, and they do hurt the bottom line temporarily. But I think if we look forward to 2026, and you'll see that in the analysis, that this is the year when we put in place all the mechanisms necessary to be extremely profitable throughout the future. And next slide. I'm purposely not doing that naive trick of just reading the whole slide to you. I'm sure you guys can read faster than I can talk. Should mention that we did change auditors recently. That was not our choice. Our previous auditor had decided to let all of its US audit customers go. There was a silver lining in that. Assure is much, much better than our previous auditor. They are very helpful. They are very aware, and we certainly appreciate the fact that we were forced to move. Gentlemen and ladies, that concludes my presentation, and I think we're going to switch to a question and answer. And I haven't done a presentation yet with Singular. This is my first, so bear with me as I learn how to do the Q&A.
That's what I'm here for, Dan. Take you through this thing. So the floor is now open for questions for Dan. Yes, sir.
Hi. Forgive me. I went to school for investigative journalism. So this is. You said that you moved to Panama because of the tariffs. That doesn't seem like something that can happen over the course of 9 months. And Panama does have a 0% corporate tax on any sort of foreign income. Is that why you did it?
No, it was definitely not a tax move. I think maybe I should explain. Most of our raw materials for our agriculture and polymer business are made in China or in South Asia, and they carry pretty high tariffs if you bring them into the United States. However, about 70% of our customer base are international, and they rightly expect that they should not be paying tariffs on products that come into Canada or come into the United States, are remanufactured and then exported to them. So we were finding ourselves in a position where it was very difficult to be profitable, and where those profits that we were making on some of these products were ending up locked up in the U.S. export rebate program. Because I will admit very much that there is a rebate program. It's just extremely inaccessible. So is that a better explanation?
I was just, because the whole tariff fiasco has started. I know there were tariffs before Trump. Trump's only been in office for 9 months. So if that was the reason that you had started before, that's too quick to move an entire facility upstream.
You're absolutely right. We couldn't move in 9 months. We started almost 2 years ago.
Well, there are other reasons to be in Panama. Bananas? Dan, I have a question. Early in your presentation, you highlighted a ramp of exceptional growth. It looked to me like a near doubling of your revenue base moving ahead. And could you take us through a little bit of how that ramp is going to develop? And what are the products, fundamentally, what are some of the key products that will drive that?
Okay. Well, first off, our legacy businesses of ENP in Illinois and all the business that's moving to Panama, they will continue to do the type of revenue that they've done in the past with organic growth. The Illinois factory that is converting to completely food grade has one contract for the wine group, which is already in production. But there are 2 more contracts which were outlined in the slide, and I think that's where you're focusing here. We are constrained by the contract. I can't tell you what the product is, and I can't tell you who the customer is in either case, but I can tell you how we're going to ramp up. The second contract is in the process of final testing before ramping to commercial production. And when we receive that final approval by the customer, we will be announcing it because we feel that that's pretty significant. We're expecting this to happen in the next weeks to months. And we're expecting that second contract, the smaller of the 2, that goes from about 6.5 to 13 million, with the option of a double at some point to 25. We expect that one to have a high probability, not a guarantee, but a high probability of showing revenue in fourth quarter that is large enough to be visible in our financials. And we are expecting, but not guaranteeing, of course, because I've got to be careful, but expecting that the second contract, the one we announced in July, will be running at full speed throughout 2026. So that's a pretty substantial jump in revenue. During the fourth quarter, we expect to finish installing all the equipment and start preliminary production for the first contract, the 30 million maximum one that we announced in January. The reason it's behind the second contract is because it needed equipment. The equipment had to be made and installed and tested. But we're expecting that will take place in fourth quarter. We will announce that the equipment, when the equipment has reached production status, and at that point, we are expecting the customer to say, please start going as quickly as you can. They want this to be started as fast as possible. So we're seeing a large proportion of the maximum 30 million will be part of our revenue in 2026. And the remainder we hope to have as our revenue in 2027. So that's how the ramp up goes. And at this point, we have not encountered any problems. And as I say, we'll announce when we start commercial production of the second contract. We'll announce again once the equipment for the first contract is in place and tested. And we'll announce a final time when the first contract hits commercial production. So there'll be clarity on the revenue end of everything, and the production and the two places I can't give you clarity or transparency are on the customer name or the actual product.
Well, it sounds like some exciting opportunities. And we're about out of time. Any closing comments, Dan?
No, thank you for letting me present. I really appreciate it. Hopefully I'll be presenting again on the next one, and I'll be able to give you some actual successes instead of what we were planning to do. I'm going to be telling you what we actually did. So I'm looking forward to that.
Thank you, Dan. Thanks for joining us. All right, let's take 5, maybe 10 here. Before our next presentation, there may be lunch. I'm not sure. I'm on West Coast time here. It's breakfast for me, but anyway, 5 or 10 right now. Let's turn this off here.
Yes, sir.
The next one is a pre-recorded one that I put in my file box just to launch it like it would be a person here, I guess.
Gotcha.
And I'll cue it up with about a 2-minute intro and hit the button to run it, and then it'll run with its own Q&A. Give us a break. Oops. Crypto or gold? Crypto or gold?
No, I'm a gold. I decided I can't invest in things I don't understand, and I don't feel like I understand enough about the crypto world. So I trade it.
Who wants to explain to this nice lady what the crypto world's about?
That's not my
Anybody?
But what we were talking about is that where, getting penny stocks, they're not available on all these trading platforms, like the
Right.
data solutions.
Big Brother's looking after you. They don't want you to step in it.
Yeah.
That high risk stuff. No, it's true. They're looking after us. So we don't make those irrational maneuvers in the market, those plunges.
Do you have a platform that you recommend for penny stocks?
For penny stocks.
Yeah.
Robinhood.
See, I just looked up data solutions.
Yeah.
It's not on there.
Robinhood?
Yeah.
Actually, Charles Schwab is more liberal than I would have expected. Yeah. And then there's another firm called Interactive Brokers. Yeah. Not too shabby for that too.
Yeah, just go ahead and take it out. I won't break it. Should take my thumb drive back.
No. Take him on board once you go home.
Thanks for being patient with that.
You're 101.
Yeah.
12, so just no rest here. Just work. So go out there and grab some lunch and come back when you can and get yourself ready at home. Yeah, he's gonna be here. It's gonna be a live presentation.
Okay. So we use this camera.
Okay. I'm gonna turn this off for the time being.
Okay. So he'll use the mic. Okay.
Yeah, that's automatic right there.
Okay.
No, it's a separate room down the hall at the end. And it's a shadow, so overflow room. So you can go more room there. It's, you get this same video that you see here, there. So,
They're just simultaneous.
yeah, simulcast, in stereo.
I have a question about the land purchase. It wasn't clear. They purchased the land from a First Nations tribe?
These guys?
Yeah. Do you know the answer to that?
That's a great question. Let me think. In Canada, it's kind of the wild west. They also get huge tax benefits. Flow-through shares. So if you buy, to encourage people to buy shares of these gold and these mining companies. So you get like a share and a half, but the half is like a tax shelter of whatever you make later. So it's a way to encourage investment. On the Indian bit, I don't recall what they did there, but
I did have questions about how they got the land. It said something about working with the tribe and getting them to be comfortable with mining. So I was really curious on whether their process was like fracking and how they're protecting the land for when the mine goes dry.
Yeah.
And where they don't find land, where they don't find ore, but they've already dug a big gaping hole.
Yeah.
Like,
I think in Canada, they're a lot more liberal about regulating that. That's why there's a lot more mining going on.
there's a lot more land too and wide open spaces.
Yeah. Oh, yeah.
Okay, thank you.
Good questions. I don't know, but AI knows.
Ah, true story.
Power Metallica. Power Nickel. How do Canadian environmental regulations compare to those in the US? Huh?
ChatGPT.
Yeah. Well, no, it's a Gemini.
Gemini.
ChatGPT.
Try Grok.
Which one do you use?
Try Grok.
Do you like Grok?
Right, yeah.
Yep.
It is.
Is it free? Not really. No, they're not free anymore, right? Yeah. I noticed this. I was falling in love with 4.0, and then 5.0 came out. It's not as good. So I want 4.0 back, but you can't get it. But what you can do is you can upgrade to a higher level program that's a lot more expensive.
Try DeepSeek.
Huh?
Try DeepSeek.
DeepSeek, yeah. I've heard the one Perplexities, people use that. Braggers using DeepSeek. Here's pretty good. You use DeepSeek?
I tried it and on commercial level, it's
DeepSeek good? Right. Yeah, it's been a while.
maybe you buy a phone and Grok fights to get that.
Yeah. They don't like each other.
Thanks for the comments.
You're welcome. Thanks for coming. Yeah, it's no answer here. It's too much of a political issue. And it's really funny, these answers you get, they really try to sidestep politics and to a degree. I mean, and they'll say things that are just kind of neutral, watered down,
Right.
nebulous.
Well, I noticed the new buzzwords are also made in America for Americans.
Oh,
Several of the presenters have used it.
oh, today? Oh.
So next is gonna be live, or we're gonna go to somebody, or it's gonna be here?
It's gonna be, yeah, here.
Okay, so
What do
you
we call
just
it?
have the mic and the camera's gonna be here, so you guys should be
Okay.
fine. Once the mic's on, I mean, this is picking up some, but when the mic's on, you should be good.
Yeah,
I'll check another room where we can hear the audio, so
yeah.
everything's fine though now.
He emailed me his presentation, so I have it in my inbox of my email.
Is it here? Your email's available here? Yeah, right? 'Cause-
Yeah. Oh, no, not that one.
Okay.
The other one. That one.
This one?
The Google Gmail. Yeah.
Okay, this one?
Let me see. Yeah, it's in here somewhere.
So you could download it and then I guess we can
Yeah.
load it up and get it ready.
Yeah, let me do that.
So this way you don't have to worry.
You try
about
to
it.
do that. Yeah. Oh,
We just gotta find his email.
His email.
I was gonna say, oh, is this guy right here? That's you.
Yeah, here's that joker. I know it. Okay. Can't eat. Oh, it could be this. What is that? That's his logo.
That looks like the file right there. Highlight it. Oh, no, that's the image. I'm sorry.
Yeah,
I thought
that's
it was
okay.
a PowerPoint.
It's okay. I do it all the time. This could be it. PPTX, yeah.
Yeah, that's it.
You know, where'd it go? It's on the bottom, right?
Yeah, most likely.
So what should I
there
do?
it is. I guess download it right there.
Like that? Click there?
Yeah. Hopefully it'll go to the download folder.
It went in there.
Yeah, it's looking like it. And then.
So we can find it in there, right?
Yeah, let's go in here. All right. Where are we? It's in downloads and it's looks like it's this one, I guess. Okay, this would be it.
Yep.
Then what we'll do is, and then
Yes, sir. I was thinking with the first presentation, I think I heard one of them mention they did a reverse split even before the LED lightning. I think
Yeah.
maybe it was the Mark Benz data center.
Yeah.
No, the reverse split was the other one, the LED.
No, yeah, I know. I did ask that because I was thinking I heard earlier that one of the first companies also did one.
Okay.
And then, but when I looked at the stock of Mark Benz, it didn't really show. It showed that it started maybe like I think a few months ago.
Okay. Yeah, it's pretty good.
So I was thinking maybe it's because of his Texas version or something.
Yeah. That this mere spun off. He's doing new ones a lot. This is serial, not killer of capital, serial entrepreneur. Let's say. Yeah. Or he has ADD. He's kind of bored fast. On to the next one.
That's what's
Yeah,
up.
yeah.
Jeez, forget, because thinking was like, he's probably making millions just starting companies and selling them.
Yeah, we've known him for a couple years, and
Hey, the projector went off.
interesting plays.
The projector went off. Yeah, it just turned off. hmm Yeah, they had lunch, but I'm just trying to set up for the next thing. Yep. Bye.
Is it like raining out? Looks like it's raining. Ah.
Okay.
It's good.
Oh, it is?
It has to be. Did you do this? Give it a second.
Okay.
Give it a second.
Yeah.
There's a, what's up, yeah.
Okay, that's good.
So, I don't know if it was maybe.
I don't know.
Yeah, sorry.
I don't know.
I get the
So
one
I
here,
think-
right?
Oh, yeah. So then the mic's on. Thank you. Okay, looks like we're good. I think we're all good. So now just the
Okay.
arrow. I don't know.
Awesome.
So we're gonna have this presentation after the lunch break, is that what you're saying?
Should be happening right about now, but I think he may be waiting for lunch to get started. It's supposed to happen. You have time to do whatever you want to.
If we don't need this port,
Huh?
if we don't need this port, you can use this.
Oh,
Okay, use a clicker. But we need this port. That's the only reason why I didn't pop it in earlier.
you need that.
If
that
do
thing
we?
plugged in?
No. Yeah, this thing has to be
Are
plugged in.
you asking me?
No. What I'm saying is, if somebody needs to upload something, we got to remove it to like we did before with the jump drives. So now with
Whose is
this,
that one?
this is from here. This is from us.
Oh,
So we'll
okay.
put this. Now you can just be here. You can be on the mic. And,
Oh, yeah,
so
that's
you
great.
Can kind of move around.
Totally
Okay?
mobile.
So
Don't
yeah,
need to be
yeah.
tethered.
So I'm gonna leave it right here. Okay.
How'd you do that?
Well, this is the piece that goes in there. It was on there, but I figured we were using the jump drive, so I didn't want to like everything was kind of.
Oh, okay.
So now we're
Did you download it on here so that could be mobile?
No,
or
it's just this piece.
Oh, that's a remote.
Yeah, so this is wireless. So this will
Gotcha.
talk to that,
Okay.
and then it can let us know.
Wireless.
And then you.
Oh, very cool. I got
So
you.
this will be here, and I think the mics, everything's on. I think you should be good.
Awesome.
Right. So when he
Yeah.
comes in, he's gonna do that, and then what do you?
Well,
Ask me anything?
Have to open the schedule. Hello, Kent.
How are you?
Great to meet you. I'm sorry I missed you earlier.
Yeah, no
Had
worries.
to-
I know you're
had to
busy.
Straight, so I gotta do this. I think I'm coming down a little bit of a thingamajig.
Okay.
Thanks for coming. How was the trip?
It was good. It was late last night. I apologize. I wanted to get to dinner, but I didn't get it.
No worries. It's business is
11:30.
business.
Yeah.
How's Tejas?
Good. Can't complain, man.
Yeah.
It's the cool time of the year. Weather starts to pull back. It's not,
Oh, nice.
It's not as muggy. So.
Oh yeah.
Yeah.
Gotta love that.
Yeah.
right?
Yeah.
And you got those Texans.
Yeah.
Although our Rams, I think, beat them. I'm not an LA Ram. Yeah, LA doesn't really. I guess they have a team. Yeah. But no, thanks for coming. Are you going okay?
Yeah. Yeah, it's a one-on-ones. Just finish up one.
Oh, good.
Yeah.
Good.
Yeah.
So I think you could, I'm going to give you just a brief intro. We're recording it. We're going to post-production edit.
Okay.
So it's cleaned up because, there's a lot of,
Commentary.
yeah,
right?
commentary that you don't want out. And we'll put it on our Single Research YouTube channel.
Okay.
We've got about 15,000 retail investors. But so I'll just give you the intro. I'll try. I know you have to leave early, but try to catch up with you a little bit if you get a few minutes later. You slip out of here.
Absolutely.
I told them I'll go get their lunch here, but we're gonna get started. Did you get the report, the research?
Yeah.
So I think I can incorporate some of you. Now that is what's called an action call, which is not the official final draft. There's various iterations and stages here. It's more of a quantitative report than a fundamental deep
dive
explanation. That comes next up. But I wanted to get it out in time for the conference and the launch to get the name out to our following quickly. And we covered DXPE a while back. I mean, we've been around 20 some odd years, and we covered, it had to be 15 years ago at least.
Okay.
It was like 22 a share.
Yeah.
Did it split? I don't think so.
Well, my predecessors, I think they did. I don't know if they did. I think
Mac
they did.
McCollum, right?
Yeah.
He came to our conference too.
Yeah. Well, Mac's a good guy.
Yeah. And David Little.
Yeah.
I think it was just Mac. I didn't think David came out.
He never came.
Yeah. Man behind the curtain.
Yeah. He's still there.
Yeah.
He's still there.
You guys are doing a great job, and I wish I never sold a share, obviously. That's a mistake, my biggest mistake. I'll introduce you. Get rocking here. So I think all you need to do is flip that guy.
Okay.
And your mic's here. It's going to record. It's recording now. And I got to turn this on. Okay, welcome back, my friends, to our ongoing conference, and we're kicking off the second half with a larger company for us that's been very successful, and to us very de-risked, and a steady, stable performer. A company that is based in Houston, Texas. It's called DXP Enterprises. And what does that DXP stand for?
Distribution experts.
Okay, that makes sense. I cracked the code on that one. Finally. So just a little bit, the company distributes maintenance, repair, and operating supplies, rotating equipment, safety products, and engineered solutions, and operates in 3 segments, industrial segments, I trust, and has been very successful with acquisitions.
Yes.
And there are many more out there.
Yes.
And since they're very successful at that, they are able to grow without needing Wall Street very much, if at all, really. And to us, that's a good thing because they don't need to sell stock. They just keep growing those, earnings on the same share base. So we are fortunate to have the CFO of DXP Enterprises, Kent Yee, with us to take us through the presentation. Welcome, Kent.
Thank you, Robert. Thank you, Robert.
Yep.
And I think, is this mic on? I'm going to use that mic.
Yeah, I'll turn that one off. It should be on. Test.
Can everybody hear me?
No.
Oh, okay.
Is there green lights on?
Yeah. Hello, hello.
I'll go get the guy.
Hello, hello. There we go. There we
Oh,
go.
there it is. Hello.
There we go. There we go. So DXP Enterprises, we're known as a B2B distributor. We go to market under 3 business segments: service centers, innovative pumping solutions, and supply chain services. Service centers is roughly 65-70% of what we do. The way to think about that, and I have some slides later on that I'll go into a deep dive, is a local presence in a local market, and we service it through an inside and outside sales force. Innovative pumping solutions, which is 15 to 20% of our business, is where we remanufacture, fabricate, or manufacture modular pump skid packages. And we also do water and wastewater. And once again, I'll go deep dive into each of these segments later on. And then supply chain services is where we help manage our customers' indirect spend. So we're typically housed within our customer's facility. And we manage their storeroom, or we have vending machines on their floor. So that's supply chain services. You can see our end market mix, and once again, part of the story and part of the movement in the stock, and I'll explain it later on. But our oil and gas end market is our largest end market, but it used to be as high as 60-70% as a company based in Houston, Texas. And through our diversification efforts, we've taken it down to 20% or less. Predominantly in the U.S., but we do have a North American footprint in the U.S. and Canada, and with offices also in the Middle East or Dubai, which once again, I'll go a little bit into that later on if someone asks me a question about some current activity that we've got going on in that part of the world. LTM sales, $1.9 billion in sales, 213 of adjusted EBITDA, over 170 plus locations within service centers, with the rest being in IPS. And really, as Robert mentioned, also highly acquisitive. And so I'll go through that later today. The segments, this just gives you a view of each of the segments and their LTM performance. What you can see here is from a service center perspective, our largest segment, $1.3 billion in revenue and operating income of $188 million, or north of 14% operating income margins. And then you've got IPS at $360+ million in revenue and $65 million of operating income, or 17% operating income margins. And then supply chain services at $257 million in revenue and $21 million in operating income. Point being, and what's the takeaway here is IPS tends to be our higher margin business, and our more high touch business, as we call it. And then our service center business, which is the largest piece of our segment, is the largest kind of consistent performer at 14% operating income. You can see we like to give pictures to walk people through a pictorial so they can really feel what we do. But if you look there on my right, you can see a DXP Supercenter, and that's what we mean by a local market presence that we service through an inside and outside sales force. People per se don't necessarily come into our facilities. We do have walk-up business, but it's really having that local market presence in an industrial market across the U.S. that we service through inside and outside sales. And that outside sales is a technical sales force, and it is a consultative sale in the outside. And so you can see that we service that through what we call a branch or a service center. And then IPS, we have an example here, and this is hard to capture in pictures, but it's where we remanufacture, we do pump manufacturing, we do our water and wastewater project management and engineering. And what you specifically see here is a pump on a skid, or 2 pumps, on a skid with pipes, valves, and controls and piping. Point being, it's very hands-on. It's where you're doing a lot of value-added work. And then here on the far right, closest to me, if you will, is supply chain services, where you can see we're housed in the customer's facility. We're barcoding and bin locking their inventory of their indirect spend. And so we're intimately tied to the customer because we're in their facility, usually in their ERP systems, and managing that indirect spend on their behalf. So slide 6 here walks you through part of the story. Back in 2014, DXP peaked out at about $1.5 billion in revenue, but 70% of our end market exposure was to oil and gas. And so as everyone knows, the oil and gas market cycled in 15 and 16 and slowly started to rebound mid to late 17 and moved on from there. Well, once we went through that last cycle, we made a conscious effort as a company to diversify our end markets, and primarily doing that through acquisitions. We want every oil and gas dollar we can get, as we say, but we also wanted more dollars of other end markets. And so you fast forward to today, and this is as of 2024, but oil and gas is 23% of our end market exposure, with water and wastewater being closer to 10%, as well as some other end markets we decided to highlight there that we've had an emphasis or focus upon. And so you can see that that's been part of the story, and that's been part of the movement in the stock. I think people are starting to see that we've been executing upon what we've really been focused on really since 2014, but it's just started to take traction here more recently. This gives you a sense of our product mix. So we go to market through the 3 business segments, but we also support those 3 business segments through 5 strategic product categories, with rotating equipment or pumps being the largest product category, and then bearing and power transmission products, metalworking or what they call cutting tools, safety products and services, and then our catch-all categories, industrial supplies. And then you can see where we fall out and where we rank across those product categories, with once again, rotating equipment or pumps being the largest product category at 60%. It's also the roots of the company and where we really differentiate ourselves, or where we really start to build our moat from our perspective, is around pumps. The company was originally founded as Southern Engine and Pump Company, and so it's at the roots and heart of what we do and where our differentiator lies. Here on slide 8, this just lays out our strategy and our financial goals. Each year, our CEO and chairman, challenges us to grow 10% organically and 10% through acquisitions. Now, we don't necessarily execute upon that every year. Sometimes it's more acquisitions than organic growth, but point being, those are our financial goals. And if we execute upon that, we'll typically double our business, mathematically every 4 years, but realistically every 5 to 7 years, we'll typically double our business. And that's pretty much what we've done, except for a few exceptions, with one of those being 14. And so that's why we kind of use that demarcation point here more recently. But from when he bought the business back in the late 80s, early 90s, we've essentially just doubled our business every 5 years. And we've been executed upon that. And so today, LTM at $1.9 billion, the way we look at it is $2 billion's in the bag. And how do we now go from $2 billion to $4 billion? And so that's really the focus and the energy and growth. On the right-hand side, what you can see is some of our more recent acquisitions, and you can see a heavy focus on water and wastewater. And so you can see that there on the right-hand side. Slide 9 here gives you a pictorial view of kind of our performance since 2020, or I guess since the COVID market, as they call it. And once again, you can see we doubled our business from a revenue perspective, over tripled our EBITDA, going from 59 million to 213 million LTM, and thus driving our return on invested capital in excess of 30+%. And so you can see that alongside with that, we increased our gross margins almost over 400 basis points and improved our EBITDA margins as well, nearly doubling them, if not a little bit more. And so you can see part of that's all been driven by not only the growth, but the diversification and the accretive nature of some of the acquisitions. So. Slide 10 here gives you a good pictorial of both EBITDA and cash flow. And why we highlight this is because we're a counter-cyclical, if you will, cash flow production type company, meaning when we're in growth mode, we actually produce a little bit less free cash flow, even though we're focused on increasing our free cash flow yield, if you will. But when the business cycles, we produce free cash flow in excess of 100%. That's important because when you look at our capital structure, we do finance ourselves partially from time to time with debt to accelerate our growth via acquisitions. Robert's correct. We can self-fund through typically our free cash flow, but when we want to get aggressive, our capital structure today is composed of an ABL plus a term loan B. And so we tap the institutional debt markets to grow. But why we can do that is because if the business cycles, we know we're going to throw off, a huge amount of free cash flow. And so this just gives you a pictorial of that. You can see in the COVID year, we produced over $100 million worth of free cash flow. And so what do we do with that? We opportunistically pay down the debt, let the market calm down, and then we turn around and go right back at it. So. This just gives you a sense of our capital allocation over the years. The real takeaway here is you can see on the net share repurchases, we bought back over 4.4 million of shares here more recently due to the depressed stock value, and us being no different, I would say, than you guys. We want to support the stock. We want to invest in the business. And so we strategically, from time to time, bought back shares. And it's been an unprecedented amount of shares that we were able to buy back and drive some value creation for our shareholders. And that's really it. I'll stop there and open for any questions. In the appendix, and I have some presentations if people want to take a few copies later on. In the appendix, there's just a deep dive on each of the segments, so you can get more of a history of each of the segments here, whether service centers, IPS, or supply chain services. But would love to take it to questions.
Given your debt financing, how has that had, or has that had any impact with the changing interest rate environment?
Yeah, so for us, it's for me, it's been a positive. What do I mean by that? As a publicly traded company, when I go to the institutional debt markets, they're not going to allow me to get leverage above 3.5, 4 times if I'm lucky. Versus my peers, which we do have some peers in the private equity space, they get 6 to 7 times leverage. And so what that's been able to do for us, from my perspective, is as interest rates moved here more recently and the interest rate environment got much higher, it was normal course for me. I was just servicing the debt contractually as we were supposed to, and able to go execute on acquisitions, versus I believe a lot of my private equity peers, if you will, from a competitive standpoint, were spending more time on debt service than anything else. So that gave us probably an opportunity or a leg up on some acquisitions at certain inflection points. And so I think that's why you see some of the push on the acquisition side. But they're always there. It's an inevitable piece of the landscape today. And so, but I think in this environment, I think it favors strategics a little bit more. So.
Yeah, I see you mentioned that you bought a lot of shares. The company started buying many shares, and I was looking. So the stock is GXPE.
Yes, sir.
NASDAQ. So I noticed the split with the reverse. Was that a reverse split or forward split?
I wasn't around then, so I don't have all the details, but the split was many moons ago. And so that was, I think even, gosh, I don't even know when the split was, to be honest with you.
It looked like they gave out shares because they're 2 for 1. So
Yeah.
I think the company may be very good.
Yeah.
The charts that you showed us over time seem to rely and involve your company less and less in oil and gas markets. Is that a conscious choice or just a reflection of less involvement with fossil fuels as a whole?
I think it's, I think it's a conscious choice to diversify. But, so our IPS segment, 50% of it's oil and gas today. We're chasing every dollar we can get, every project we can get. So, so there's more brown projects, green projects, whatever you want to call them. And so, it's even some of our more recent acquisitions, one of them has, in the Gulf Coast region, had oil and gas exposure. So I guess to answer your question, from our perspective, we still want every dollar we can get. We're just very sensitive or more conscious about being sure we're getting the water, wastewater, food and beverage, chemical, general industrial. And if we're going to look at those other acquisitions, the multiples are going to be on the lower end on the oil and gas side. So if that answers your question, we're seeing just as many projects in our minds as we saw before. The one theme I think I've talked to some people about already that we see is when the market cycled in 2015, 2016, there became this huge emphasis on return on capital with the majors and the mid majors and all that. And I don't think that ever went away once that kind of stuck. And so the spending from 17 onwards has been pretty consistent. So I know there's current volatility today in terms of what people are predicting in terms of oil prices, et cetera, and all that. And I, not that I would see it at this point in time, but I don't think that's going to change much of the activity that we see right now, because there's just been a more discipline around the capital project side, which we tend to service here more recently, since I think really since 17. We've just had a steady flow. We report backlog numbers on an annual basis, and we provide color commentary on the quarters. And if you listen to us, what we've repeatedly kind of been saying over the past 2.5 years is that our oil and gas or energy related backlog has been steadily just increasing. And so it's been a very consistent activity from our perspective. Now here more recently, we've gotten some bigger projects. And so, you know, those may taper back. And so you take those big wins, but net still the backlog's growing. So it's been a lot more consistent, if that answers your question. Yeah.
So which of your divisions is most profitable, not in terms of just earnings, but in terms of net?
In terms of what? I'm sorry.
Net.
That would still probably be IPS. IPS would still be the most profitable.
IPS standing for the pumping?
Innovative Pumping Solutions, yeah. Yeah. And part of that's here more recently been driven also by the water, wastewater. So within that IPS umbrella, if you went back to 14, so almost 100% of IPS was oil and gas. You fast forward to today, almost 50, not quite, but just call it 50-50 is oil and gas or energy, and then water and wastewater. And that water and wastewater, you can have businesses that have, you know, 40-50% gross margins, and EBITDA margins in the 20+% range. And so that's really driving not just the sales growth, but also some of the profitability. So, and we believe that water, wastewater can be $1 billion business. And so that's our short-term to medium-term goal. And so today it's, you know, 150 to 175 million in terms of revenue. So there's a lot of runway to go there. So.
What do you think the biggest risks are facing your company currently?
Great question. You know, it sounds cliche, but I would say people. We don't work in a very provocative industry. We're an old economy, blue collar industry at the end of the day. And I was talking to someone, as we get to this size, trying to find people who want to go work in this industry, whether either at corporate or in the field, is very challenging. It's not crypto, it's not Facebook, it's not social media. It's old economy, and it's B2B. It's necessary. It keeps the wheels of industry in motion, but it's not where people think to go. And so I'd say that's one of our biggest challenges. You know, yeah, I'd say that's the biggest challenge. What we do day to day is not rocket science.
Any more questions for Kent? I'd like to ask a question, Kent, regarding your growth driver of M&A acquisitions. How does the landscape, how does the ramp look, and what industries will you be focusing on, say, the next couple of years?
Yeah. So one, Robert, on the last earnings call, we have a pretty full pipeline. So, you know, I mentioned we have 3 to 4 letters of intent. What I would say is that continues to remain the same. And we keep seeing more opportunities. That's also what's unique about our industry, to hit on the last issue from an acquisition standpoint. If you look at the history of the industry, industrial distribution, you have a lot of baby boomers who went into it, who used to work for the manufacturers. Well, if you fast forward to today, a lot of the baby boomers are, if not already at retirement age, are planning on retiring. And so you have this huge generational transfer occurring right in the moment. And so I don't suffer for acquisition opportunities, I guess is the point. And so, you know, I wake up every day and I've got an NDA or something to sign because I need to go filter and look at an opportunity. And so point being is we see tons of acquisition opportunities. And in the current moment, I'm probably in one of the sweetest spots I feel like I've ever been around the industry, and I've been around the industry pretty long. Second thing I would say to answer your question is obviously water, wastewater is a focus, but we're in some senses we're agnostic. Our CEO David Little has always said, there's probably over 300 plus industrial markets in the United States, and we're probably only in half of them, if that, today. And so there's a whole nother set of industrial markets we got to get into. And as we get in those markets, we'll get into different industries and pockets of the United States and of North America, if you will. And so that pie today will look much different 5 to 10 years from now. That's what I can assure you if we execute upon our strategy. We like water, wastewater. We like all the dynamics that are behind that, given what we went through on the oil and gas side. But the reality is some of the companies we buy are just general industrial economy type companies. They could be paper, they could be agriculture, they could be just general industrial. And so we're really agnostic. And so people will see us execute upon acquisitions that, yes, could have a water, wastewater focus, but a lot of other focuses as well. So. We like food and beverage. We like the things that we say that aren't going to go away, that people got to keep doing. and so we look for those things. Even the oil and gas, it's a depleting resource. We need it to keep doing what we're doing in today's world. And so we tend to like those markets because we can see those long term, and you can have a long term view on those things. So
they say lipstick is recession proof too. No matter how broke people get, they will buy makeup. You mentioned your last earnings call. So what did this year look like in terms of earnings? Last couple of quarters.
So let me just kind of fast forward here. So I'll just walk you through it. So Q2 was a good quarter. It was a record quarter for us. It was at $499 million just in terms of sales, and then you can see adjusted EBITDA, $57 million and 11.5% in terms of EBITDA margins. And so sometimes I do get that question of kind of over the short to medium term, where do we think we could take EBITDA margins? And you can see it; it's easily a 12 to 12.5% EBITDA margin business over the short to medium term. Now, some of that's going to depend upon mix and ebb and flow, but that's kind of how we look at it. And so we're run right into the $2 billion that I referenced earlier. You can see return on invested capital is in excess of 30+%. And so, we feel good. We do have some large projects. That's some of the quarterly commentary. We got 2 large projects on the IPS side. One of them is in the Middle East, in Dubai. And then the other one's more domestically based. But we get excited. That's where there's also opportunity. The rest of the world, as they say, if you will, we've been primarily a North American and US focused type company. But as we get bigger, and that's a challenge for us. That's one of the challenges is how do we start thinking about the rest of the world? And we have those opportunities. We did an acquisition B27 many moons ago that got us access to the Middle East. And part of that is starting to pay dividends. We thought about closing that aspect of the acquisition initially, but we stayed with it. And today that's really paying dividends. And we see that part of the world as being a piece of DXP that could be, $100 million, $200 million business, frankly. So.
Okay, well, thank you, Kent, and thanks for joining us. Any closing comments?
No, excited. As our CEO always says, we still think we're undervalued, and there's still an overhang on our stock. But why wouldn't we say that? But no, we love it, and we think it's a great opportunity. And our short to medium term goal is to double the business. So.
Terrific. Thank you very much, Kent. Maybe 10, or not. We've got to reconfigure, retool here for our next presentation, which we'll be very serious about. This is called Curiosity Stream.
Oh, I know the
They're on your app.
Steve.
A very focused National Geographic.
Yeah, no, I know the one.
Yep. fact, I think they're kind of a spin-off of Discovery Channel.
Yeah, well, they were, they used to work at PBS, and they used to have
Oh.
guys on there.
That's it.
I have to watch a documentary on PBS. I'm having a hard time finding it, but I think you can buy it.
Well, the Curiosity Street gives you all, I don't want to do the pitch with the other, they have like a bunch of free documentaries. It's totally.
Oh, yeah. Sure, we'll pass them out. Oh,
Well, I was gonna ask about a price tag.
yeah.
Well, I was just gonna leave them up here and let people grab them.
Okay.
Is there any more food?
Yes. Would you like me to bring you a plate?
Yeah, would you please? That'd
In
that'd
here?
be, yeah, yeah.
Okay.
I ain't going anywhere.
I'll bring you a plate in here. for
Okay.
you. Okay.
Yeah.
I was asking about the price tag.
Yeah. No.
I'll bring you a plate of food.
Yeah.
Okay. Would you guys like a chart?
Serious business.
Mm-hmm.
Before this meeting, we decided to do a lot of sales before this meeting. So about that, yeah. To me, it's like, he seemed very wealthy, and just like, no, I'm just saying. I see the first $9 a share, $4, $3, but even before that, it was still around $3 or something. We buy it, where is it gonna go? They're talking about it was $12. Okay, that's $3. It seems like they pay a dividend once per year as well. And it's like, I don't understand what's any other opportunity. Have you heard about these high yield stocks? I was going to talk to my mom about that. She's been getting like $100 a month. So it's like, it's
Yeah, I like dividend stocks too.
So it's like, how do you-
I know.
It takes money to make that, but it's like, how should I wait for this, like, pay this off? So it seems like, so we didn't make- so what it is, it seems like we never came out, and that's early mid 2023 or so, and they just put it in that, like, this was paid every week. So this is 9 cents, like, yeah, they pay. So what they do, they invest in options. Well, you see exactly the type of business, you know.
So it's not, you're not buying.
That's what it seems like. Yeah, it seems like, yeah, they're like trading, they're doing stocks, maybe they're doing like bonds or something. Different stuff. And yeah, like they didn't kick back this month because it was like, ULTY is one. Another one, and so, and I think it was everyone's there. Anything can happen with these companies. It's paying out. Possibly they just full return within a year or two before they start making money on it.
Right.
No, I didn't think I was gonna listen. I thought I was gonna be like.
What are we doing next?
A virtual. That one went great. Clicker and everything, did good.
Okay. Now we're going virtual.
Yeah. So called Curiosity Stream. A guy named Clint, maybe Clint Stitchcomb or something like that. Clint.
Here you go.
You see a Clint there?
Yes, sir. Yeah, I'm trying to get them right now. Panelists.
Okay, I'll
Make sure you can hear us.
Okay.
Test, yeah. Test, cool. Camera's good. Everybody can see. Oh. Why is that still on?
Can you hear me?
Yeah.
Okay, great.
Clint.
Yes, sir. Yes.
Robert, how are you?
Robert, good. Yourself?
Oh, just rocking the Big Apple. Love it here. You should be here. You're here already.
Hey, I am an old paper boy, Robert. I'm never late.
Okay. Let me cue you up with an introduction and we'll fire up and get you on. So, our next company is a global media company, home to award-winning original and curated factual films. The company has millions of subscribers and covers a broad swath of content, including science, nature, history, technology, society, and lifestyle. The flagship Curiosity Stream SVOD service is available globally in over 175 countries and and on all kinds of platforms. And if you check, if you have an Android or Apple, I bet you can subscribe right now. So we have the CEO, Clint Stishko, with us to take us through the presentation. Our analyst rates it a buy. Our analyst picked up this company a little over a year ago at $1.67. It's done really well, and we think it's going to quite a bit higher to his price target in the next 12 months, $6 and change. So let me hand it over to Clint. Welcome, Clint.
Thank you, Robert, for the terrific introduction. And also with me today is our CFO, Brady Hayden. Brady, you on? Okay, I think you guys need to let Brady in because he's also participating in driving. Yep.
Is he presenter too?
Yeah.
So he's presenting.
Guys, I need to share screen also, please.
So who needs to present?
Brady, I think it's 2 at a time.
All right, let's try.
Joint. There we go.
May I share screen?
Oh,
Please?
Brady, we got you. Yeah. Okay, Brady. I don't think we can get both of you at the same time, or can we?
I'm trying.
We're trying. Do you want to switch back to Clint while we're trying and let Clint get started, or who's going to start the party here, guys?
Can I share screen and while Clint speaks?
Sorry?
I'm driving the deck while Clint speaks.
Okay. So do you want to switch over to Clint? And Brady's got the controls, right? So that's fine. Our vendor, our wonderful vendor, has decided to upgrade, and we're all kind of scratching our heads going, yeah, where's the benefit?
So you want Clint to present?
Clint will present and Brady's going to turn. Yeah.
Yeah, he should get off. Hold on, let me kick this.
Okay.
Brady.
Yeah.
All right, Clint. Oh. I think I might have kicked him. Yeah, they're gonna have to log back in.
Oh, okay.
Yeah. Oh, here you go. No, that's not him. You should shoot him a text to come back in.
Okay, Bobby?
No. Just shoot your guy, Clint, and the other guy to get back in. No, they wanted to be both presenters, and then I put the other one, and then he took precedence of the camera, so I had to kick him. It's all right. As soon as they get back in, I just.
My partner has the controls to them. You're back again.
Yeah. Because he wanted to present, but the other one wanted to handle the thing. So he had the camera, and then I took him off and put the other one, and then the system doesn't, it gets confused. All right, so this is the guy.
So he's speaking.
And
Brady supposedly. Yo te escucho, y tú te voy a dar un mensaje y te escucho hablar.
Oh, but he don't have a camera. You Clint?
Te están escuchando.
Yes.
Do you have a camera on or no?
Yeah. Yes.
Hmm.
I mean, I can see you guys fine.
Yeah, we can't see you.
No, I've been logged on for 15 minutes. So, no.
I went, but I got Braden. Braden came on camera. That's probably why, because we don't see him. And then when I make Braden, he comes in and we see him. So we're just gonna keep it like that until Clint could figure out how to get the camera on.
I do these calls all day long. Like there's no, I don't think there's, well, okay, fair enough. There we go.
There you go.
Great.
You're on. You can see himself.
Okay, great.
The presentation.
Well, he has it, I think. You can share if you have the documents on your end. Clint.
Brady's sharing the document, and I'm.
Yeah, here we go.
Terrific. Great. Thanks, guys.
You guys
And,
see?
we good to go?
Clinton.
I know. I apologize for the clunkiness. Really appreciate everybody making time today. As I mentioned, our CFO, Brady Hayden, is with me as well today. And so we'll clip through the deck, I think, with all deliberate speed. And kindly, please feel free to interrupt at any time, ask any questions. I would love to make this more interactive than just a lecture. So anyway, Curiosity Stream was founded in 2015 by John Hendricks, who founded Discovery Channel and Discovery Communications back in the 80s. He just really has the courage of his convictions around what we call factual content. And so anyway, he'd been working on this for a number of years, launched it commercially in 2015. A lot has happened since then. But just to kind of hit a few of our, most recent highlights, today we've gone from, just an idea that he had to controlling over 1 million hours of audio and video content. We have about 20 million retail and wholesale subscribers, more than 20 million retail and wholesale subscribers across 176 countries. In our last earnings report, we announced revenue of $19 million, EBITDA of $3 million, which is dramatically higher than we were negative EBITDA a year ago, negative EBITDA 2 quarters before this, and then it would amounted to a 53% year-over-year revenue increase. Got a good, solid team of people, and we're ultra focused right now. Next slide, please. And so, as I mentioned, good Q2 earnings. In light of some of the large agreements that we're working on, it's a little difficult to project quarter to quarter with ultimate precision, but we're getting certainly closer to being able to do that. That'll be a challenge, over the next 6 to 9 months, but it's a very good challenge to have. So as I mentioned, 53% year-over-year revenue growth. Our content licensing growth was considerable. That's been a little bit lumpy in the past, but that $9.3 million was powered, largely by AI video licensing for training. We continue though to do traditional licensing deals, and as you can see, EBITDA was negative $1 million in Q2, and $3 million in 24, and $3 million positive in 25. Some of that's due to the way that we amortize content. So there are non-cash issues that affect this. It's starting to even out a little bit more now, and so we'll be positive adjusted EBITDA company for a long time. Next slide, please. So our mission is to satisfy the world's curiosity with premium factual content, and increasingly even certain sports and general entertainment content that informs, enchants, and inspires. Slide. Next. we make money three ways. We have a subscription business that includes retail subscriptions. So anybody with a broadband connection can come to curiositystream.com and sign up for CuriosityStream or for what we call our smart bundle, which would enable people to subscribe to 6 services for $9.99 a month or $69.99 a year. Or people can go to the big channel stores that Prime Video offers, that Apple TV offers, that Xfinity offers, Roku, etc. And then we also have wholesale agreements with various partners outside the world. Many of these are outside the U.S., but we have just recently completed some foundational agreements inside the U.S. And that's with companies like Signal in the Philippines, or Truth Plus in the U.S., or Izzy in Latin America. So that's our subscription business. We also have a licensing business that includes traditional licensing of content. We have 2 series running on Netflix right now, which we like because not only are they a good payer, but it exposes CuriosityStream to just a massive audience. So we'll continue to do that. And then what's driving the majority of our licensing revenue today is content that we are licensing to the hyperscalers and others who are building large language models. And so under key partners, you can just see you'll see a collection of our traditional partners. I mean, it's everybody from Canadian Broadcasting Company to Canal Plus in France to HBO Max, TV1, ZDF, and even Fox Nation. That's just a representative sample. We have probably over 50 partners that we've licensed, or 60 that we've licensed their content to. And then we have a nascent advertising business that's driven largely by third-party platforms. And so what I mean by that is companies like Tubi, like Pluto, Vizio, TCL. So this is nascent. This is a small part of our overall revenue, but it is durable, and it is increasing. And we believe that over the next few years, we can make this a meaningful contributor to the overall to our overall growth in overall revenue. Next slide, please. A few more investment highlights, like what's unique about Curiosity. One is the volume of content that we control. So we control today over 1 million hours of content that we have certain rights to. We don't necessarily have all rights in all perpetuity for over 1 million, but we have the key rights that we need in order to sort of maximize our exploitation here. We have content and data from 250 plus partners. As we are constantly acquiring content for our subscription services, for our AVOD and FAST services, for our pay TV channels, it is not hard to go from doing that to then extending rights from those partners into the AI training space. So we've been successful doing that. We've also just brought on a lot of new partners purely for that purpose. So that's a quick summary of our controllable rights. And then as far as the global markets go, I'm not a big top-down guy. I'm much more a bottom-up guy. But just to provide a sense of these markets that we're going after, SVOD space, $100 billion plus, advertising video on demand, $60 billion plus, and then for content licensing, and this number is taken from a very broad swath of licensing, is over $200 billion. And then as you look at our revenue lines, which I just shared, we have a subscription business that's steady growth. That will grow at, we anticipate mid-single digits over the next several years. And then we have a very high growth business in regard to what we're doing in the AI licensing space. And then reasonably high growth in the advertising side. Next slide, please. It's just a quick look at thumbnails from some of our content. We have high quality content. We've won a lot of awards. You might recognize David Attenborough, who we have a few series from, and he narrates a number of our titles. He's a representative example of sort of the gravitas of hosts and experts that you'll see across our services. Next slide, please. And just a little deeper look at our content library. It includes original content, obviously includes more licensed content, as there's a lot of content out there to license at really palatable rates if you know where to go. We have well over 250 plus content partners today. We've really put our foot on the gas and working to lock up as much as possible, and we continue to do that. We anticipate that we will double the size of our controllable right in the not too distant future. We have content that's in 13 languages, as we mentioned, for the full category of factual, science, history, nature, technology, crime, lifestyle. But we've also expanded into not only outdoor and combat sports, but for AI licensing purposes, we've actually amassed and aggregated a rather large collection of high quality college sports, football, basketball, soccer, baseball, etc., for which a premium amount of dollars being paid today. And I get asked a lot as it relates to the productivity side of AI, or at least the tools that are available to us. What does that look like? Curiosity. So in our case, there's some marginal improvement on the cost side with customer service, in editing, with sequencing. But big driver for us, what we're looking forward to is when the synthetic dubbing gets a little bit better, and when the pricing drops to the levels where we think it will drop, instead of having content in 13 languages, we could have content overnight in over 100 languages, including tribal languages, as an example. And we know that will have an impact on our overall subscriber growth. Next slide, please. Okay. What this looks at is a subscription video on demand space. And so at our core, we've built a strong subscription business, which is not easy to do. That's the biggest barrier to entry. Anybody can launch a FAST channel or an AVOD product tomorrow, or create a distribution company, but it's very difficult to build a subscription business. And I think as everybody's learned, unless you're Netflix, who has escape velocity, or Amazon, who has a broad variety of other businesses, it's difficult to grow your direct subscribers unless you spend a lot of money on consumer marketing, or you bundle with large partners. So like everybody else, we're pursuing a pretty healthy bundling or wholesale strategy, and we're spending we're pursuing a marketing budget that enables us to grow at what I just described, kind of this mid-single-digit percentage growth for the next several years. As far as our services, I mentioned these before: Curiosity Stream flagship, $4.99 a month; Curiosity University, which we acquired through a tuck-in acquisition a couple of years ago, and which we really expanded on, features over 800 lectures and talks from the 200 best professors from around the country, as rated by Rate My Professor, and then also from subject matter experts. Another service that we haven't talked a lot about, but we believe is a diamond in the rough, is Catholic Stream. Again, through small tuck and acquisition, we picked this up, which contains the largest collection of Catholic courses content in any sort of streaming package. So I think we have real upside there. It's very early in building that, but that's $10.99 a month, and it's pretty durable, even though the subscribers are small today. Just as we're doing with CuriosityU, we're beginning to roll that out in more of the big channel stores and packaging it in with certain wholesale partners. We also have the Smart Bundle that includes not just CuriosityStream and CuriosityU, but services like KidStream and Tastemade and Psalm TV, and basically services that program to factual things like cooking and travel and kids content and food and other sort of content categories that we don't completely cover with CuriosityStream. So that's a heck of a deal. If you subscribe to all of those, you'd be paying probably $40 to $50 a month. You can get it all from us for $9.99 a month, and we'll continue to add to that. So it's our premium tier. Look, this is kind of a top-down slide that I think you just look at with just kind of knowing that. Again, we're more of a bottom-up focused company, but obviously streaming is a big part of the overall TV and video viewership today. It's a big market, and people are just increasingly more facile with subscription services. Next slide, please. So this is a slide that provides some sense of what we're doing in the AI video licensing space. As you might imagine, whenever you're working with companies in this space, the confidentiality around the deals and around who we're working with is pretty stringent. Is really stringent. And so, while we're not allowed to talk about any individual companies, this is a sort of representative sample of players in the space who are licensing content to some degree. And so if you look at the CapEx that these guys are all committed to, you look at OpenAI's announcement on Friday of $19 billion going to AI training next year, you can start to back out sort of a TAM for video licensing training in this space. Typically, the way that breaks out is, for the big players, 75% of their overall CapEx budget is going to training. Now, most of that 75% is going to compute and energy. 3 to 5% is going to data licensing, and of that data licensing, somewhere in the neighborhood of 25 to 45% is going to video licensing. So, without being ultra precise, trying to communicate here that the overall TAM for video licensing for AI training is significant and meaningful. And we've been told by a number of partners that we have the best overall corpus in the industry, and I think that's because we have high quality, but we also have the ability now to deliver content quickly, which is important, and we have the ability to structure our data in a way that gives us a significant competitive advantage, meaning we can clip, we can tag, we can index, and we can annotate content at scale in a way that just meets our partners' increasing needs for not only editorial, but how they need it. And so typically, like, as these models can train typically need more than 7 seconds or more. We're cutting clips from into typically anywhere from 7 seconds to 30-second clips, depending on their needs. And we'll do that from 50,000 hours of content as an example. So anyway, just it gives us an advantage. We're really trying to put our foot on the gas here and create, just as Netflix has in the streaming space, a certain level of escape velocity. Next slide, please. And so just to kind of make it a little clearer, like we have our own content, our own original content, but what we learned from throwing ourselves into the marketplace is that in order to generate real revenue, you need a lot of content, because the hourly rates for licensing video for AI training, are just a fraction of what you would find in the traditional media licensing space. And so we're playing the role of kind of using our content as the lead for a bigger, broader corpus. And yeah, whereas I think initially when we started, people were a little suspect of sort of brokers or aggregators, and for good reason, because there were a few people that just kind of popped their head up at the beginning who had started off as a technology company and then thought they could kind of transition to essentially trying to aggregate broker content. So we do this as a natural course of our business. We have the overall quality, and we have the reputation and the ability and the track record now makes all of our ongoing deals significantly easier than when we first jumped into the mix. And typically, the biggest providers, they don't want to work with a zillion different partners. They just absolutely won't. We want to work with reputable companies who control a critical volume of content. Typically, that means over 500,000 hours. Next slide, please. Again, this is kind of a top-down slide, but this looks at the AVOD and FAST market. So we're pursuing this kind of slowly. We have a lot of upside here. We would benefit from having another key person or two that was focused only on growing our advertising business. But in light of some of the bigger opportunities and faster opportunities that are in front of us, we've been allocating the majority of our time, energy, and resource toward subscription and licensing. Next slide, please. This is a look at our FAST channels that we currently offer today. So with Curiosity Now, which is a pure FAST channel. Curiosity Channel is actually a pay TV service that we're paid for around the world in the tradition of the cable business, where we're getting paid a per subscriber fee from cable operators, direct broadcast satellite providers, wireless companies. Curiosity Now, FAST, Curiosity Espanol. We actually have 3 channels in the U.S. Hispanic space. We've since changed Espanol to Curiosity Explora. We have Curiosity Animales, which is just that, animals, and we have Curiosity Automotive, essentially, in the U.S. Hispanic space. And so those 3 channels are not exactly a joint venture, but a partnership with MediaCo, which is the second largest U.S. Hispanic media company. They have radio stations, broadcast stations, and they just have they're really dialed into the U.S. Hispanic media ecosystem. So those 3 channels will make much more working with them, even though we're sharing the revenue, than we would going it alone there. Just since in the last week, we launched Curiosity University Fast, CuriU Fast, and our intent is to stand up another 4 channels before the end of this year in the fast space. Next slide, please. So we talked a little bit about this already, so I won't spend a lot of time here. Good earnings report in Q2. We haven't given year-end guidance, but I think if you look at some of our 8K filings, there's sort of some implicit guidance in there. But the good news is we're up and to the right, and on track to have, if not our best, one of our best years ever, and or certainly our best year ever from a cash flow standpoint. Next slide, please. I'll yield to my partner Brady, but if I could just drive home one thing, that is, we have 0 debt and we have $31 million in cash. I think it's hard to find a company like that. We are paying a dividend, which we have found has brought more people to listen to the Curiosity story. And while we paid the dividend from operations in 24, we will probably not pay all of the outlay in 25 from operations. We may have to dip into our cash reserves a little bit, but our intent is, and our belief is, that we will pay the entire dividend from operations in 2026 and going forward. So, Brady, I'd love to hand it over to you at this point.
Yeah, I'll bring it home, Clint. We've got, as Clint said, we got June 30. We held just under 31 million in cash and investments. And one other point we get asked about is we had some outstanding warrants that were left over from our 2020 D-SPAC. We anticipate those will expire within the next month, and they should expire without any outlay for the company, given the original strike price. Next slide. Here's our reconciliation of net income to adjusted EBITDA for the past 5 quarters. You can see we're trending up and to the right there. For Q1 and for Q2 of 2025, we reported our first positive adjusted EBITDA in the company's history, which correlated with our first positive net income both in Q1 and Q2 of this year. Next slide. And here's a breakdown of what our cash and investments look like as of June 30. Like we've said before, just under 31 million in cash. And I'll finish up by saying we are guiding to 15 to 18 million in revenue for Q2 for the full year adjusted EBITDA of 11 to 13 million. I'm sorry, in adjusted free cash flow, 11 to 13 million for full 2020. Clint, anything else?
I think that's great, Brady. I would just, to the extent anyone has any questions, I have been asked too, like, why has the stock dropped since June? And I can assure everybody, it's not for any operational issues. I think, again, I'm a BD ops guy. I'm not a stock market expert. You got plenty of people in the room who are, but our founder chairman sold some shares in the open market in June to help offset some significant debt that he has. That's public information. And I think as a result of that, it spooked some investors. So, stock dropped from $7 down to $4, essentially. Now, to address this and to make sure we put this behind us, we were able to conduct a secondary recently that enabled our founder to pay down some debt in a more significant way, and give him a little bit of give him sufficient breathing room. So his intent going forward is to be just continue to be a cheerleading shareholder, and with his remaining 12 million shares essentially live off the dividend. Happy to take any questions. Yeah.
Sorry, Clint, what's the cash yield with the dividend and the price right now?
Thanks for asking. It's in the 7% range right now. So I think yeah. I don't know what it is today, Brady, if you're looking at it, but
any questions on your folks?
What's the ticker symbol?
Ticker symbol is CURI. Any questions?
Yeah, 7.24 as of right now.
so I think it's pretty rare to find a growth company who also pays a dividend. But
yes, it is.
Hi, did the Discovery Warner Bros. Merger have reverberations with your content?
no, in fact, it's only positive, because if you look at the way that they're allocating their content spend, it's all going, virtually all of it is going to Warner Brothers Studios. I mean, that's kind of in part why they did that, is they want to, it's Warner Brothers Studios and HBO. So if you are a producer producing content for Discovery Channel, TLC, you're looking for new opportunities now. I mean, a good friend who went from doing, I think, about $32 million a year with them to zero in just a couple of years. So all that means is that they're living off their existing library, or largely doing a few key additional series or additional seasons of high performing series, but otherwise all of it's going to the studio. And it's the same with National Geographic, which is owned by Disney. They are putting their resources toward ESPN, toward Disney, and toward the studio. So it's helpful, actually.
Questions? Any questions? Can you tell us a little bit more about the potential, growth potential and importance of your AI endeavor?
Yeah, thanks for asking. So we started watching all these publishing deals that were getting done at the beginning of last year. Reddit did a $200 million deal, licensed circa $60 million a year with Google, with OpenAI. Following that, you saw deals with Condé Nast, The Economist, The Atlantic, AP, Reuters, News Corp. These were all publishing deals, so all text oriented. We knew that there'd be some kind of video market that followed. That's just the history of the media business. And so, we got in early, have really sown a lot of seed and done a lot of dense work. We have a team that gets together every single day at 11 a.m. to go through, what we're doing on the content acquisition side, how our conversations are going with certain certain licensing partners, licensees, essentially. You don't have, anytime you jump into a new business, there's a little bit of choppy water, and there's a little bit of chaos. It's just the nature of it. But thankfully, the water is getting much clearer, and the clouds are clearing as well. So we said at the beginning of the year that we thought we would have a licensing business this year driven by AI largely, that would be close to half of our subscription revenue. We've since amended that to say that we believe it will be more than half of our overall subscription revenue this year. And what I said in the last call is that we're supremely confident that the revenue that we generate from AI training licensing next year will be greater than what we do in 2020, in 2025. And so, our intent is to build a business that has, really three strong revenue lines. Subscription, which is extremely durable, grows at, I'd say, mid-single digit percentages. A licensing business includes AI licensing, includes traditional licensing that grows much faster than that. And then, meets and exceeds eventually, our overall subscription revenue. And then an advertising business that, in the next few years gets into 8 digits. So not unlike X, where they talk about subscription revenue, licensing revenue, advertising revenue. That's the type of, durable company that we're endeavoring to build.
And get paid 7.24% while you're waiting for this growth. Why these guys are working very hard for you. Well, any final comments, Clint?
I just want to thank everybody for spending time today and taking a look at Curie. And as Robert had said, I believe we're the top performing media stock in 24. We're there in 25, but we have a lot more upside, a lot more growth ahead of us. Especially in light of the fact that I think the stock took that correction since June. So I would say a great time to buy. And the other thing I will add is that we do really work in service of the shareholder, and everything that we do is designed to not add any additional hard costs to the company. And so to the extent that we can do that, we will, and we'll continue to do that. We continue to drive down, at least marginally, our overall cost basis. And even in the new agreement that I just entered into, the employment agreement, I said at the beginning, just don't give me a raise on my base salary. Fix my base salary for the life of the thing, and let's create incentives so that if the company does very well and our shareholders do well, I'll do well, and our employees will do well as well.
Thank you very much, Clint. Thanks for joining us. That's Curiosity Stream. Thank you.
Thank you, Robert.
Appreciate it.
All right, we're going to take 5 minutes to do a technology adjustment. So if you can get in and out in that time, let's do it. Who do we have here? The guy with the mustache. The guy without a mustache. Good to see you,
Robert.
Mr. Johnson. It's a pleasure. Thanks for coming.
You said you have the.
I have it here. That's
Okay.
part of the technology
I
adjustment.
told him I would check for him.
Yeah. So we're live. We're recording all this. So yeah, gotta be a little careful. But about that, that certain information that you're not allowed to say, and you don't, by the way. But I might. So I'm gonna find your thing. I need my guy, my tech guy. I touched this thing and
then
we could be in deep, what?
No, it's okay because I can do it.
You can?
I can do it.
You don't need this. I love it.
I don't need to talk.
No. So how you been?
Good. I was in Washington yesterday.
State? DC?
DC.
Oh,
I
I feel so sorry for
I
you.
had dinner
How was
with,
it?
Mark Rose from Apollo.
Oh, wow.
That was very cool.
Wow. And you didn't get shot at or mugged?
Actually, I was having dinner pretty close to Joe's with the president was.
Oh.
And when I came out, there was a lot of security, and I thought, wow, I'm glad I have it.
Safe.
It wasn't me.
Tagging along. That's great. So,
What do we need? What do we need here?
I can get when you tell me, I'll get the presentation from the email.
We're gonna do it here, or we're gonna do it? They're gonna.
Oh, yeah, we'll do it here.
Okay. So you want to get it from the email?
It's live, and our CEO is here.
Gotcha. So you said from this email, right?
Yeah.
From this one?
So let me search it out. Harriet is her name. Love it. Okay. She sent it. I know maybe a week ago. Who's that guy with that mustache? Jeez. What the heck is going on over there?
The mustache thinks you.
It's amazing. It is.
Don't you think? Doesn't he get the distinguished award for life?
Oh, absolutely.
Courtly gentleman.
I think this is it. I want the P on it. Beside it. Yeah. Does that look like yours?
Yep, that's it.
Uh-huh.
Okay.
Right stop. Wait, we gotta do a couple of adjustments.
Is that the file?
That's, you could probably roll it from here.
Nah, I'm
right?
gonna
Just
download
explain
it.
it.
Download.
Whatever you think, yeah.
Yeah, we should download it.
Might be an old version.
June 24? Oh, hold on. She probably sent a newer one. Oh. All right.
There you go.
Do you see something new?
Right here.
Oh, you have a,
Yeah, that's it.
good eye, good catch, right in front of my nose. There we go. So I just opened it. You can,
This is it?
yeah. Ah, the one with all the healthcare products.
There you go.
I love it. Ah.
What's that?
That's very sophisticated. Nice.
Hold on, give me a moment.
How's the place up there? Did you get out of it somewhere?
Oh, I've been trying.
You should sit with there.
I haven't, I'm leaving on it.
Yeah. But too much to do with tariffs, that extra level.
Oh, I'm going back to China in 3 weeks. China, Malaysia. A lot of traffic. But you know what? It's an opportunity. It's an opportunity because you have weaker competitors, you have disruption. It's okay. Sometimes that's when things.
Yeah, that's where you have.
It's not comfortable, but.
Yeah. Get off your chair. Get up and jump.
Get out of the jungle.
Good. We saw you, we missed you last night. We had a nice little dinner. Yeah, yeah, no, yeah. It's our favorite place.
I told Alicia I'd like to go to San Francisco to do with Karen. They send some scissors out in advance. Yeah. Very
Busy, yeah. I got my business card. The service we use, they just have to, it's like an alien service. It's like, where are the buttons I used to know where they were? Where are they? You know, thank God we have this gentleman here.
He knows.
I think this, is that all right?
This is perfect.
Yeah? Okay.
Look, okay, let me do the intro.
Does he want, okay, you could do the intro here, or then you could do.
Test. Okay, we're rolling. One of our star CEOs and a testament to long-term investing. I'll tell a little bit of a story. Way back when, once upon a time, when we started, nigh on 23 years ago, there was a little company that manufactured and sold scissors in Connecticut. And we thought, well, this company is a little bit off the beaten path, a little bit undervalued. And lo and behold, we went out and visited. And I remember the meeting was conducted in a converted large shower, restroom. So I knew this company was really looking out for the shareholders, saving money. And it became our first initiation. And that was 22 years ago, and it was about $5, $6 a share. Well, I think recently it traded as high as 50, 50, 6 to 50. Just a testament to long-term investing. And Walter Johnson, the CEO of Acme United, is here to tell you about the evolution and the path ahead with Acme United. Thank you, Walter. Up to you with that thing.
Thank you, Robert. Just to be clear, I'm Walter Johnson, Chairman and CEO. And Robert was talking about meeting in the men's room. That wasn't exactly what happened. We were growing so fast that I looked at the men's room and I decided they don't need the stalls. They can go to McDonald's for that. And we turned that into an office. So with that, let me tell you a little bit about our company. Acme United's on the New York Stock Exchange today. Back in those days, not so much. We were on the American Exchange. And back again in those days, we didn't make money. We make a lot of money today. So there've been some good forward progress. We've grown through acquisitions. We've grown through a lot of innovation. I'll give you some examples of that during this presentation. We've had 14 years of consecutive sales records. And that's hard to do. I can tell you because our team has been making that happen, and we've done it. We're positioned, we think, for continued growth. My personal plan, and this is aggressive, and it's just Walter Johnson speaking, is I want to add another $100 million in the next 3.5 years, very profitably. And it's going to be hard. I'll lay out how maybe we can do some of it. Okay, so in the got to do better than that. Here's the corporate overview. So on the right side, that's our traditional business. It was cutting, and as Robert had mentioned, we are the largest scissor maker in the world. So when you go home and you look, you'll probably see a Westcott scissor. Those are ours. You'll see some with gray handles, with yellow inside. That's our branding. Some are titanium. Some of them are non-stick. We sell them at Staples, at Walmart. You'll see them at Amazon. You'll see them at Michael's stores. You'll see them basically everywhere you shop. And that's how you get to be the biggest in the world. We're also one of the lowest cost producers of that product. And because we are, we, in some cases, can set the market. And what that means is when you have things like tariffs and you're the biggest, it's you that people look to, where are they going? And so when we do minor price increases, or in some cases decreases, it's because we're the leader in that field. On the other side, are the companies that we bought in first aid. And we started actually by, what's a kid's scissor? One time, kids' scissors were even all just metal. And this is before I was ever part of this company. But somebody had the idea, well, put them into a little case, sterilize them, and now they're a disposable medical instrument. And so that became how Acme United went from scissors into the medical business. When I took the company over, we were losing so much money in scissors that I sold the only thing that could make money, and that was the medical. And then what we had left was some gauze and tape. We put them in a white box, and we got them placed at Staples. I couldn't believe it. And we were now in the first aid business, and we realized we liked it. And we took the cash flow that we eventually got from the ongoing scissor business and started to buy up first a company called Pack Kit Industrial First Aid, which got us into the industrial market. And what we discovered there was that there are things like refills that are necessary for an industrial first aid kit. Refills being if something's used up and you have a problem at a work site, it's got to be replaced with a refill, so it's a full first aid kit. And as you look at this list, one of the things it did as we moved more and more into first aid is we're buying plants in the United States and Canada that were making the first aid items. And so although I can't say that we thought 10 years ago of leaving China, where we were getting most of our Westcott items, almost by default, it happened because we bought a product line and built on it, the first aid area that was being made domestically and outside of China. And so today, 60%, maybe a little bit more, 65% of the products that we sell are made outside of China, whereas years ago, that was not the case at all. About a year ago, we bought a company called Elite First Aid. And this was really important to us because this product can save lives. You know, most first aid, when you think of the minor stuff, you fell, you bruised yourself, you're bleeding a little bit, you bumped your head, you need an ice pack. But when you've got a serious cut, a serious bleeding wound, an arrhythmia, things where you need to save lives, and you need it in a portable product family, that's what Elite is. And so these are basically medic bags that we are now distributing throughout our customer base. Not always, but today our customer base in first aid spans everything from offices to factories like Boeing and Ford and refineries like Exxon and food like McDonald's. We sell at every Walmart in the United States for their own use, whether that's in a warehouse or it's in an office or in a truck, a delivery truck. We sell to Amazon. And so placing something that can save someone's life in all those locations gives us great leverage, and it's a product that people need. So I'm very excited about this acquisition, and it's been something we've been able to carry throughout our product family. Here's our footprint, and I can read it, but you probably can't. But let me just tell you, on the right it says China, and you can see 4 offices. Then you see Europe, and we've got a warehouse and an office there. And then on the left is North America, and we've got 3 operations in Canada and about 8 or 9 in the United States. And the importance of this is that global footprint. One of the things when you have the challenges we had with tariffs in April is, where do you go now? Well, when you can call your colleague in India, or you can call your colleague in Singapore, or you can call our European colleagues and say, where are we going? Or what are we doing in Egypt? Because we're global, we responded very, very quickly to that. And we benefited. You probably know we had a record earnings second quarter, and that was in the midst of that crisis with tariffs. And that was in part because we do have market power. It was in part because we were prepared. We bought a lot of inventory in advance of the tariffs at prices pre-tariff. And in part it was because we had a nimble workforce dispersed globally. And that's a very big strength of the company. Here are the financial results. So I told you we had 14 years of record sales in a row, and that's part of it. And then 100 million for the first half of 2025. Our plan is to make this another record year, and we have a shot at that. The EBITDA has been consistent except for actually only 1 year, and that was the year when our supply chain was totally mixed up. When you may remember, shipping containers were piling up in Long Beach and LA, and you couldn't get products from China because their whole supply chain went crazy. And the ships that were off of the ports were dragging their anchors and pulling up pipelines. It was a mess. Well, for us, that was a very costly time of federal mistakes, and our EBITDA dropped. But short of that, last year we did a record 20 million of EBITDA, and for the first 6 months of this year, we've had 12 million of EBITDA. So it's another very strong year. And the key thing, in my view, is with that cash flow, it allows you to, frankly, build your balance sheet, do your acquisitions, buy your plants, and continue to finance working capital and growth. The net income was a little bit more spotty, but you can see again in 2022, it was hurt by the supply chain crisis in the United States. We made $10 million after tax last year, and for the first half, a record $6.4 million. Earnings per share followed the net income. We do pay a dividend, and as you can see, we've had consistent payouts and an increase. And when the cash flow supports it, we tend to have another small dividend increase, and that's generally every 6 or 7 quarters. So the growth drivers. This is what an industrial first aid kit looks like. And my guess is there are a number of these on each of the floors in this building. And frankly, if there aren't, then my sales team has a job to do. But you'll see that there are little components. And in each of those little boxes, it might have gauze, it might have adhesive bandages, it may have tape, it may have alcohol, or it might have BZK, some antiseptics. We've done something very special with this. We've computerized replenishment, and nobody has done it other than us, to my knowledge. That box is a critical part of life saving. Let's say it's at a Boeing plant, and it's near some of the machining. Someone hurts themselves seriously, they go for treatment. That has to be filled, right? I mean, there's a problem. By law, it's got to be filled. Common sense says it's got to be filled. The refill is what, if there's a missing part, you put it in there, or if it's expired. What you see on the middle is a first aid kit, and down at the bottom you can see the frequencies. And what this is demonstrating is that we're monitoring inside the box through RFID tags what's missing. And so and this is all patented, and it's a utility patent. We're able to, with each item that goes in that first aid kit, program its RFID for a lot number and also expiration date. When that expiration date is exceeded, it no longer is read by the reader, and it says it doesn't exist. So it captures usage of the component, theft of the component, and obsolescence. And each of those then are aggregated, and it goes to the safety manager. And it also goes, if they want it, directly to us and their distributor. So the next day, a delivery can arrive, and they can refill that kit so that it is 100% complete. The refills are high margin. The refills are critical for maintaining the safety of the workforce, and it's an annuity when properly installed. Some of our major distributors are now taking these, moving them throughout their distribution, and I think it's an exciting innovation in the industry. In addition to the regular first aid boxes, and in addition to the elite medic bags, we also have another station for bleed control. I hope this never happens, but if you get a serious cut and you're bleeding profusely, you can die in about a minute and a half. You need quick treatment. And so we've got solutions for your limbs, for your chests, for your torso, and they're all broken out and they're available. Now, one of the things you may be aware of is there's a bandage called an Israeli bandage. There are other names for it, but these have clotting materials on them. So with a serious bleed, you put it on it and hold it, and you stop bleeding. I mean, it saves an incredible number of lives. And then, of course, we'll also have tourniquets and we'll have chest seals for other problems. But that is really a bandage that everybody can use in an emergency for a cut that you wouldn't have been able to treat 10 years ago. We have a plant in Florida that makes alcohol prep pads, BZK wipes. We're expanding it right now. It benefits from the tariffs because it's made in the United States. And one of the things we do with the alcohol is we put them in lens cleaners. And here's an example of that. So it's going into the Grangers of the world. It's going into Home Depot. Maybe it could be a consumer product like at Walmart. And it's an area that is produced in a medical facility, but we've crossed into the consumer market, taking advantage of our broader distribution. As an aside, the Mednac facility is growing very nicely and is benefiting from the tariffs because the alternative products come either from India or China. And they make excellent quality products in both countries. And our challenge is to make them of comparable quality at a competitive price. The challenge of price has been addressed a little bit with the tariffs. But for us, it's a big opportunity, and there's a global market. So as we're doing automation in those plants, we're eyeing some of the international competition as opportunities. In the cutting area, not only do we make scissors, but we make other things that cut. For example, a utility shear or a non-stick scissor for craft. The green one at the bottom is a box opener. We sell millions of these a year to places like Amazon for their own internal use. And it's got a little ceramic blade that's sharp. So you can open a box, but it's not so sharp that you'll cut a finger off the way you would with a razor-based item. I can tell you you bleed if you do this, moving it across your knuckles, because I demonstrated it once and I found out it cuts. Don't do that. But I still have the fingers. We're in the craft business. We were set back a little bit this year because Joann stores went bankrupt, and we were one of the big suppliers of their cutting tools. And last year we had growth in that area because basically nobody else wanted to sell them because they thought they might go bankrupt. We kind of worked around debtor in possession financing and gained a lot of share, but then it did go bankrupt. We were paid, but now there's a migration to other locations like Michael's Stores, which bought Joann, as well as Amazon and Walmart. So we've got an expansion going on. We got extra placement last year. That collapsed with Amazon, but we're recovering it in other distribution sites, locations. Here's a fun one, the Vibes scissors. So there's something you should know about kids' scissors. Kids in the United States lose them every year. I don't know what happens or why. They can have brothers and sisters. They lose them all too. And every August or July, somebody shopping for kids' scissors and all those kinds of products. I used to like doing that with my son, and it was always something with color or texture. We tried once to make the scissors smell like bubble gum. It didn't work. That didn't work. But here's the attempt this year. A lot of really cool colors and texture. And I don't know where these are, but I'm sure when you look, you'll probably see them at a place like Walmart and Amazon. Here's something that is a quasi-domestic product. A few years ago, DMT became available as an acquisition. It stands for Diamond Machine Technology. DMT makes the best in the world for a flat diamond-based sharpening tool. And it's made in Marlborough, Massachusetts. We put it on its edges so that when you put a blade through, it automatically conforms to the angle on the blade. And then we brought that into the consumer market. The product you're looking at is at Walmart today, and it's an excellent product. The neat thing is you don't have to know how to sharpen anything. You just put it in and pull it through 3 times, and it's sharp. We've got some new distribution this year, and particularly in Europe, with a slightly different looking holder, but interesting product, and it's been doing very well for us. So here's our priorities. Just to continue to grow. You saw 14 years of record sales. Well, I want to do it another year for the 15th. We're driving our e-commerce business. The market share gaining products that we just showed you, among them the smart compliance software that goes into the first aid kits. That's a big growth potential for us. And then, of course, the craft tools are growth and the kids' scissors. We're doing a lot with productivity. And we'll have spent about $6 million on equipment this year to drive out cost. And, you know, those typically you're looking for anywhere between a 2-year and a 4-year payback. And on a return on capital, a 4-year payback is 25%. And it's sort of an annuity. So if you can actually find these opportunities, you're raising your return on capital and you're making yourself hopefully more reliable with less scrap and higher productivity. We tend to continue to increase the dividends on a regular basis, and we are actively seeking acquisitions. So for those who would be interested, this is our headquarters today, and the men's room at the old site has been converted back, and we now have proper restrooms for men. Thank you very much.
Any questions for Walter?
Yes.
Okay, so the 25% is for, you just mentioned 4-year payback and 25% return on capital. That's for like some internal organic growth. What is it for normal organic growth, and what is it for acquisitions?
So the question was, I had mentioned that we're looking for anywhere from a 2 to 4 year payback on capital spending. And, you know, a 4-year payback would mean a 25% return on that investment. What is it for acquisitions and organic growth? It's less. And particularly on acquisitions, because normally when you buy them, you've got to put something in to grow and generate the savings that will eventually come. But we've purchased some companies where we haven't had any accretion at all. For example, the Camillus Knife Company, which we bought out of bankruptcy. But we were able to grow it and then build it. The organic return on capital, I think, is somewhere around 8% or 9%. So clearly the things that we're driving forward with would raise that return on capital. although with acquisitions, it might be delayed until we achieve what we hope for.
And inorganic
Inorganic,
was 8%.
yeah, organic is 8.
And inorganic is how much?
Well, inorganic, again, it depends on what we buy. We bought Camillus, it had a negative return, and we sold that for $20 million and 100 times the purchase. But that's, generally, we're looking for them to help us grow, so. Other questions? Yes.
What other product categories are you looking to get into either through acquisitions or innovation?
The question is, what other product categories are we looking to get into? And some examples of that would be in the first aid area in particular. And I say that because we're now 2/3 first aid, and it's the fastest growing of our segments. And there you can look at it in 3 ways. You can buy competitors. You can buy market adjacencies. So you can, as an example, wound care. There's a lot more we could be doing in wound care. There's a lot of acquisitions in wound care. Or third, vertically integrating, making the items that go into our kits. Med-Nap is an example of that, where alcohol wipes and BZK wipes, which we had been buying from China, we then substituted with our Med-Nap facility in Florida and grew it. And when you buy a vertical integration, if it's one that works according to the way you hope it does, you keep the base business, and then the annuity from your usage and your refills carries it along with extra growth, and then it all works. Believe me, it's not been as simple as it sounds, but that's the idea. Yeah.
Is Q4 gift giving time usually when you have your big boom at the end of the year?
So the question is Q4 usually the biggest quarter of the year because of gift giving? And the answer is no. Yeah, you know, as much as I'd like to say, with 2/3 of our sales being in first aid, I'd love to give you a blood pressure or a bleed control kit. It's just not romantic. So that's kind of hard. But there are a lot of promotions in the fourth quarter. So even though it's not gift giving, for example, with hunting and fishing and areas like that, where and outdoors, there's a lot of first aid that could be put as a gift. And again, you're not going to be very popular if you give somebody scissors for Christmas.
I was talking about cutting wrapping paper.
And with wrapping paper, yes, that's a good business. And sometimes we'll do a promotion where there'll be wrapping paper and tape and wrapping and scissors and maybe even one of our box openers, ceramic box openers. That does work. Thank you.
Are you tapped into the prepper market with these kinds of?
Well, that's interesting too. The question is, are we tapped into the prepper market? For those that don't know what that means, there's a group of people that are ultra preparing themselves for any emergency. And so they'll have things like medical supplies, they'll have food and other items. And we do sell into that market, but there's a lot more that we could be doing there. And the people that are in the, that sell into the prep market spend a lot of time understanding the requirements, getting good products, and they take that segment pretty seriously, as do the preppers. But we're peripherally in it. Well, one more question.
Oh, yeah. So Your current company generates 40% plus from healthcare products?
60,
60.
65.
So you would think the market would give you a higher multiple PE ratio because of that stability and growth over, you know, other pursuits. And with your current valuation, at what price would you accept a buyout?
Oh, that's a very interesting question. So the question was, looking at the valuation of the company and having the first aid business perhaps valued higher than our whole company today, and it's 2/3 of our business, what price would we look at a buyout? Well, let me just tell you what my intention is. The intention, and this is Walter, we're going to add $100 million of sales in the next 3.5 years. It's not going to be easy. It's mostly going to be in first aid. And any premium we would get today would pale by the value of adding 100 million or about 14 million more of EBITDA to our company. And if we're successful in doing that, and you believed you could do it as I do, you'd say, we'll talk to you later.
I like that answer. Sorry.
Question.
Yes.
How much is your business dependent on tariffs, for example? What if those changes? You mentioned India and China to be your main competitors. So
The question is, how dependent is Acme United on tariffs? And if there are further changes in the tariffs, how do we respond and what's it do to us? And I can tell you that's an important question, and we're living it. 2/3 of our sales are produced in some fashion in the US or Canada. Another probably 5% is produced in Egypt. But within China, we are dependent, and we pay the tariffs when they're due. We also have pricing power and negotiating power and, frankly, mix power of products, all of which help to deal with that. But we are truly impacted. Now, you might say, well, why is that? Well, the scissors, what are they? They're steel. So basically, where is the steel made? Half of it's in China at half the price of the global market. So if you're going to make scissors, you might say, oh, I'm making in Vietnam or I'm making in Malaysia. You're not really doing that. You're taking the steel from China, moving it there for processing and back to China. And now it's maybe called Vietnamese, but still China. That dependency is something that, given the market structure of steel, I think we'll have to live with.
Another question right here.
I thought it was really interesting and smart that you added the countertop sharpener to your product line. And I'm just curious what your customers are retailing that for. Do you know?
Yeah. So the question is, we were complimented first for bringing the sharpeners in, we call it Simple Sharp, into the retail market. And it's very easy to use. And the question was, what do we retail that for? And at Walmart, that product is retailed for about $19.99. So it's in a very affordable place.
Last question, anybody? What's the dividend yield and how much do you plan on growing the dividend?
Okay. So the question was, what's the dividend yield and how much do we intend to grow it? So the dividend yield is somewhere around 1.3 or 1.4%, depending on the stock price right now. So it's it's not like a utility company with a high yield. But I can tell you, when people who've owned our stock, and some of them have paid $3 a share, and they're getting that 65 cents in dividends, or 64 cents in dividends, it's a lot. And the reason that what happens is, if you can continue to grow the dividend, you eventually look like you're getting a good yield because you buy at a certain price. Say you buy it at 40, and we're able to increase the thing to double it. Now it's got a 3% yield in, say, a 5 or 6 year period, and your cost basis is still your cost basis. So we have the ability to increase the dividend quite a bit. And as I said, we tend to do it every 6 or 7 quarters because I want to make sure the cash flow is sufficient, that it's not taking away from the acquisitions and the new products and the buying of plants and doing the other things that we do with cash. But over the years, what started as 1 cent a quarter is now, I think, 64 cents a quarter. So, 64 cents a year. So it keeps going.
That's it. Growing that dividend, growing that share price, year after year after year. Any final comments?
Well, I want to thank you for being here today. And when you go home, remember the scissors. Look for Westcott.
Oh, I'm sure I have Westcott.
Thank you so much.
All right. 5 minutes. Fantastic. That dividend. That dividend.
It matters over time.
First started it.
Yeah.
Yeah, it was like 20 years ago.
It was a 10-year quarter.
15, yeah.
16 cents a quarter.
Everything grows.
4 times 66. That's what it is.
No, a lot of times you need that.
Yeah.
It kind of confirms and verifies everything above it, right?
It does.
Yeah, absolutely. Big believer in that. So, keep it coming.
Yeah, I've got some one-on-ones.
Oh,
Right.
I'm gonna drop by and see you real quick too.
Yeah, good.
Yeah.
Okay.
Good time.
Okay.
All right. Help. Where's the tech guy? There he is. All right. We're going virtual. Back and forth. It's kind of like odd and even. We're doing that thing.
So we don't need this any longer.
No.
Okay. Close all these windows. Oh, we needed that. Is the person here? Is the person in here or no?
Jim Marone. James Marone.
Here he goes.
Yep.
This is acting weird. All right, I think we got it now. All right, I think he's ready to go. So whenever he,
Uh-huh.
that's him.
Looks like he's at. Hello, Jim.
He's ready to rock. I guess it gives a.
It'd be good if we could make that. Yeah, yeah, that was right. That's
Is that
wrong.
too big?
No, I think if we scroll from there, at least you can see it. Problem with this whole, yeah,
What do you prefer, that way or the other way?
the other way, I think.
Yeah, and then get rid of this here.
Testing.
It goes right there.
Yeah.
I think we're all good. Let me try something real quick.
Okay.
Is that a little bit better?
Yeah, getting better and better.
Okay. No, okay. Let me keep it like that. There we go.
Okay.
All right.
You good?
You need this one too? You talking from here?
I got this
As long as they don't clash, you're good.
Right.
You'll hear it. And if anything.
All right, well, our next presentation is actually one of our top senior analysts from the Great White North, also a Toronto Blue Jay fan. Ooh, not really, right? Buffalo Bills? Ooh. Jim Maroney, he has been our Northern Light, providing us insights and ideas and performance in the great area of resources, mining resources. And he has been focusing on strategic materials, minerals, gold, silver, rather, rare earth elements, all the things that are so important these days strategically, since we have very little of it. Other countries have a lot of it. So that's kind of the setup. And also AI is a big consumer of these rare earth elements and defense, like B-1 bombers. It's just amazing. These magnetic powers is like surreal, but very much in demand. So, Jim is joining us from, what are you today, Jim? Toronto? Buffalo?
Well, you could say Toronto, but I'm closer. I'm in the Niagara region, so I'm actually closer to Buffalo than I am Toronto.
All right, let's just say the Great White. Anyway, so without further ado, it gives me a great pleasure to introduce our natural resource and minerals and mining analyst, Jim Rohn. Go, Jim.
Well, I thank you, Robert. It's a pleasure to be with everyone today. I wish I could be there in person, but unfortunately, my schedule just doesn't allow it. But I will try to be as engaging as possible, as if I'm in the actual room with you. And yes, I will be discussing a little bit some investment ideas, particularly with regards to the metals and commodities trade. So we've recently issued a report at the beginning of the summer providing an investment thesis regards to some commodities, as well as some names that are in that space, which are very compelling. So what I'll do is just kind of share that investment thesis as to why we think we're bullish with regards to both the commodities as well as some of the names. So let me take you through this report to begin. So it's dated June 6th. Now, typically, something that was dated a couple of months ago usually still applies. But, as you can see over the past few months, there's been a lot of traction with regards to commodities. And it's going to continue this way. So this is one of those rare exceptions where something that you published a month ago is already outdated due to the trajectory of where this space is going. So, but it still applies. There's still a lot of room going forward. So the investment thesis still holds. And they are this, and it's particularly with regards to silver. Now, that's not to say gold is we believe will underperform. Not at all. What we are saying is relatively, we believe that silver will outperform gold just due to the relationship between the gold and silver price. And so what silver really does is gives you a little bit of an added margin of error. So, you know, like anything that's volatile, right? Anything that has had a good run, like gold and silver and the other commodities that have, it could quickly turn as well. So what silver does, given that we believe it's going to relatively outperform to gold, gives you that little bit of added cushion should things go sideways. But the way everything is kind of pointed, it looks like it's still got lots of legs left. Now, here's our investment thesis with respect to silver. Again, number one, with regards to the gold-silver ratio, we believe in a mean reversion. So what we're saying is, you know, maybe gold is kind of at a ratio of 100 to 1. Historically, it's around 50 to 1. So what this saying is, you know, gold can't continue to go on forever the way it has. And so we believe maybe gold will correct in relationship to silver, which provides a little bit more upside to the silver price. Number one. Number two, strategic industrial performance. So, you know, as Robert mentioned, you know, it is used in military applications quite heavily. So, you know, we've been seeing a lot of geopolitical risk around the world, both in the Middle East as well as Eastern Europe. And there's a strong demand for these type of metals in those applications. As well, we hear a lot about AI and data centers. This too is going to require a lot of commodities. We've also been hearing a lot about green energy, EVs and the such. This too is very dependent on commodities, particularly metals like silver or even the rare metals that you hear about. So it also has an attractive relative valuation, particularly against gold and broad equities. What brings me to mind, just yesterday, you're seeing a lot of action in this industry. There was one of the largest merge and acquisition deals between Teck Resources here in Canada and Anglo American. So I believe the new company is going to be called Anglo Teck. That's just a reflection on the movement within this space. Okay. So that's really your investment thesis. So let's kind of dig into a little bit more of the details. I talked to you about this gold to silver ratio. Look at the historical ratios since 1980. So back in 1980, you know, if you recall, it was the end of the Carter presidency. You know, there was a lot of instability at that time. And the ratio was around 29 to 1. And over the, 3 decades, really, up until this current time, like 2024 is already outdated. It's a year ago. It's already 85 to 1. And, with the recent, history, it's closer to 100 to 1. So this is showing you that relatively, gold has had a much bigger movement than it has with regards to silver. Now, again, can it continue this way? So this is, this bull versus bear argument. However, if you are someone that believes in mean reversion, in which things cannot continue to go on forever and outpace the rest of the other commodities or the other sectors, then you're going to believe that, yeah, you know what, there should be a correction to gold and maybe a little bit more upside to the silver. Okay, so that kind of gives you a historical perspective. Now, with regards to the other investment thesis, with regards to macroeconomic drivers, there's been Fed tightening. Inflation has not gone away, okay? It continues to remain sticky. Prices remain elevated. There have been discussions of rate cuts, maybe due to political pressure, as we've seen in the news. However, the Federal Reserve is in a real tight bind because they have this pressure to lower interest rates. However, they still have this monster of inflation continuing to persist in the economy. The inflation premium continues to be outsized by what the real interest rates are, which are around zero or negative, which is not a good omen for things like currency, fiat currency. Added to that, with expanding global debt, particularly US debt to GDP, which exceeds 120%, the credibility in currencies, whether it be the US dollar or the euro, continues to wane. There's also de-dollarization trends between emerging markets. They are continuing to purchase gold and silver, putting upward demand within these commodities. So silver is acting as a dual asset. So like gold, so they do have common characteristics with other metals, that being gold, copper. It continues to hedge currency debasement, but it's also participating in the industrial growth cycle. Hence, we call this a dual asset. 3, the strategic demand for energy transition. So green technology will not go away. There may be short-term pressures with regards to things like EV mandates and what have you, infrastructure as far as charging units. However, this is not going to go away. And again, they're very dependent on materials, okay, particularly metals, whether it's electric vehicles, semiconductors, military defense, as well as solar technology. And so what this chart is showing you on the slide is just the amount of metal, particularly silver, that's required in these industries. Okay, so this is also reflecting, a positive driver to silver price. How much so? They're predicting that there's going to be actually a 30% deficit with regards to silver with respect to its production levels for geopolitical risk. So we could see in the news, expanding geopolitical tension within the Middle East, going beyond, Gaza and that region. Likewise, expanding threat in Eastern Europe, okay, outside of Ukraine. So this is also continuing to put pressure, well, not pressure, but tailwind behind commodities. We see it today, if you're looking at market news today, that there has been a big increase within commodities just today as a result of the news cycle from yesterday. Okay, so there's a positive investment thesis towards the commodity, and with it comes the names. So the names kind of have a lot of traction based on their underlying commodities. However, there's even more upside with respect to the names because the companies usually have leveraged operations. Okay, so either it's financial leverage or operating leverage if it's very infrastructure heavy. So what that will do is any increase in the commodity has a magnified effect in terms of profitability for these publicly traded companies. Okay, and we have a list there too. They're also historically been trading very low with respect to what their book values are. So what the book value tells you is that would be the floor for what these companies should be trading at. So typically they can't go below what their equity value is, and anything is above it. Okay, so historically they've been trading at what their equity value is, but that's no longer the case going forward. Now there are some risks, like any investment. Again, very volatile sector. So for all the people that have been enjoying the upside, it could quickly turn, very quickly too. So it'd be hard to really unwind your position in a timely manner, given the quick movements in this space. So we do have price targets. Now, remember, I said this is a report that we issued at the beginning of the summer. It's amazing how quickly time flies by. We're already in September. It just felt like the summer had just started. So right now it's already trading at around $40 an ounce. So it's in between what our base case of $35 an ounce is to our bull case of $45 an ounce. However, as I said, our bull case is even very conservative at this price. So we believe that there's a lot of more upside to what is currently trading. Okay. Again, I kind of mentioned the leverage positions that the individual names offer. So that might be a good investment idea for you with regards to the names. So Robert, that's really all I have. I just wanted to take you through this report. I thought the report was a very valuable report, and I wanted to share that with your clients and prospective clients.
Great. Thanks, Jim. Any questions on the metal markets for Jim?
There was a slide with 4 company names: Pan American, First Majestic, Hecla Mining. What was the 4th one?
What was the 4th one on that? Yeah, there you go. Let's go back to that.
Yeah, there it goes. MAC Silver. Thank you.
Didn't that get acquired? I think that got acquired, actually, bought out. Jim, I have a question for you. What is the current ratio of silver gold, and how undervalued is it?
Yeah, that's a good question. You know what? I will have to look, but given what the gold pricing, how gold has been priced lately, and given what silver is, then I would estimate that it's in the triple digit gold to silver price.
Wow, yeah. Still a lot of room to close that gap by silver, right?
Yeah, precisely.
So of the two, you'd be a buyer of silver over gold because of that.
Yeah, definitely. Relatively, I mean, they're both going to have both upside, but as an investor, which one would you rather invest in? The one that has more upside than the other, or less upside, right? So this is why our thesis is with regards to silver. Even in the merge, Rob, sorry to interrupt, but even yesterday, like there was the biggest merger in this space yesterday between Tech Resources and Anglo American.
Oh,
and
wow,
that wasn't even a gold merge yesterday. That was with regards to copper.
Copper.
Yeah.
Well,
so
a name you followed is pretty well positioned for a lot of these resources. Your heavy metal guys, Power Metallica.
Right. Yeah, and we do have some names too in our list that specialize with regards to copper. Now, most gold companies also offer copper because it seems like wherever there's an ore deposit, gold and copper seem to coexist with one another. But there are some companies that focus more on the copper side, and then there's some companies that focus more on the gold side. It all depends on what their deposits are.
What are your thoughts and the outlook on uranium?
Now, uranium too, it behaves like any other commodity, really, because it is a resource play. So this too has continued upside, and it has had a great run, and we believe that there's further legs for it to continue to run.
In fact, one of your companies is presenting later today, closing the show.
Yeah, so I'm looking forward to hearing a little bit more of their operations. And
indeed. Yeah. Any questions for Jim on minerals, rare earth minerals, silver, gold? How about some crypto, copper, oil, gas? All right. Well, let's hear it for Jim Rohn from the Great White. Thank you, Jim. Thanks for taking time out. Any final comments?
Thank you, and go Bills.
Go Bills. All right. Yeah, that was quite a comeback, though. Yeah, you have to say. I turned the TV on, as I often do, when it gets like that, and I couldn't believe it. I'm glad I didn't bet on that one. Ooh. All right. Thank you, everybody. We're going to take 5, actually 10. Jim, thanks for giving us 10. Let's thank Jim Rohn. Yeah, thank you. 10 minutes to our next one.
Well, no, I told them that. No, I wouldn't. Oh, I see. No. There's a lunch break.
Particularly fun because first of all, I guess, much time to realize they cast me as old grad. It was really supposed to be like 70. And I remember the another one that came in to be young with me. And she didn't look that much younger than me, but yeah, she had curly hair, big Jewish nose. So, it is. Interesting. Oh, it's trying to be PC. I know you. I know. Oh, yeah, yeah. It's. Did you ever know that? Did you? But that's all you do. So I'm kind of. See how that progresses. It is a big convenience for ourselves as much as.
Yeah. Let's see under one.
Flushing here or taking a while? Yes. And then they come, yeah, it's cheap. And she's got a great deal.
Cheap. Or too much.
Yeah. Yeah. That would be worth my time. You know what?
Marketing manager.
No, I'm not bothering you. I think you're like,
Just coincidentally, our platform, our company changed their whole look and feel.
Okay.
So, and I was marginal on the same end. I'm subbing for our director of research. And so that threw us for a loop. These guys have been
Fantastic.
awesome.
You got to download another file or?
We've got an email, right?
Yeah, well, Mike had said to send it to Robert.Maltby at Gmail.
Yeah. So it's in my Gmail basket.
Is it hit? Oh, Gmail?
Like the last one that we found from Ted.
Yeah.
Not here.
I mean, I just sent it, like literally.
Yeah. So, strangely, and I use Gmail because it's faster than my Outlook, right? Corporate firewalls, but it's slowed down. Maybe it's because I have to buy more storage space. It could be.
I don't know.
Yeah.
But we can also find it at our website if that's faster.
That's faster.
This, which one would it be? This one?
Going to here.
Singular?
No, he sent it to my Gmail, which is over on the, whatever you call that thing. It should be like top of the basket. Not going up. Let's see. There you are. Yeah. You got it. Oh, that one. Yep. Yeah, it's not a touch screen.
This be, yes, this one. This one? Not this
Here
one.
it is, right here.
Okay.
Yeah, there we go. So I'll leave it to you. I'll give you a brief intro and get rolling.
Okay.
Okay.
Okay, we're back. Going to the home stretch. And these are really good ideas, okay? Saving the best for the home stretch. So we're talking about a company that's got very good tech exposure. And when you think tech, you go value? No, you're kidding. But yes, in this case of this company we're looking at, in my view, one of the strongest valuations out there, the lowest valuations out there. Company Phototronics, kind of recent initiation for us. Maybe it's 6 months. They design, manufacture a high precision photomask essential for semiconductor and flat panel display production. Their products, it's very key here, enable the miniaturization of microchips and enhanced display resolution, supporting innovation in AI, IoT, automotive, and consumer electronics. We launched coverage recently and have a $33 12-month price target on Phototronics, symbol POAB, and currently trading in the low 20s. So, and we have Ted Morrow, VP of IR with the firm. And he's going to be starting here pretty soon.
Should I take the microphone or just stand there?
You're probably there. You can use the clickers too.
Use this one?
I think we're good. Yeah.
Let me see.
All your set.
Okay.
Hold on, isn't that it? Okay, it is. It's just like a little delay though.
Advance it manually or on the computer, laptop.
I'll just check it. Hey, this will be you.
Okay.
You want the mic for this?
This one's Mike.
Mic's fine.
Okay.
This one's fine. Okay. Thanks, Robert. Really appreciate it. Yeah, so we make, it's called a photomask for the semiconductor market and for the flat panel display market. I'll get into the products and the technology in a second, but you can see on the bottom left-hand side, you have an individual holding up a sample or an image of a photomask. It's in the semiconductor world, it's 6 inches by 6 inches. It's a piece of glass, and it basically has on the glass what the schematics or of a semiconductor chip design are. So, and then that's for the semiconductor market. For the flat panel display market, the photomask size is say 3 meters wide by 2 meters tall, and in our clean room facilities there, it's too heavy for humans to lift that piece of glass, and so it's a very automated process. But kind of get into, obviously we got the safe harbor, but actually this doesn't, we're going to do this way, the old-fashioned way. There we go. All right, so just a little bit of, just a quick overview. Numbers there are trailing 12 months. Generate a lot of very strong cash flow out of the company. Headquartered in the United States in Connecticut, right up the street. And then we have, on the bottom left corner, you see revenue by geographic location. And that's really, out of the facility's origin. So, for example, we have 2 facilities in China, so 26% of our revenue originates out of China. And within that, all of our production in China stays in the China market for customers in China. In Taiwan, a decent portion of our Taiwan production, so a third of the total revenue, actually ships into China. So our China exposure is relatively high. And then on the bottom right-hand corner, you see that, we break out revenue. Actually, we'll get into a little bit more detail momentarily, but we have various categories of high-end versus mainstream, and it's about a 50-50 split, high-end being more leading edge on both the semiconductor side and the flat panel display side. One of the things that I want to highlight is, we have 11 clean room facilities throughout the world, 3 here in the United States, 6 in Asia, which includes 2 in China, 1 in Korea, and 3 in Taiwan. Having facilities strategically close to your customers is a huge advantage in this industry. Our lead times tend to be about 1 to 3 weeks, and then we win business and sometimes we lose business because we can quote turnaround times of about 24 hours. And so having facilities very close to customer locations, obviously you're gonna reduce your shipping time, and so that's a huge strategic advantage for us. So what is a photomask? And as I was kind of saying, with that earlier slide, so we break out revenue, semiconductor, on the semiconductor side and the flat panel display side. Semiconductors is 3/4 of the business. And there, what happens is we take a piece of glass, and when we receive the semiconductor chip design instructions from our customers are a lot of times manufacturing facilities. So Samsung, Semiconductor Manufacturing Incorporated, which is based in China, United Microelectronics, they're based in Taiwan, Intel, Taiwan Semiconductor, Global Foundries, Texas Instruments, any semiconductor company with a manufacturing operations, they will send a semiconductor chip design to us. Our engineers will convert those instructions into a software program that we insert into our clean room facilities. At the clean room facilities, we essentially shine and write onto the piece of glass what those instructions are. So when a semiconductor chip is being designed, there's multiple layers to complete that entire design. Every layer of a semiconductor chip requires 1 photomask. So one chip design will wind up with, say, 20 masks, 30 masks, 80 masks, 100 masks, depending on the complexity of the semiconductor chip. So every layer requires 1 photomask. So what happens is we create we essentially print and etch onto the glass the chip design, create the photomask, create the photomask set, ship those out within 24 to 48 hours off to the manufacturing facility. In the front end of the semiconductor production line, our mask is inserted into a lithography tool. If you've heard of a company called ASML, they're the market leader on lithography in semiconductor production world. So our mask is inserted into the lithography tool. Laser shines through a laser light beam shines through the glass and essentially projects the semiconductor design onto the wafer, and it actually shrinks it down into a very miniature size. Then the wafer gets cleaned and polished, and it comes back, and you insert the next layer or the next photomask, and essentially print the next layer of chip design onto the wafer. So you go through that entire process, ultimately creating the semiconductor chip or the integrated circuit. The wafer gets diced up, and now you've got a semiconductor. Very similar thing happens on the flat panel display side, where we received the schematics of the design of a laptop, the screen of a smartphone, tablet, even a TV. And for a TV that's say 70 inches, a 70-inch screen TV, yeah, you need a photomask that's 70 inches big, right, or at least 70 inches big. So the photomasks on the display side can be very big. And here again, it's the light shines through the mask and onto the piece of glass that ultimately becomes your display for your electronics device. So again, it's 3/4 of our business is on the semiconductor side, and about 1/4 is in flat panel display. And then within, I had mentioned earlier, we break up revenue between high-end and mainstream. In the semiconductor world, our high-end business is considered, for those familiar with the semiconductor world, is considered 28 nanometers, 22 nanometers, 14 nanometers, and we do a little bit of production at 7 nanometers. So those are all dimensions of semiconductor chip design, and it's a measurement of the distance between transistors within the semiconductor chip. And so today we hear a lot about NVIDIA GPUs, right? All the rage on artificial intelligence. NVIDIA GPUs are a lot of times being designed at say 3 nanometers, 4 nanometers, 5 nanometers. Well, if our high-end revenue goes down to say 14 nanometers or maybe 7 nanometers, how does that relate to an NVIDIA GPU? Well, the history of the industry is, as the semiconductor industry was being developed 50, 60 years ago, most of the photomasks for the industry were in-house at the manufacturing operations. And then along comes merchant suppliers such as Photronics in order to capture some of that business. Eventually, merchants became big enough where about 50% of the market, of the total photomask market, it was about 50% of the market became merchant supply in 2010. Since that time, it's kind of evolved to where it's actually skewed back towards the captives, where captives now are at about 63% of the total merchant supply of the market. And I'll get into a little bit why that is shortly. So why invest in Photronics? So as I said, we're a market leader of photomasks into the semiconductor industry today. It's a very critical product for the manufacturer of chips. The market size is about $6 billion today. Of that, as I said, it's about 63% of that market is captive. The remainder is merchant. Of the merchant market on the semiconductor, this is on the semiconductor side, we are about 1/3 of the market, 1/3 of the market share of the merchant market. And there's another player that's a little bit bigger than us, and so combined we're about 70% of the global market. So it's for all intents and purposes, it's pretty close to a duopoly. In the United States, the market share is even more concentrated between the two of us. We actually have a little bit more favorable market share. Combined, we exceed about 90% of the U.S. market, which becomes very interesting when we think about the reshoring of semiconductor production into the United States. We hear a lot about, with the current administration in the White House, about bringing manufacturing back into the United States. It is very, very true and very much happening in the semiconductor world. In December this past year, we announced that we were going to expand our production capabilities here in the United States. Again, we have 3 clean room facilities here in the United States. One of them in Allen, Texas, which is a suburb of Dallas. We're expanding capabilities into what we consider 40 nanometer and 65 nanometer. And you think about, okay, well, then that's not your high-end business. Well, true, but some of that business that we are manufacturing out of our high-end facility up in Boise, Idaho, we are transitioning to our facility in Allen, Texas. The reason that's important is because then that frees up our high-end capabilities and capacity in Boise, Idaho, to take advantage of what's happening here in the United States. And what is happening? Well, Taiwan Semiconductor, which is the largest manufacturer of semiconductor chips in the world, is expanding very aggressively in Arizona. They expect, or at least they've come out and said, that by 2030, they estimate they're going to have about 1/3 of their global high-end production occurring in the United States, from like a couple percentage points today. So a very aggressive shift by Taiwan Semiconductor to bring manufacturing into the United States in the semiconductor world. Global Foundries is going to spend $15 billion over the next 5 years to expand manufacturing in the United States. Texas Instruments is expanding very aggressively in North Texas to expand their manufacturing capabilities. So we're seeing this massive semiconductor reshoring of production into the United States, which is very exciting, for us being a market leader and a big supplier into the United States. As part of that, we do talk about captives outsourcing more. And so I talked about earlier, okay, the semiconductor industry was about a 50-50, or at least the photomask portion of the market was about a 50-50 split between captives and merchants in 2010. And it's kind of progressed to about 63% on the captive side. We do think that the merchants, because of this reshoring of production into the United States, we do think the merchants are going to capture a little bit more business in the future. And that's because as Taiwan Semiconductor is expanding here in the United States, well, they don't have a mask operation, photomask operation in the United States. They do all of their photomask production out of their facilities in Taiwan. And so because time is of the essence and shipping costs and whatnot, does it make strategic sense for them to create, to capture, to bring photomasks from Taiwan into the United States for semiconductor production here in the United States? We don't think that that's the smartest move in the world. Obviously, we're a little bit biased, but we don't think that that's the smartest move in the world. And so we are prepared and we are in conversations with them in order to handle more of their production here in the United States. Nothing, confirmed yet, but we're hopeful that that something like that, that they'll be outsourcing a little bit more. We're also in conversations with companies like Intel and Samsung, which are existing customers today, to expand more aggressively into or to take on more of their business. We also talk about node migration as being beneficial for our industry and for us in particular. As I said earlier, sometimes a semiconductor chip design will require 20 masks to produce a semiconductor chip design. Sometimes it takes 80 or 90 or 100 masks. And as you go into smaller and smaller geometries, more of our higher end business requires more masks. More masks equate to a greater revenue profile for us. So that's a favorable trend that we see happening. And then on the display side, we see more higher end masks being required for more advanced screens and more advanced capabilities. Some of the things that we're seeing on the screens, for smartphones today and for tablets today is, lighter screens, because we're hearing a lot about foldable phones today, right? Well, a foldable phone, you basically have a screen on one side of your device, and then you open it up and you have essentially 2 additional screens. So the lighter the glass is, the lighter the phone's going to be, right? Because I think, it appears to me that the initial phones on the foldables are quite heavy, right? And that nobody wants a heavy phone, right? So so that's an important technology advancement that's coming down the pipeline. Also, things that they're working on, or that we're going to help with our photomasks to help that the industry is working on is, I don't know about you, but my eyesight has really deteriorated over the last several years, staring at my smartphone and tablets and whatnot. And so they're actually working on screens that are actually going to reduce the strain for eyesight, which I think will be beneficial for everybody, right? And then So those are some of the advancements, and why I invest, from a technology capabilities perspective. Operationally, we're very good at what we do. We're very, we have very streamlined organization. We don't spend a lot on OpEx. It tends to be about 10 or 11% of total revenue. And we generate a lot of cash flow, which is always a good thing. And so really it's all about new chip designs as far as, what's going to drive revenue growth in the future. And obviously, semiconductors, the end market is anything that requires a semiconductor, whether it's consumer electronics, automotive market, industrial, aerospace, defense, runs the gamut. And it's not as much about wafer starts or wafer fab equipment spending. It's all about semiconductor chip designs, which makes it harder to track for the investment community, just to see, what's coming down the pipeline for new chip designs. But you can rest assured that we pretty much, our revenue trajectory tracks it pretty closely. And we talked a little bit about the reshoring of semiconductor production. I don't need to go into much more detail about that. But this slide talking about node migration, which I mentioned earlier, really gives you a feel for the value of a photomask as you get into more leading edge. And so I mentioned earlier, okay, we don't produce a lot of masks today at 3 nanometers, or we don't produce any masks at 3 nanometers, 4 nanometers, 5 nanometers. The bulk of the masks that we produce today, are in the 22, 28 nanometer, 40, 65 nanometer, and 90 nanometer range. But as you get into these more advanced photomasks and the more advanced chip designs, the value of the mask increases exponentially. The reason for that is to produce an NVIDIA GPU today requires a technology called extreme ultraviolet technology. ASML produces or manufactures the lithography tools for that capability. One lithography tool from ASML costs $300 million. So a fab at TSMC, Samsung, Intel, obviously it's going to be hugely expensive to create chips at those geometries. And because of that, there's a fairly high correlation on the costs of producing a mask at those geometries. So in a let's say a 5 nanometer chip design, let's say requires 80 layers or 80 photomasks, and you actually in that photomask set likely it's about a third of those masks will require EUV capabilities. The remaining 2/3 actually don't require EUV capabilities. So what may be happening is, we could go to TSMC and say, hey, we will produce some of those non-EUV masks at say 28 nanometers for you, which would probably be about 60 masks in a total, 80 mask design set. And then TSMC will say, okay, we'll handle the EUV masks, the remaining EUV masks. And so, that could open up opportunity for us at say 28 nanometers to handle some of those capabilities. Or, conceivably down the road, and we are expanding our capabilities into more higher end, we could, ultimately capture that, 7 nanometer, 5 nanometer production, but that's going to take some time. Another example of the difference in mask value. So Photronics is the #1 supplier. I know I talked about the market shares earlier, but we are the #1 supplier, and those were from a revenue perspective, but we're the #1 supplier from a units volume perspective globally, and that includes the captives. And so on the semiconductor side, we generate about $600 million in annual revenue. If I was to take Taiwan Semiconductor's photomask operations, their internal captive operations, and isolate that business and separate it out from Taiwan Semiconductor, that's probably worth about $3 billion in annual revenue. So 4.5 times larger than we are. And that's because they produce, it would probably be about 75 to 80% of their masks are at 3, 4, 5, 7 nanometers today. So that gives you a sense for the cost required and obviously the value of masks at the very leading edge. Obviously, we want to get there, but we're in a capital intensive business. It doesn't, we don't install an EUV tool from ASML that costs $300 million. We go out of business pretty quickly. The tools that the equipment that we install into our clean room facilities range anywhere from, say, 10 or $15 million up to, say, 40 or $45 million. Not nearly as expensive, but for us, it's still quite capital intensive, which is a double-edged sword, right? It's great because it limits new entrants coming into the industry. On the flip side, it's capital intensive. And so, while we generate a lot of cash flow, we spend a lot on CapEx. I talked a little bit about the display business, with the foldable phones and whatnot. One of the things that I'll say on display is Photronics is very good at creating photomasks for the display market. Several quarters ago, we started shipping our more advanced or next generation photomasks for what's called AMOLED Generation 8.6. The customer that we were shipping to has its own internal mask operations, and they decided to go with us because we could do things we had better capabilities on creating masks than their own internal operations, and that's it's pretty impressive because considering that that customer is a very well-known semiconductor and consumer electronics company based in Korea, if you understand who I'm talking about. So, again, why do we win? It's high quality, operational excellence, being able to ship, your photomask set out at a very rapid response time. We call it cycle time, within 24 hours. Those are really the reasons why you win. And we have a global footprint with 11 clean room facilities throughout the world, and we're expanding our capabilities on the technology side. Over the last several years, we've grown pretty well. In 2019, about 3% of our revenue originated out of China. Then again, you go to that chart on the page 3 or slide 3, one of the first pages that I showed. We're at about 25% of total revenue coming out of China today. So have grown very significantly with our China operations. And then, when COVID hit, the supply chains were very disrupted. We, again, I think I quoted earlier that we have 1 to 3 week lead times. During COVID, our lead times exploded up to 4 to 5 months. It was during that time that the customers, the semiconductor manufacturing facilities, realized the critical nature of photomasks, because if they didn't have photomasks, they couldn't produce a single semiconductor chip. And so our pricing power really improved during that time frame. So that really helped not only our revenue trajectory, our gross margins improved from the low 20s into the mid 30s, and obviously helped generate pretty significant cash flow. As I said, capital intensive industry, we're going to spend about close to 25% of revenue on CapEx this year, fiscal 2025, October fiscal year end. We've said for next year, we're actually going to undertake it's going to be another investment year. So while the last 5 years, 2020 through 2024, we averaged about 15% of total revenue was spent on CapEx. For 2026, we didn't come out and exactly say what our number is going to be, but we did say that, okay, we started a process of expanding our facility in Allen, Texas, that began earlier this year. And so because of that, our investment in CapEx is elevated in 2025. That's going to continue into 2026. On top of that, we're going through an end-of-life tool replacement cycle. So basically, over the course of our history, we've been very, very good. We've actually excelled at extending the life of equipment far beyond what our competitors have been able to do. Competitors have told us that, actually they're trying to figure out what our secret sauce is and why we've been able to do it, which is great because you don't have to buy equipment as frequently. But now we've kind of come up to this time frame where all of a sudden we have a lot of end-of-life tools that we have to go through and replace. And so we're going through this cycle that's going to last about 3 years of elevated end-of-life tool replacement costs. So part of that occurred in 25. It's going to continue into 2026. And then on top of it, we are expanding into our capabilities in one of our facilities in Asia. And so what's happening is, I mentioned 25% of our revenue originates out of China today, right? And I talked about the reshoring of semiconductor production in the United States, but also, the whole industry, because of COVID, is trying to diversify itself away from or move production out of China. It was way too exposed to China. There's another factor that is at play. The Chinese national government is trying to essentially create its own self-sustaining semiconductor industry. And as part of that, a number of years ago, actually around the time that we entered into China, the Chinese national government started subsidizing startups in China. And so we see that today, we actually see those players largely participating at the 90, 130 nanometer geometries. And so we do see pricing pressure at that part of the market. It's not a big percentage of our China business today. The bulk of our China business occurs at 22, 28, 40 nanometers today. But we'd be foolish to think that at some point down the road, we don't know, maybe 3 years, 5 years down the road, those Chinese startups probably start to encroach onto our entrenched position here at 22, 28, 40 nanometers. And so what we're doing is, obviously, we're expanding here in the United States. We're also expanding our capabilities at one of our facilities, not in China, to expand capabilities to support some of our customers, particularly in the Korea region. And so what you're going to see, or what we're trying to see, demonstrate over the coming years is, yes, while we do see this risk, we're going to continue to generate revenue out of China. We're going to continue to generate cash flow out of China, but we're not sitting still, and we're going to try to evolve our geographic profile and our revenue mix to diversify away from China. If you took the China market, and I said, about 25% of our business is generated out of China today, but we do have 2 facilities there. One's on the semiconductor side, one's on the flat panel display side. And if you took, if you're to dissect into, what the breakdown is, it's pretty close to a 50-50 split. We do not see the startups on the flat panel display side in the China market. It's only on the semiconductor side. And so that gives you a sense of, how much exposure we have to the China semiconductor market, where we do see the increasing competition. And so that's why, it was kind of a lengthy description of, conversation about, what we're doing and why we're doing and why we're expanding geographically into the markets that we are. So real quickly, I think we have, maybe about 10 minutes left. Do I have that right?
Yeah.
So real quickly, just kind of summarize the current environment that we're in. It's been a little bit of a stagnant environment. Again, we grew pretty significantly, coming out of COVID for the last several years. China was a pretty good contributor to the revenue growth. And then over the last, I would say, 12 to maybe 18 months, revenue slowed down and has continued to slow down for a couple of reasons. One is, again, we're not really participating in the, in the AI data center semiconductor world today, right? And that's where all the growth in semiconductor world is coming, right? NVIDIA's knocking, everything out of the park. Broadcom, Coherent, you name it. The rest of the semiconductor world landscape, Texas Instruments, Infineon, On Semiconductor, ST Micro, Microchip, a little bit more sluggish, right? And that's very reflective of our business over the last, say, 12 months. On top of that, there's been the tariff issue and the whole geopolitical landscape that has also kind of stagnated our business a little bit. If you think about a semiconductor chip company, XYZ, and they have a choice of manufacturing a chip in the United States with, say, global foundries or off in China, depending on where they're going to ship their product to. If they're not certain what the tariff landscape is going to look like, because tariffs still haven't been finalized, at least with China that I'm aware of, since they don't know what the tariff costs are going to be, they're not entirely certain they know exactly where to manufacture the product. And so we've seen a little bit of the slowdown in the release of new semiconductor chip designs because of that. So that's kind of impacted our business a little bit. Yet we still generate gross margins in the low 30s, which is much better than we have in the past. And so we've seen there's been a concern with our business. Okay, how sustainable is this gross margin improvement that you've seen over the last, say, 5 years? It's been about 3 years the last 3 years where we've been able to generate gross margins in the low to mid 30s. And so that's been, pretty consistent. And then on top of it, ever since, or I would say in the last, starting about 5 or 6 years ago, we entered into long-term sales agreements with customers. And within those long-term sales agreements, anywhere from 1 year to 3 years, and have continuously rolled over and been renewed. We've had pricing agreements established in those sales agreements, and we've not had very significant changes in the pricing environment on those long-term sales agreements. So that's pretty important to understand for the gross margin profile. This goes into the product mix, which we kind of talked about earlier, and then I'll talk a little bit about the balance sheet, because everybody always wants to understand what's going on with our cash balance. $576 million of total cash and short-term investments, which you need to be aware that 69% of that balance is associated with 2 joint ventures that we have. Getting back to that geographic presence, one of our joint ventures is in Xiamen, China, so on the China semiconductor side. Another joint venture is in Taiwan, also on the semiconductor side. So those 2 joint ventures, both with the joint ventures with a competitor called Dynapon Printing. Dynapon Printing is not allowed to compete in both the China market or the Taiwan market. We have full operational control. It's a 50.01% ownership for Photronics. So full operational control, full decision-making control, full financial control, consolidate all the financials into all of their financials into our financials. So that's important to understand. And obviously they've been generating, those 2 facilities have generated a heck of a lot of cash flow over the last several years. And so that's why, a good portion of the cash balance is tied into those joint ventures. Over the last 3 quarters, we've repurchased $97 million worth of stock. Did so very opportunistically. It was about $73 million occurred in the April quarter. Took advantage of the financial market volatility that had occurred. The board has authorized an additional $25 million on top of the $3 million that was remaining. So there's $28 million now on the repurchase authorization. I'd say that from here, given the capital intensity that we're expecting over the next couple of years, for us to repurchase any more stock, it's going to have to be probably be very opportunistic from here. Yeah, and then the last slide is basically, the guidance for our October quarter. But I think I'll leave it up to see if there's any questions because we have a couple minutes remaining. Yeah.
Oh, yes, I seen maybe you had about 20 million plus in debt and then about 600 something million in revenue on the other screen. Is that at 20 million in debt?
So that was a year ago. We had 20 million of debt in the year ago quarter, July quarter. So in the July quarter this past year, we're basically down to almost zero debt, almost debt free.
What about Intel? What did you make of that, and how do people feel about the government, bailing them out?
Well, it is, a weird situation for us Americans, right, where the government's taking ownership of a private enterprise. Although we did see it, 15 years ago, or almost 20 years ago, in the financial services industry as well, right? But so it's not unprecedented. But obviously, free markets, you don't really want the government to take it over. At the same time, Intel for a good 10 years has really dropped the ball and fallen behind TSMC. And so, the question is, does the investment help solidify Intel's positioning? It sounds as though the government doesn't want Intel to divest its fabs. It sounds like that's the primary purpose of it, because Intel, or the government, does run programs through Intel's fabs, and they want to make sure that it's doesn't fall on the wrong hands. And so that sounds like that's the justification for it. Well, the way we look at it is, hey, Intel's a customer of ours. If it helps them get healthier, that's a good thing. Yeah.
So Ken, if you take out the AI,
yeah,
and I don't know what else, maybe some select telecom, what's the base growth rate X that?
Yeah. I mean, I guess I could hide behind well, it depends on the semiconductor chip design starts, but nobody knows what that, or at least most people don't know what that is. I guess what I'd say is there's market research out there that indicates, so I've been saying, we've been in kind of this sluggish environment for the last, year or so. Market research is projecting that, at least for the markets that we're serving, the non-AI data, hyperscale data center environment, it's probably going to be several more quarters of sluggishness. And probably looks towards the second half of 2026 before things start to pick up. That coincides pretty well with artificial intelligence transitioning towards end user devices, whether it's the smartphone or a tablet or robots or the automotive market. So as chips are being designed for AI at the edge, that would be a good catalyst for us, which we think probably coincides pretty well with the timing of that report. So it's we'll see how it plays out, but that's kind of how it feels like at the moment.
Do you produce human chips?
I'm sorry?
Do you produce human chips?
Human chips?
Yeah.
What's a human chip?
Biohacking.
Well, again, we don't produce chips. We produce photomasks that enable the manufacture of any semiconductor chip, except for the very leading edge. That's at 3 nanometers, 4 nanometers, 5 nanometers. So any other chip, at 14 nanometers and beyond, and older, yes, if it's a semiconductor chip, we probably produce a photomask for it. I'll let you go first. How about two more? We'll go fast.
Does China have any issues with you doing business in Taiwan and vice versa?
No, because a decent amount of our Taiwan business ships into China, so that's good. There was this past summer, one of our customers, Semiconductor Manufacturing Incorporated, was added to a not what was the not a banned list, but almost a banned list, where Taiwan placed them on it was a restricted list. Taiwan placed Semiconductor Manufacturing Incorporated on a restricted list. SMIC is a Chinese-based company. And so that actually caused us to move some manufacturing around because previously we were shipping out of our Taiwan facility into SMIC. Well, now we had to move all that production over to our Chinese facility to ship into SMIC. So it caused some challenges for sure. You worked around them, and that's the advantage of having global operations with facilities in various countries, right? Where you can offset and kind of diversify or move away from any restrictions.
And one more question. Yeah, I was gonna ask, how much cash flow currently, how much cash on hand may your company currently have? Like, in general, like some companies will mention they have like thousands of millions of dollars.
Yeah, I mean, if you look at, I think, our operating margins are about 25%, and then take out the cash flow or the CapEx. So you're talking 10 to 15% of revenue is free cash flow. So on a $800-something million business, you're talking about $100 million of annual free cash flow.
So you can pay off that debt easily. It's just there because of the books or something. Well, you already paid off the 20 million.
Yeah.
100 million.
Yeah.
Well, thank you, Ted, and the presentation for the
Thank you very much.
Right. I think we got to run right into the next one here.
Yeah, sorry for taking
a long
a little longer.
But now, thankfully, it's live to live this time. We don't have to mess around. Okay. Do we need our tech support guy?
Probably. I have it on my computer.
Do we need our tech support guy?
Let me find here. Let's see. Just
a deranged person. It just happened. He got shot in the neck.
It doesn't
look good. It's really sad. And deranged people.
Yeah, they got that. He's like a friend. Last flight I inserted into it. And so light shining through glass. This could
Fight back. I don't think there's ever been a conservative that has attacked a liberal like this. So.
There hasn't been anything. We don't know anything about this. So it's been something
No, that's PowerPoint? No, I just have it online.
Oh, it'd be easier if you could just send it over. Is that possible?
Yeah.
Yeah, you could attach it. It's just because everything's been. Want me to send you guys email? Or I could send you an email. You want to reply? Hold on.
What's your email?
This one says Robert at Singular Research.
I have Robert at Gmail. Robert Maltby at Gmail.
Let me see if he has them. I guess Maltby.
Yeah.
I guess you could send it to that one. I have that one accessible here if you want. Just because we got another speaker, and then to just rewire everything and just be.
Is that quick?
Yeah, I'm just waiting for the email to come in.
Okay. What's your stock now? $3?
$2.
$2.
It's trading right at asset value. As if you wouldn't have any, like it doesn't, if you were just to blow the asset down of the production, that's
Yeah.
what it's worth. It gives no credit to any drilling that we're doing. It's oil and gas. Doesn't give the best multiples. What's another email that I can send it to?
Robert at Singular
Robert.
Research.
Try robert.maltby, MALTBIE, @gmail.com.
That's the one I just sent it to.
Is that
Well,
what you said?
well, actually, yours says there's no dot in it, but
Well,
you would know
I
better than I
received
do.
emails from that
Oh,
one.
yeah?
Yeah. Try this one right there.
Who?
Yeah.
What I mean?
I mean that one.
This one?
Yeah. Yeah, the inbox. Just send it.
Is there another one that I can send it to?
Send it to the same one. It should be there, but maybe it went to junk. Did you just, how long ago you sent it?
2 minutes ago.
Oh, 2 minutes ago. Geez, it may not even be here yet, the way it's going with this. Did you send it before, like yesterday?
No, I thought, because last time I just plugged my computer in. What's the other one? Robert at what?
Robert.maltby, MALTBIE, @gmail.com.
Well, that's the one I sent it to. Is there another one I can try?
Yeah, Robert at singularresearch.com. Gmail sure has gotten slow. Maybe it's because I need to buy more memory space. It just never used to do this. Oh, wait a second. Now I'm in the wrong email box. There it is. We got it. We got you right there. Yeah. Goes in the wrong email. Jeez. Too many phone numbers, too many email accounts. How's your last name, Chris?
Plugsma. Just to say Wabi. It's easier. Plugsma. Wabi Plugsma.
Screen.
Go.
Yeah. 1, 2, 3.
Okay, we can't go a full session without looking at a dynamic opportunity in oil and gas, right? Oil and gas. This stock literally is trading at book value, liquidation value. That's how tough this industry has been lately with oil prices weak. This company, very unique, Prairie Operating Company, symbol PROB, trades at about $2 a share now. And our price target is well over 10, to put things in perspective. It reminds me of that period of time where they literally were paying to get the oil taken away from the barges, like in 2015. In other words, it was like giving oil away. There's so much of it.
Or when it went negative.
When it went negative, right? So, valuation levels like these are, interesting times. This company is engaged in exploration in Weld County, Colorado, a premier DJ Basin, in the premier DJ Basin. And their assets comprise 54,000 acres.
And since increased.
It's since increased. So happy to have Wabi.
Plugsma.
I gotta get that name right.
A lot of vowels.
Unique name. Wabi Plugsma. And if you can spell it, you pass.
If you can spell it, I'll send you a care package.
Right, Wabi, all yours.
Thank you. So, like Robert said, Wabi Plugsma with Prairie Operating. We are a public corporate company. Our ticker symbol. Yes. Public company. Ticker symbol is PROP, prop, Prairie Operating. Since we are public, here's our disclaimer. You can read that on your own if you want to. Some bedtime reading, put you to sleep. It's on our website and in any one of our corporate presentations.
Really intimate with the mic.
So we are a DJ Basin oil and gas company. We are located in Weld County, Colorado. We have about 65,000 net acres, and we do about 23,000 barrels of production a day. We just completed 2 acquisitions over the past year. The first one, Nickel Road Operating, was about 100 million. It came with 5,000 barrels of production and another 5,000 acres. And the transformative acquisition that we just did, Bayswater, was a $600 million acquisition. It came with 20,000 acres plus and 25,000 barrels a day of production. We were able to complete that transaction as a $100+ million market cap company. So it was literally a minnow swallowing a whale. We went from 14 employees to over 60 in a matter of a month, fully integrating the 2 companies. To date, this year, we've drilled about 27 wells, and we operate over 360 in the basin. We have 600+ locations, which is about 10 years of drilling inventory. And we have a very strong hedge book. We hedged the majority of our production, about 85% of it this year, the day before Liberation Day. So we locked in about $68 a barrel and $4.50 for gas for 2025. For 26, 7, and 8, we're about $64 a barrel and $4 on gas. So we have a very robust hedge book. When oil dropped after Liberation Day down to like the mid 50s, I think our hedge book had about $70-80 million of value in a matter of a couple weeks after putting it on. Our main goal here is obviously shareholder return. Right now, we do not distribute cash back to shareholders. We are in growth mode. But once we hit that inflection point of production to where cash flow is outpacing what we will need for our growth and maintenance CapEx, we will start to distribute cash to shareholders in the form of dividends. And we are targeting next year to be able to do that.
You said not next year, or you said next year?
Next year. Yes. As you can see from the map here in the DJ Basin in Colorado, we are in the yellow. The purple is Chevron. They surround us along with Civitas and Oxy. We are kind of right in the middle of all of that. This is not exploration. It's more of exploitation. We know the oil is in place there. The DJ Basin is one of the premier shale plays in the United States outside of the Permian. How the Permian, if you've been following that, is kind of peaked. At $40 oil, the Permian has about 3,000 locations left. For some companies, that's a year or two's drilling. As I said, we have about 65,000 net acres, 23,000 barrels a day of production, and our PV10 value is just under 1.3 billion.
Are you owning all of this acreage, or are you leasing the mineral rights?
We lease the acres, but we own the acreage for the most part. And we have the mineral rights on this as well. Others, you know, a landowner will lease it to us. We will make royalty payments to them. But our PV10 is just under 1.3 billion. Our market cap currently is 130 million. Our growth plan is a two-pronged approach. We look to grow organically through the drill bit along with acquisitions. As I say, we did 2 very large acquisitions. We'll continue to do that while we are drilling. Just a little bit of a highlights from our Q2 report that just came out. We did 68 million in revenue, net income of 35 million. That was producing 21,000 barrels a day, 50% of that being oil, which was a 540% increase quarter over quarter. Our adjusted EBITDA was 38.6 million, which was a 600% increase quarter over quarter. And we had an impeccable safety record. We had 0 incidents across all operations, and we strive to continue doing that. We put out guidance for the remainder of the year. We're looking to be producing between 24 and 26,000 a day in production. Adjusted EBITDA between 240 and 260 million on a CapEx budget of 260 to 280 million. Kind of the pillars of our company: financial expertise and leadership, focused on organic and M&A growth. We're focused right now on the DJ Basin. We're not looking to get into the Permian. We have enough out there to satisfy us, and it's disciplined capital allocation. The 2 acquisitions that we did were both off-market transactions, and we were able to complete those at 2.5 times or less EBITDA. At the time, you could do 2.5 times EBITDA. That would be a private company, put it into the public vehicle, and you were trading at 3 or 4 times. You had an instant arbitrage and an uplift in value, and we'll look to continue to do that. I mentioned earlier our hedge book. This is just a kind of graph, as you can see how our volumes are hedged throughout 25 through 28 on the oil and gas side. Again, we're 85% hedged for 2025 at $68 a barrel and $4.50 on gas. And for 26, 7, and 8, it's $64 on oil and $4 on gas. So in the DJ Basin, we are targeting the Niobrara A, B, and C, and the Codell Sands. Highly prolific zones here. We're in what we'd call an oil window. We're predominantly oil, 70% liquids, 30% on the gas front. So oil is what makes up the predominance of our revenue stream. One of the main drivers out here is takeaway capacity. We have contracts in place with all the major pipeline and takeaway providers in the area, which will satisfy our 10-year development plan. We have access on pipe to over 100,000 barrels a day of production. So we can put into their pipelines up to about 100,000 on our current contracts before we would need to look for additional space. We have priority, so if another producer is on that line, they would be kicked off to make room for us, which also kind of benefits us in the M&A aspect. Anyone in this kind of area is kind of incentivized to sell to us, because if they start drilling, they put it on pipe, we potentially have the ability to kick them off, and then they're shut in. So we become the natural buyer. I said earlier that we have about 10 years of inventory. This is kind of a breakdown of how we have developed that It's through existing locations on the acreage that we have, through acquiring, through leasing, and through additional A&D opportunities. We like to keep about 10 years of inventory ahead of us. Anything less, the market thinks you don't have room to grow. Anything more, the market tends not to give you any credit. So 10 years seems to be the sweet spot for that. Operating in the DJ Basin in Colorado, regulatory issues are at the forefront. It's second behind California in regulatory presence. That has kind of been put kind of to rest. There was a moratorium not too long ago, which has kind of capped any new regulations put in place. It's put more of a certainty for operators in knowing what they need to do in order to get permits and begin drilling. We have a very competent, extensive team that focuses just on regulatory, and they've come from Chevron, PDC, and are ingrained in Colorado regulatory politics. This just goes to Prairie. Our goal is producing the cleanest molecule here. We use e-fleets. We don't truck. We put on pipe. And as I said earlier, we have had 0 incidences on, excuse me, across our asset. So this is a team that has done it before. As I say, not our first rodeo. One of our founders, Gary Hanna, his last company was sold for $2.5 billion. Ed is a 25-year industry veteran on the banking and on the oil and gas front. Our CFO, Greg Patton, has only been in the DJ Basin in oil and gas. He knows the assets inside and out. Brian Freeman, he's drilled wells everywhere on basically the planet, from Saudi to offshore to the Permian to the DJ. Anything you can think of, he's seen it and done it. And our general counsel, Dan Sweeney, 25 years of legal experience, all in oil and gas. So you can see our, this was our adjusted EBITDA reconciliation, which was the 38.6 for the quarter. And this will give you kind of an idea of our 240 to 260 in our guidance, should you choose to. And that this presentation is online on our website. We just put out an operations update last week for our Opal Coal Bank. We were doing about 500 barrels a day per well. So it was 8-well pad, 4,000 barrels from that pad alone. We had 3 others behind that with Noble, Rush, and Simpson, which will put another, I think it's 33 wells online this year. So we are active in growth. Happy to answer any questions anyone might have.
Just out of curiosity, how do you intend to spend investment?
It all goes into the ground. Like right now, all free cash flow that we generate goes right back into drilling operations.
Repeat the question.
So what do we plan to do with investment and capital that comes in? Yeah, it goes straight to the drill bit or to M&A for acquisitions.
I was looking at the stock. I was wondering, when did you guys get onto the NASDAQ specifically, other than OTC?
December of 23. So prior to that, we closed our first acquisition in May of 23. Anything behind that we merged into a shell pretty much.
You're guiding for 240 million?
Yes.
For
this year.
This year, your market cap is half of that.
120, 130.
Wow. That's really wrong.
That's where the opportunities
That's a-
lie.
Yeah, that's a cool market there. Your cap structure right now,
Yeah.
equity wise.
So we have an RBL with Citibank. We have a preferred equity piece that's with Hudson Bay, and then common equity. That's the breakdown of it.
Is the preferred convertible to common?
It is convertible to common. We have stated publicly that it's our goal to refinance that out this year, so as to take away that dilution overhang, because we think that's what's weighing on the stock right now.
Yeah.
But even, as I said to you, even if it was a full conversion, you do the math, you're basically trading at asset value just on the production side at $2.
How much is the equity value or the amount of the market value of the preferred?
148 million.
Okay.
So we have 5 analysts covering us from Citibank, Piper Sandler, Roth, Clear Street, Johnson and Rice. Buy ratings from, I think it's 3 to 11.
Mean target?
I think 6 or 7, something like that.
Okay. When does this price erosion end? How much lower do we go here?
Like I said, $2 seems, from my back of the envelope math, is right at your
the underlying.
Commodity.
Yeah.
I mean, I think you had the opportunity for it to continue lower. It's held in very well.
Yeah. That's the exposure, right? As goes oil, as goes crop.
Yes and no. Short-sighted, yes. On a bigger picture, remember, we're hedged out. This year it's 68 for 85% of it, and 50% in 26, 7, and 8 for at 64.
Like 60-ish.
We're at 64 for through 28.
Right.
Our break evens are around $40 a barrel.
Wow.
Yeah, it's a great business. So, but it's oil and gas, and people tend to.
Yeah.
The oil and gas industry kicks off the most free cash flow or distributes it, yet it gets the lowest multiple in the S&P.
So you showed the purple areas for Chevron on the screen. Is there other gas stations you compete with? Like, I see gas stations all over, little ones I've never heard of, like Sinclair.
Those are gas stations, right? We're drilling for oil and gas. We sell our oil, and then that will go to a refinery, and then that will be distributed to whatever gas station.
Are they your competition, like the gas stations, or do they have wells?
No, those are not. Like, competition in our area is more so we would be competing with somebody to, say, purchase, let's just say this block was for sale. We would be competing with whoever here wants to try and get this. But as far as drilling, we're all getting the same sort of price per barrel depending on what you're hedged at. So I'm not competing to sell mine versus Chevron. There's an ample market to sell into.
I have kind of curiosity, in what ways, if any, does AI impact like your operational?
No, that's a good question. So my last company, right, we were in the Permian. I would sit on site. I would sit in the operations room. I'd go on the rig, and I would see people, roughnecks working. In this one, you're using AI to basically guide you the entire way. So it's helping the rotary steer go. So it's within a foot. Like it's incredible how precise, like you can be landing something 6,000 feet under the earth and be within this of your target.
Is that how you were able to increase the barrel amount? Like you said,
I mean, it helps, right? As opposed to just human seeing and knowing where it is. But if you go and look at, say, the drilling engineer in, let's say, the command center of the rig, he's sitting there in an armchair like this with 6 large screens all around him, almost like he's flying a plane or playing a video game for the most part. Prior to that, it was one screen here and, you know, all the guys out there interchanging pipe. So it's definitely playing a role. All right.
All right. Well, thank you. Woby Plaguesma. All right. Wear the hats. Last time we presented, he had these very cool hats.
Yeah. Make oil great again hats. I don't know if that would be the right audience right now.
Investors. Okay, so our next presentation will start in about 15 minutes. So take some time, walk around, get some air. Can't really tell if these mics work or not.
I have no idea.
Boom, boom, boom.
Now they are. There you go.
See how they're really right here. Okay. So thanks, man.
You got it.
Thanks for
Thank you.
doing it. I have a one-on-one meeting with you about something that's more follow-up questions.
Yeah, happy to.
Get these guys started. So
Whenever it's fine. I was telling Alicia, yeah, happy to come out to Vegas again and do the dinner. So
okay.
It was beneficial. So
Yeah.
happy to be out there. If you have investors you want me to present to,
Sure.
just let me know. I'll be over there.
It's his name Derek, the tech guy. I keep forgetting his name.
Oh, Bobby.
No.
Derek.
His assistant.
I think I'll go back out. I just came in. Well, Bill Jones was like running my checking table because he was inviting someone that was gonna do like a big portfolio manager. I'll come out now. Look at the exact time.
So good. That's a good.
I'm saying you want to do sunsets. I'm saying it's actually cool.
right on the river, and same thing. So you get these boats and you walk around, so you get that whole outside, then you get high, go back and forth. So, wow. But it's I mean, you're live on like just to try to.
Like, we're going to the ferry. What? You know what I mean? Like, you have to take the ferry.
You're right. Still. Yeah. Oh, that's right. Yeah, I'm gonna look at this.
They was there recently. I don't know where it was.
What is that?
And it has to be specific. Yeah. He probably would, but it's not in that. No, I can't see that. I can't see that. That's crazy. You expose us under. I would never. Yeah. I'm gonna go get some water. You know, when you're in it and you keep working.
Yeah, it's like going to
Really sweet. So he surprised me if you can get dinner. We took me to dinner. We did.
That was pretty cool, actually. It was like, oh, when do they come?
This is gonna be exciting, yes. Because we knew how, it was a couple of years.
Janet.
At least you got I think like a year
No, I don't see him here.
You didn't forget, that's right.
Uh,
No, Lamb.
yeah, I don't see him. Yeah, he's not. I'm gonna email him.
Yeah, so I
Call him.
figured, shoot him a text.
He's late sometimes.
Oh, okay. Okay, you know who's
Gentlemen joining us for the presentation today. We're got a room full of investors. Show me a sign. Let me know. Thanks, Robert. Someone registering. Here somewhere. I'm gonna call him. We got things to do here. I think I'm gonna call him. Here it is. Hey, Tom, Robert, Malby, Singular Research. Hiya. Good. You joining us? Okay. Wow. No. Can you join us now? Okay. That would be terrific. Do you have what you need to link in to the show? Like same as before to the conference. Okay. Yeah. Perfect. So we have tech support here because I'm not so good at it, but I can talk about it. So I'll let you try to work on it, and I'll stay here on the phone if you need us. And also, do you have your PowerPoint, your new presentation, or were we using one from the? Okay, yeah, email that to me so we can upload it. All right, so I'll hold on, I guess. Okay, terrific.
Well, you can do it there, share your screen.
All right, thanks, Tom.
He can share your screen.
Huh?
I said he can share your screen on his side if he wants to.
Yeah, he's virtual. Yeah, I think he's done this a few times. He might be getting good. He might be getting good. So yeah, this is a whole different way to do it.
What were you using before?
This, but they totally changed the interface. Yeah, I'm like clueless. Like I wasn't very good to begin with. So.
You said you had a tech person and they just not there anymore?
Yeah, no, he left the firm, and we this is the thing that really threw us off here. It's like, wow, it's like different. Don't on the fly. It's just hard to find anything. You know, it's different like this. So we'll see him. He should appear here. He's got it. A few minutes. Hey, Tom? I think he hung up. He's trying to get in. Give him a few minutes. Yeah, he sounds pretty confident. We've done it a lot of times with him. So, but he may run into the same, like, whoa, what is this? So we'll just wait for him to magically appear. It's a nice operation you guys have up here. Plug and play, pretty smooth. You guys have been tremendous. You know, I couldn't have done this. That was fantastic. I remember years ago, I did this at like one of the big hotels around here, and they have some service that they use. They all use at that time. We changed, but they weren't real helpful. Not very. It's like, yeah, you gotta go. Yeah. What do they call it? AV something. Come back.
Yeah, exactly. And then you want to go to streamings and go to Mark and all the attendees.
Yep. Spread. That's a great strategy. Here he is. Hey, Tom. Sure. Not happening. Okay. Hang on a second. Okay, perfect. I'll resend you the link to jump onto.
I think you like this one better. I think you were more comfortable. Which email were you more comfortable? This is
Yeah, that one. He's sending it here.
This is the one here?
No, not that one. The one we're on here. It's fine. It should come in here. He's
this
sending
one,
it.
right?
The one we're in. This is X that out.
No, this is what.
This is the one we're in.
This is the one we're in.
Yeah.
You want?
Yep.
This is the other one.
Yeah, it's the other one, right? Yeah. Shouldn't come in there.
No. Should be in this one.
Yep. When it comes, and then we have to send him a link to sign up with.
So he's gonna send us. Let me close out.
Yeah.
This one. This one.
But I got to send him an invitation to sign up.
Yeah. So if he sends us, this is him.
Yep.
This is him.
Yep.
So this is what we need.
Uh-huh.
This is a PDF though.
Yeah. PDF's good.
Okay. Whoops. Twice.
Yeah.
Okay. Oh wait. We left them. We left them.
He has to sign in, and so
we got to
he lost
reply.
the link, and so we have to send him a new one.
Let me see if I could find.
We have your presentation, Tom. We're looking for a fresh link to send you, so stand by.
Let me see. Do you have the link? Do you know where we can find the link for him in this email?
Hey, Tom, can you hear me? Okay. The quickest way to do it is go to our website. The link is right here.
Oh, it is.
Go to singularresearch.com.
When that opens, you'll see the link. Yeah, that's right. Estonia. While you're doing that, let's try to send an email that has it's modern, but trying to find out when it's forward.
What is it, singular? Oh, you would have it on there, right? If you go on your phone. You want to go on the website on your phone and copy it and share it?
That's an idea. I may have it, maybe on the trail here, just to grab the link here.
You want to send box? What's the website? You said singular. What was it? Where's the link? Is this the link here? Where's the link? Which one? This is the link? Is it?
That's a good idea. Very good idea. I don't know why I can't retrieve the email. It's just,
I sent an email.
You sent him an email? Yes.
Yeah.
Hey, Tom, we just sent you an email with the link. So stand by for that to get there.
I gotta admit it. I'm gonna have to register and get out, put it again, and then register again. I don't know why it makes you do it twice. It might do it the first time though.
Yeah. Do that too. I can give that number to It's, the session ID is 727. All right, it's probably coming in. You have it here already. So I think we'll see you, we'll let you in. Excited about it. And for this, we need to see your But Tom's had success, I think.
Yeah. Nothing yet.
You see, Tom? I think if you want to, we have the one you just sent, caption 100 plus MLBS potential in Wyoming and New Mexico. You got a better one? Okay. That's nice.
That's you. That's been there this whole time.
He's been here the whole time, so he's in.
Oh wait. No, that's just us talking.
That's us talking.
He would see you. Once he's in, he'll see you.
Sorry?
I said, once he gets in, he'll see you.
Yeah. He wants
I think he
to
just
send
got
me a different presentation, a newer one than that.
Well, he's got to get on first, and then.
Yep.
Does he need the session ID?
How's it going? Okay. All right.
Is he in it yet or no?
You said you sent it.
Let me see. Reply to.
I know, like as we were walking out.
I think so. I would do that. Yeah, coming in. I see him, Ruben. I'm not here.
That's fine.
At the bottom.
Oh, there you go. Okay.
We had a positive. Did you send that one?
He's in.
Oh, yeah, good.
Yep, Robert. You're just gonna click for him, right?
For me, I think he's remote.
Oh, he's gonna remote it? He's gonna share?
He's remote.
So I don't have to, no, he's gonna do his himself, or you're gonna click it? He's in though.
I think you're in, Tom. Can you see us? All right. So now, do you want to, can you move the slides yourself?
Well, if he shares it from his thing, yes, but if not, you're gonna have to do it. He would have to do it on his end to share. If he wants to share it, he cannot just take this off. Yeah, if you want to. Let me stop sharing.
That's fine. I'm happy to do that. I have a. Now, in this interface.
Are you a presenter? No, you're not a presenter yet. Okay, try now.
Okay, here we go. Do I want to include the go-to interface?
Yeah, I mean, you're sharing. Yeah, that would be.
Okay, and optimize for video.
And we would see you, or?
Okay, I'll go to.
In the bottom, there's a share button in the bottom, and then you would go to share, and then you would pick your window, what you want us to see. I don't know if you have a double monitor or a single monitor, and then you just pick that where the actual.
Share.
Yeah.
It's asked me to.
Let's give you a tab of Chrome, the browser tab, or then it gives you a window tab. You want to click the window tab, not the entire screen, the window, and then you would select where your PDF is at.
It's asked me to open system preferences to grant permission, which I've done. I've granted permission to screen share to.
Yep.
Go to meeting. Let's see here. Okay, hang on a second. But I've emailed it to you, Robert. You could,
You want us to put it up?
yeah, if the one I just emailed to Robert most recently, which is 6 minutes ago or something.
Is it there? All right. Now you just gotta unmute yourself.
Mute myself?
Oh, there you go. Hold on. You can hang up.
Turn on the camera if you like to.
There you go.
And
Instead.
oops, easy.
Good.
Live?
Here we are.
Does it work? The slides, test. I think you got the good control.
I'm not sure how to.
Oh, you can hear him. You're live. But you're gonna
Change
have
the
I'm gonna turn the slides.
slide.
Oh, you know what? Hold up.
Hold on.
It's my fault. We might not be able to. Let me see.
That way. That's the entire screen, sure.
All right, yeah, you.
Yeah, I'm gonna turn the slides. Looks like I'm gonna be your personal slide turner. Hold on a second. Let me see. Yeah, okay. We're at the beginning. Okay, let me introduce. All right, after no more delay, we have our last presentation of the day, and to me, it represents one of my favorite commodities, uranium. Going to hear about uranium and why? Why it's the fuel for AI, and why it has been kickstarted to increase production by 18-fold. He's calling me now. I'm going to do his presentation. All right, bear with me. We had him, and then he's in Estonia, which is on planet Earth somewhere. Estonia. So I think they are still making their way towards the 21st century. Let me get Ruben here. Help.
Hi there.
Are you back?
Yeah.
Okay. So can you,
I'm back.
see the screen? All right.
I can see the screen here.
We got to find the turner. Okay.
Yeah.
All right. So Tom is the CEO of Myriad Uranium, which is a junior miner, and we follow the stock. Jim Maroney, who spoke to us earlier, has a $1.35 price target. Is trading at about 18 cents. So lots of room. And in our mind, one of the lowest price ways to play that uranium that is the lifeblood for AI. So Tom, it's down to you now, and I'll turn the slides. You just tell me when.
Oh, I see. Oh, very good. Okay. Well, hi, everyone. I sincerely apologize. I'm not sure if Robert mentioned, but I'm over in the Baltic and Eastern Europe, and the connection is actually very good internet here, but wanted to verify that I'm human logging in. I'm very happy to be here. Myriad is a really interesting company. I personally have built several companies with partners from zero to over $1 billion as part of a team. And this is a candidate for that also. These prior deals include in gold and in cobalt. And our chairman, Simon Clark, and I were partners on M2 Cobalt, which sold to an offshoot of Glencore. And our chairman, Simon, had built a company called American Lithium from a few tens of millions up to 1.3 billion. And so this is what we're going to do here. So you can see 100 million pound potential in Wyoming and New Mexico. That would make us a really big company, and we're partway there. So you can go to the next slide. I don't think I can control here. So I actually just inserted some very interesting slides before this. And so it was meant for me to scroll myself here, so I'm sorry, Robert, but if you could scroll down a few more slides. So keep going. And let's see, another one. And keep going. And one more. Okay, let's stay here. I will just jump straight into the situation. I think it's useful for me to get right into it. Myriad Uranium has two projects, one in Wyoming, one in New Mexico. The project in Wyoming is called Copper Mountain. In the 1970s, Union Pacific Railway partnered with Southern California Edison to advance this project. They spent $85 million over several years, that's in today's dollars, drilling 2,000 holes right here, and you see the result of some of them right there on the screen. It's just a bunch of colors for you, but I'll explain it. And they planned a large-scale uranium mine. They had it sketched out. They had it planned where they were going to put the leach pad, etc. And that initial mine was going to, according to the plan, produce 15 to 30 million pounds of uranium. They drilled about 1,000 holes into that area that was going to be mined. Then they drilled another 1,000 holes in the periphery, and they determined that that entire area, including the area around, would probably contain over 65 million pounds. That makes this one of the larger projects in the United States. But in 1979, the 3 Mile Island accident occurred, and virtually all uranium development in the United States stopped. So that is why our project is not currently a large-scale uranium mine. Therein lies the big opportunity here. We are a small company. This project went into Myriad, and it went into Myriad before everybody realized that we have a monster of a project that belongs in a much bigger company on a much larger exchange. That is what's going on here. That is why I personally have invested $650,000 of my own money at high prices into this, and I will continue to invest. That is why management has big ownership and keeps investing. That is why we have Swiss Uranium Fund, which normally has 100 million market cap minimum, as far as I recall, come down and invest in us. That is why we have lots of East Coast funds, Toronto, and some significant uranium investors that are, well, prominent uranium investors that have invested in us. They know and they believe, and so do I, that the moment will come where the market realizes and understands that this is a big project, not trapped, but located in a small company. So we're going to unlock that. So back to 1979. 1979, Union Pacific had drilled 2,000 boreholes, and they had probed those holes with something called a DFN probe. And they estimated the amount of uranium in the ground using that probe. And the results are the orange colored. So there's orange, yellow, and red in this graphic that you see. And that DFN probe revealed to them a certain amount of uranium. It was good enough for them to plan a large-scale mine. I've seen the economics that they had planned, that they'd estimated. It had a 3.7-year payback period, a 20% discount rate. Back then, interest rates were higher. And it was going to be a profitable mine, according to their model. And it was going to start production in 1983. When they did that drilling and probed the holes to estimate the uranium, they had a sneaking suspicion and reasons to believe that they were underestimating the amount of uranium at Copper Mountain. But it was too late. They were already quite a ways down the path with their mine planning. And so they went with their conservative numbers, and those were good enough. Then the 3 Mile Island accident occurred, and that was the end of the project. Now, fast forward, we were the first company, ourselves and our partners, our partner company, Rush Rare Metals, who we are merging with soon. We're the first group to have unified ownership over this project since 1979. In the 2000s, two companies had half and half of this project, and they'd planned to unify ownership, but they never quite did. And then Fukushima hit, and that was the end of that, the Fukushima accident. So here we are. It's our time. Again, 1979, conservative estimates of the uranium content, but they nevertheless had planned a mine. Last year, in late 2024, we drilled the center of the project, and using a newer probe, new gamma technology instead of a neutron probe like they used in the 1970s, we got better results, more uranium. So that is the next additional color that you see there. Together, the orange and the yellow are the combination of the 1979 drilling and the drilling from last year, where we used a new probe. Okay, we were ecstatic. We were telling everybody that we had even better results than what was going to become a large-scale uranium mine in 1983. But we were cognizant that they suspected there was even more uranium at the project, but they never modeled it. They didn't, because they couldn't really identify it, and so they didn't put it in their financial model and their mine plan. We sent all of our samples that we thought we should to the laboratory for chemical assay, which gives you 100% accuracy. And amazingly, where there's significant uranium, we found 60% more uranium than was visible to the probe. So we have an entirely transformed project here. We've just started disclosing all of this to the public, and there's more disclosure coming about how, just to summarize, we have a beautiful project that was going to be a mine. It was better. at the end of last year, and then now we are currently putting out more disclosure, telling the world that it's even better and better. So we have the potential. We have the potential to be the largest or one of the largest uranium projects in the United States. This is just as the demand for uranium, and in particular the demand for uranium inside the United States because of politics, geopolitics, White House policy, etc. Just as demand for domestic uranium is skyrocketing, and investment, for those of you who follow this, is just about to pour into, well, starting to pour into uranium companies and pour into the United States. So we believe we've hit this just right. You may be familiar with how things work with large caps versus small cap companies. Well, in minerals in particular, the large cap uranium names have started to move, and the smaller equities, they follow in our business. So we and our peers will start to move soon, we believe. And then, of course, the very best companies in the junior space will move the most. And we believe this is going to be very exciting. We have, the next 6 months for us is going to be, in particular, extremely exciting. So that is what's going on here. You can see how much the amount of uranium in the ground has grown over the past year, in fact, our concept of it. And it was already going to be a large-scale uranium mine. This is something, this is the first time that I've shown anybody this slide. We just finalized it today. And this is after about a year of work. And, I'm sorry that it's not, that the lead in had to be a little bit rushed, and that it's not taking up the whole screen, but here we are. This is very exciting. I think you get the idea. Our company, Robert, you could perhaps scroll down. There is a summary page. You can go past this and the next one. Now, are you able to show this entire slide here, the uranium supply and demand?
Try.
Okay. Yeah, very good. What's going on here in the world is that, take a look at that top line. That is projected uranium demand, but it does not include data and AI, because this was done 18 months ago. And data and AI and small modular reactors lift that line significantly. And the bottom bars are the supply, projected supply of uranium. There is no fast way to add more supply. Uranium does not work that way. So we have an exciting situation in terms of the projected price. The current price, spot price of uranium is $77 per pound, and a lot of banks are projecting $135 a pound later next year. When that happens, it's going to be wildly exciting times, and that's what I'm here for myself. I personally would be doing something else if this wasn't the future that we believe is likely. Robert, you can scroll down a few slides here. This just came out last week. I was in London at the World Nuclear Association conference, and you can see some scenarios here, but this is demand and supply, and there just simply is no way to get more supply in the uranium space. You can continue, and we can look at the summary of the company with shares and cap table, et cetera. It should come up in a moment. Well, as we get there, you'll see what Copper Mountain looks like. Our Wyoming project looks like that. It's beautiful. It's a former uranium producer. And that's my dog, Hugo. So, yeah, so we're located in the center of Wyoming. You can keep going, Robert, if you like. This was something interesting happened. This is a photo of the reason. One of the exciting things about this company is Union Pacific did $85 million worth of work, but there was no data available publicly. And that is why we did not know that the project was huge. When we acquired our interest in the project, Myriad was just a few $1 million market cap. And we decided that we would take on this project and see what was there. It was only when we drove to, well, my counterpart, the other company, was driving and met a rancher. And the rancher said, "Oh, you have this Copper Mountain uranium project. You probably want to come talk to me. I have been saving paper-based documents for 50 years relating to this uranium mine. Would you like to come over for a cup of coffee?" And my counterpart, Peter, went over, and it was like Indiana Jones. All of a sudden, the small project turned out to be an enormous project that was going to be a large-scale uranium mine. And here's the data, which we drove back across to Vancouver, Canada. Thanks, Robert. This is exceptional. All of that work we would have had to do ourselves and create that over years, spending $85 million. But we didn't have to do it. We have a roadmap. We have a lot of data. This is just an old map of where the uranium is at Copper Mountain. So instead of us having to explore for it, all of our counterparts that are similar market cap are out looking for uranium, but we have it. So thank you. You can keep going, Robert. We'll just go to the, you can keep scrolling. These are some of the interesting information, including suspected roll front deposits of uranium that we have at our project that aren't even included in these estimates. So geologist George, I want to mention something important. In 1983, the US Department of Energy analyzed Copper Mountain and estimated that our project has 200 million pounds of uranium. That is, maybe I mentioned that earlier, but this is absolutely one of the largest, potentially one of the largest projects in the United States. And you can keep going, Robert. This is what the old information, the old drill information looks like. This is what was included in these bins, and from this we could extract and make 3D models for the subsurface. You can keep going. Thank you. Keep going. This is what drilling looks like at our project. All the drilling we did last year. It's a news release that just talks about the results, saying they exceeded expectations and verified the old work. So we were very confident that this will be a mine again, or that, you know, that we'll be back on track to turn it into a large-scale mine. Thank you, Robert. You can keep going. You can keep going. The project was a producer. It produced a lot of uranium during the Cold War, 1950s and 60s. These are small mines that were on the project, so it is a past producer. Yeah, keep going. This is what the results of drilling looks like. Those are the samples. And our technical team. Yeah, keep going. So just really 2 more slides to talk about this one, and then the overview. When we did the chemical assays, grades were up to 60% higher. Anything over 1,000 ppm or higher, there's 60% more uranium. This is due to something called disequilibrium briefly, uranium decays in a known way, and these probes are designed to pick up the daughter products of uranium, not just uranium itself. It turns out that proportions of uranium to the daughter products at our property are off, but they're off in a way that is fantastic, has turned out to be fantastic for us. And there's much more uranium than anybody expected, pardon me. And then we can just go to one more, the summary page of the company. And then I'm happy to take questions and keep going. Well, this probably works as a summary. Fundamentally, we have a team that has done it before. Myself and my colleagues have built companies and sold them, and so we're doing it again. For those of you who understand mining and uranium and jurisdictions, we are in the middle of Wyoming. That's the best jurisdiction in the world right now. We have a very large package of land in an area that has produced uranium in the past and was about to be a large-scale uranium mine. Those of you who are concerned with permitting, people ask that in different jurisdictions. Wyoming is excellent, and they just produced an open pit, or sorry, they just approved and permitted an open pit mine, and it's a gold project, U.S. gold project. This is fantastic news for people who are concerned about that issue, and many people are. Again, we have a huge amount of past work. We have a historical resource. There's definitely known uranium in the ground, and a lot of it. And there's really big upside potential. Again, Union thought there's 65 million pounds and up, and the US Department of Energy believed there's 200 million pounds, or there is 200 million pounds at Copper Mountain. So we're just getting started, getting to 200 million pounds, we hope that we will get there. And all of this makes us a very attractive target for the variety of larger uranium companies who want excellent projects. Also very exciting for AI and data companies, tech companies who need to secure long-term sources of uranium in big volumes. So we make an excellent target. Thank you, Robert.
You bet. Any questions? Yes.
So you mentioned an upcoming merger. I didn't catch the name of the company, number one, and what do you expect that, how will that impact the project and shareholders?
Yeah, and sorry, the company's name is Rush Rare Metals. Rush Rare Metals, and I believe that's the website too, rushraremetals.com. We are working towards the agreement for the merger, so maybe we will have that settled within the next month, and then there's a process of a couple months to complete that. When there is divided ownership of these projects, often you get reduced or lower, and sometimes significantly lower value for each company that owns a share of the project. So according to our analysis and the analysis of the analysts at banks that we work with, 1 + 1 should equal 3. And we expect an uplift in the overall value, aggregate value once the companies are put together. So yeah, anyway, I think you understand what I mean. So it's much easier to finance and advance a project with unified ownership. You get a reward for that.
Another question here from the gentleman in the second row.
Thank you. So you said it's supposed to be very difficult to get uranium out of
Just a minute, man. We've got a gentleman in the second row, then you.
I was gonna say, so he was saying that merger may be complete soon, and I also was gonna ask, were they planning to get onto the NASDAQ? So when, how soon for the merger to finish, and when maybe would they be looking for the NASDAQ or higher markets?
When's the deal out? Go ahead, you heard you.
Oh, okay, I think I heard him. Yeah, how soon will it close? It'll be, I'm supposed to say a few months. I'm supposed to leave it vague because the lawyers have asked me to not pin everything down. So there's that. In terms of getting on the NASDAQ, we're going to have to decide whether we want to list ourselves or perhaps we'll get acquired by a NASDAQ listed company, which will elevate us. We're looking at into these options currently. I've mentioned this publicly before. So we do want to get on the NASDAQ as quickly as possible. We think that will be a big multiplier of our value too. We belong, when we did this deal, we belonged in the United States. Once we found out what we had in terms of it being a big project, we knew we belonged on a big US exchange with a big valuation. So that's the bridge we need to cross, and the jump we have to make.
Lady in the back with a question.
No, I'm just saying, isn't it like very hard, difficult process to get uranium out of the salt with very high temperature? Because you can't just find it. It's just like it's like in the salt or something, and you get the high temperature to get this melt out of the some minerals or salt that I heard.
Difficulties mining uranium and maybe separation from other minerals?
Yeah, like separation to get it out.
Yeah, it's easy. It's easy. There are deposits in the world where it's more difficult. Our uranium, you simply dig it out of the ground and you can separate it by spraying, just in the same way you would with gold or copper. You put it in a pile on the ground and you spray acid on it, and it's but it's not a high temperature process. That's just one of the approaches you can take.
It is in demand that all the smartphone, everything it uses cannot be. It used uranium. Like a very
Demand supply.
Yeah.
I think we had a chart relating to that earlier, but with AI in particular. Also, the administration, I might add, has done a couple of things to kickstart uranium. I think Tom may have covered it, but one thing that they did is they cut down the time for approval from 5 years to 12 to 18 months. That's pretty big. The other thing, their goal is to increase production stateside by 18-fold, which you do the math. Right. That's going to create a lot of revenue from uranium. Is there another question? Okay, Tom, any final comments?
No, thank you, everybody. And thank you for, I really appreciate your time. And please contact me directly with any questions. Hopefully my phone number and email are
we'll display it.
Available. Yeah, happy to speak to anybody.
There you have it. The CEO, Tom Lamb of Myriad Uranium, live from Estonia. Yes. Thank you, Tom.
Thanks, everybody. Thank you.
All right, folks. It's been quite a day of technological challenge. So thank you for persevering and all that. But hopefully you got a lot of knowledge and a lot of ideas that you can prosper from here. But remember, these are high-risk ideas, right? So, it's either that or Vegas. And I'm kidding. Consult your financial advisor before making any investment decisions in this role. Thank you very much. Thank you. It's great to have you. Thank you.
Woo-hoo. Thank you all. You're all.
Thank you, Robert.
Thank you, John. All right.
Missouri and Texas.
The universe don't make sense, so it was meant for.
Yeah.
Especially before that day. Especially before that. That's-